Welcome everybody to a special edition of Face, the Summit, which is sponsored by IG and Forest Park FX and powered by forexanalytics.com. How's everyone doing today? How are all my trading warrior brothers and sisters? It's going to be a great two-day event. We brought in the best of the best so that in this pandemic environment that we're in with the huge volatility that we've had in the markets recently, massive swings. We were all praying for volatility last year. Be careful what you ask for. We certainly have it now. And we're going to have speakers that are going to be painting narratives and talking about specifics in regard to FX and currencies for you to take in as a two-day intelligence gathering event for you. So we will start off the first hour with base, and we're bringing in the whole crew today. Also, I did want to say hello. So hello, everybody. Welcome to Face, our special edition. At times, I think I'm the face of Face. So let's have a great session today. It's going to last a long time. It's a marathon, so have your questions ready. This is going to be interactive. So you're going to be able to ask guys like Mark Yusko and Peter Schiff and Jamie Satley, Peter Bookvard, different questions at the end of the interview or presentation. So it's going to be quite an event. And I'm going to start it off like we usually do every day here in Face and just talk about a couple of markets that may be of interest to you. Yesterday on Turnaround Tuesday, I was talking about the potential of a turn in Euro Pound, getting a nice bounce today back over this key 61, 87.44, 61.8 level here. We'll see what type of reversal can occur here. When you look at it a little bit longer term, we had one hell of a move. Yes, I use the move hell, and Ellioticians would say this is impulsive. Another definition is that we got from point A to point B in a hurry instead of chopping around in corrective fashion. So it's my contention this was not the end of the move in Euro Pound, but that we could have something similar like that happening from here. I'll give you a Nostra Pinkert call. I think we're going to be trading over a buck on Euro Pound. I want to talk about the dollar quickly since that's the focus of the webinar here. We have a couple of key areas for you to pay attention to. Closes back over this 101 level is going to set the stage for new highs. As you can see, we have this little potential corrective pattern, but you really here's how you have to bracket the dollar back under 98.33. We could have a pretty good failure to challenge this low. So right now we're in the middle of no man's land, and breaking out above this resistance 101 should give us new highs above the 103 level. So I'm not going to spend a lot of time on analysis today because we have Greg Horvat with us during the regular Face special edition. And at this time, I'm going to turn over to my colleague, Blake Morrow. And everyone enjoy, sit back, relax, and sharpen your pencils for questions for our great crew of guests that we have here today. Thanks for joining us. How are you today, Blake?
Hey, good morning, Coach. What an exciting next couple of days for all the traders that are listening in right now. I was looking at just the lineup. I mean, our lineup in general, but for today, I mean, wow, this guy. We got this guy Dale Pinkert. He's awesome. But we got Mark Yusko, Mark Chandler. Hearing from Forest Park is going to be awesome. Just because for those of you that they are one of our webinar sponsors, but I'm pretty sure. I'm not sure if it's actually. I wanted to say I was pretty sure it was going to be Trent that is giving the presentation, but it might be Justin as well. Both of them are awesome at doing what they do. Is they find traders a broker that fits their needs, and they've helped hundreds of Forex analytics traders over the years, and they're awesome to listen to, especially for those of you guys that may not be so happy with your broker. But Peter Bachvar, he's awesome to listen to on CNBC. I really can't wait to hear him. Peter Schiff, he's obviously got a view on gold, so I'm really interested about that. Jamie's one of our favorite guests here on, and same with Mark Newton. Just a great lineup today. So I'm really excited. And before I even continue on, I just need to thank all of our sponsors, Forest Park, obviously, that I just talked about, IG Markets and the CMT Association are key sponsors to this event, and then FX Street for media. This is a great event that our team has put together. So I don't want to spend a whole lot of time talking about the event because it's going to be so long. And I've only got a few minutes today because we do have Greg Horvat, one of our team members from Forex Analytics that does the Elliott wave analysis. He'll be on with us in a little bit. So Steve Volge will be joining us. So it's I want to keep it relatively short and sweet for myself because my presentation isn't until tomorrow. Thank goodness, because now I'm going to have to make a couple tweaks to my my PowerPoint because I'm going to see all these other guys and gals and their presentations, and I'm going to have to make mine. Bam. Like exciting. No, not really. It's a PowerPoint, for crying out loud. It doesn't get too exciting. Anyway, let's talk about the markets, what we're dealing with right now. First of all, we do have the FOMC and we have GDP numbers today. So that might have a bit of an influence on the markets here today, even though it's more the forward guidance of the Fed that we're going to be paying attention to going into later today. But one of the trades that I took advantage of yesterday, which I think was more of a layup, and I hope you guys took advantage of it too. If you use Forex Analytics and you follow the patterns in play right here, then you probably are aware of the dollar yen. But the dollar yen really cracked some key support yesterday, and it backed up to that. I mean, this is a pretty easy technical move. I mean, it was like I said, it was a bit of a layup here because we basically broke the 107 level, and then all we did is we did a 50% retracement right back into previous support, became current resistance, and I was like, oh, there's a short right there. Now the dollar yen, I feel now that we're below the 107 level, as long as we stay below 107, the risk is for lower prices in the dollar yen. Now there is a big question mark that I have as a currency trader on how I want to treat the yen regarding risk appetite and risk aversion. In the past, the yen has always strengthened with risk aversion, meaning the euro yen, dollar yen, yada 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 would go lower as stocks would go lower, or if stocks went higher, the yen would actually weaken. We're not seeing that currently. We've seen that correlation breakdown, I guess is the way I should put it. But that doesn't mean that the dollar yen can't move down, and that correlation can't take hold if stocks come down. It is entirely possible.
Maybe it accelerates it, Blake.
It could, yeah, and that's a great point, Dale. It really could. So technically, and this is where I have to trust what I see versus trust what I think, because when it comes down to it, I mean, there's nothing more for me if I can get a macro or fundamental backdrop to confirm what I'm doing, to be in a trade because of that. Because of what I see technically, is confirming that move on a more of a macro or fundamental level. However, I have to trust my charts and my instincts first and foremost. And if I had to pick one of the two, I'm going to trust price before I trust what I think is right, because conventional wisdom isn't always conventional. So therefore, with the dollar yen, yeah, as long as we stay below 107. Actually like 107.20. Wouldn't mind being on the short side, and I don't mind being on the short side. Now, one of the other trades that I did, actually I got hit overnight, and if you guys are with Forex Analytics, you get this analysis every evening. Because I do all the updates for the basic technical analysis in the evening, unless I happen to be out of town, which obviously right now I'm not leaving anywhere. You get this, you get the evening updates, the end of day updates. What I'm looking for is, this downtrend line to continue to hold, and that it has. So as the downtrend line continues to hold in the euro dollar, I continue to play it as a bearish wedge. Now, there's a little caveat here because I did short the euro dollar overnight at 108.65. I got hit at, not at the highs, but at this trend line, because I was like, well, I'm just going to play the trend line. There's a couple things that could develop here. First of all, I see it as a wedge. And let me get rid of this line here. I see it as a wedge, but there is a risk that we had a false breakdown here, right? Also, there's a risk that we are possibly setting up an inverted head and shoulder pattern. So I can't dismiss what I'm seeing. Therefore, as the pair gets, if I should say if, not as it, if it gets back down towards the 108 level and it looks like we're going to hold, I'm going to cover. I mean, I'm not going to, if it's stalling at 108, I'm just not going to stay short because of this possible false breakdown, inverted head and shoulder pattern that's setting up. However, I want to stay bearish the euro if we close below 108 because that'll invalidate this this inverted head and shoulder pattern. And I don't want to totally give away my my presentation for tomorrow as I talk about the big hot mess that the dollar is in right now, because it is messy. But I am a little bit biased at this moment with the dollar. And like I said, I'm going to hit on that more tomorrow. Okay. One other thing I want to bring up before I bring in Steve and Stelios, my two partners and founders of Forex Analytics, I want to talk a little bit about the S&P. So yesterday, we had really talked about the S&P and the risk of us hitting the 618 retracement. It's a big fib level. I'm not the only person looking at the big 618. Everybody's looking at the big 618. I try to explain to people here on our webinar every single day. And by the way, if you don't listen to this webinar at this time every day, it's free. And you'll hear myself and the rest of the team discussing what we're looking at for the day. I sit here and I try to explain to people what I do is very basic. I'm not doing anything that's magical in a sense that I'm not looking at some obscure technical analysis, that's something that you've never seen. The analysis that I do here is the same analysis that I've been doing for me for over 20 years, but for people that have heard my voice, have seen these webinars. And, back when I had the morning edge, and 15 years ago, I'm still using the same technical analysis that I did use then that I do now. So it's not anything special. So I know.
So are many others that you spawned as traders, Blake?
I may have. I think so.
Yeah, I know you have because they've been mentees of mine, and people have said that you're a game changer for them.
And that's important because my quest has always been, by doing these webinars, is just reshaping the bell curve a little bit, because you always hear, if you trade the markets you're going to fail, and this high percent. I'm just trying to reshape that a little bit and tilt it more into your favor of succeeding. So I don't do anything strange for technical analysis. I follow very basic technical rules. I think more of positioning and macro and false breakouts, I think about wrong positioning in the market a lot. Those are just types of things that I incorporate into my basic analysis. So, one of the things that I talked about yesterday, and I want to just be clear here, is that we came really close to the 618 retracement, but we also posted a false breakout yesterday. So That is a bit of a risk for the equity markets today. Now, as you can see right now, we are higher. Okay, we are higher overnight, but there's still a lot of day left in today. I mean, North American trade hasn't even opened. So what I'm really looking for today, if we close below this 2850 level, that to me is going to signal that yesterday was a false breakout. We did, get the key reversal today, or the confirmation that we're reversing today. And then I'll be looking for short risk type of moves. Now, short risk type of moves might be more of a long dollar type of trade, or maybe long yen, continuing that trade, especially with the euro yen below 116. But I'm trying to just kind of outline for you how I'm going to be trading the next couple of days. And with GDP today, and also with the FOMC, those are pretty important events that the market will be watching. So, and one last thing I need to say before I bring in Steve and Stelios is, you might be saying, oh, Blake, well, if you're looking for us a break below 2850, does that mean you're looking for new lows? I don't think of the market like that. I think of the market I try to think of it, what's going to happen over the next, few days to the next week. Do I think a break below 2850 might usher in some selling back towards 2700? I do. False breakout, especially if we close the week below there, it could, bring in some selling in the next week. But, is that going to bring us, new lows? I don't know. I mean, there's a lot of variables between now and what could potentially be then, and over the next several weeks to months that, I'm not here to try to figure that out. I'm here to try to figure out what momentum is going to do over the next couple of days, because that's ultimately what's going to make me money as a trader. So anyway, with that being said, I hope I gave those of you that are listening in kind of an idea of what I do every day here with my analysis. But I have so many other team members with the Forex Analytics team, and if you're not familiar with our team and who is part of our team, you can read about them all here. And we're trying to get everybody here over the next 2 days. Amanda is she's in our chat room, and she is the one person, if I can just get her to say hello so you guys can hear her voice out in the UK, I'll be happy with that. So anyway, with that being said, I want to introduce my two other colleagues, Steve and Stelios, both founders of Forex Analytics. Good morning, gentlemen.
Hello, good morning.
Good morning, Blake.
Good morning, guys. How are you doing? And I'm so excited for the next couple of days. Oh, look, Steve's on video. This is the difference between where you're at in Athens, and in Athens it is 3 p.m. For me, it's 5 o'clock in the morning. So you're not going to see a video of me.
Well, why, Blake? It's the same time for me.
Come on, Blake. Just get out of your pajamas and do it.
Yeah.
And look at that crowd behind us, Blake. Look at all those people.
It's not happening. Anyway, hey, I'm so happy for everybody here. It's going to be a really exciting event. Steve and Stelios have done a great job putting it all together. Coach, I'm very happy that you're our host here, because I couldn't imagine anybody else doing it. So I want to say, everybody have a great first day of the Online Traders Summit, and I'll be here speaking tomorrow morning, but also my presentation is tomorrow later on in the day. So you guys enjoy, and I'm going to pass it over to you.
You're not escaping that easily. I want a prediction. What do you think about data coming in 10 minutes?
It's going to be worse than expected.
Okay.
I'm such a big news trader, Steve. What is the data? Employment claims?
GDP, advanced
okay.
GDP quarter on quarter for US, core PCE prices, GDP deflator, but GDP is the main
Minus
story
28%.
Blake, by the way, Data Flash is giving us an estimation of minus 4%. What does Bloomberg give you?
Let's see here. This is my Bloomberg here, my economic calendar. And so you were asking about GDP, negative 4%.
Okay, so they agree there. Okay.
Yeah. So yeah, we'll see. We'll see if that data comes in. I'm not. I'm not a 100%. I'm trying to grab something here. I'm not 100% sure that we're going to come in lower than expected, but I do believe it's going to be a fairly weak reading. I think more people are going to be focused on the Fed and the statements that the Fed have a little bit later today, actually. So,
Yeah, totally agree.
all right, guys.
All right. Good hunting, Blake.
Thanks.
Perfect.
Have a great day, everybody.
Thank you, Blake. See you
Good morning.
in a while.
Good morning,
Good
guys.
morning.
Good morning,
How are you?
everybody.
So, yes.
So for those that, first of all, for those that are asking, Stelio, on the event page, if you move lower, you can see the schedule of each of the days: Wednesday, Thursday, who speaks when, what's the subject. Like for example, we can see here in Peter, since he's with us. With the exception of Peter, the two Peters, actually Peter Bookvar and Peter Schiff, that we're going to interview them live. So I think that's going to be quite exciting, which also means that you have a great opportunity to throw in questions, and we'll do our best to forward the good ones. The rest are going to have a presentation, but that doesn't mean that they're not also going to leave some time in the end. I think the vast majority of them will leave something like 15 minutes in the end. So they can actually also answer some of your questions. So we're very happy being here and having all those people both today and tomorrow. Now back to what we do, which is charts and analysis, and we have in 35 minutes we start with Mark Yusko. So Stel, what did we have overnight and today in the morning?
Well, first of all, we have, like Blake mentioned, we have GDP coming up. It's a Q1 reading, so remember this is before the big effect of the lockdown.
Yeah,
so
big part of it. Yeah.
Yeah, we're expected a -4%. I wouldn't be surprised if it's not as weak as that. Q2 is the one that I'm more interested in. And as Blake said, we have the FOMC also, but really we're going to just be waiting for Jerome Powell's Q&A session. Now, in terms of what else I've been looking at, I mean, data-wise, yesterday we had the Aussie CPI came in slightly better. I mean, it's not that important. What I'm looking at is obviously equities, bonds, and oil. Those are the three things which I look at, and I try to make sense of the situation at the moment because it's a very complex situation with the coronavirus outbreak. And on one hand, you have equities, which are on, let's say, the S&P. It's on the same level as it was in January, before this whole thing really took hold of the world. But bonds and oil are telling a very different story. Now, bonds, the 10-year US and 10-year Bund, they're almost at all-time highs or very close to. Oil, we saw what happened with oil futures trading very negative in the May contract. The June contract, which is the next one, might go again to negative territories. You never know because of the lack of storage. This thing basically will get rolled over to the next contract, or it will get closed out. I don't think there's going to be a lot of actual deliveries taking place. So my view is something's wrong. Either equities are wrong or bonds and oil are wrong. I tend to think that equities are the ones that should be repricing a little bit lower. The problem is that it makes sense and to be lower than where we were 4 months ago.
The important question still to ask here, though, is not who is wrong, is, with the current situation being what it is, meaning governments and central banks, going to unprecedented extent in easing, if this decoupling between, assets that were, quite nicely correlated can go on for a much longer period of time than most people might expect. So I think this is the million-dollar question, right?
Yeah, and the short answer is yes, it can go on longer. It has done in the past many times. We even saw, I think we're in a situation now where we were in late February, early March, where we had a drop-off in equities due to the initial panic of the coronavirus. But then the market, what does it do? It always tries to see the clear skies ahead. It tries to get ahead of itself on the positive side. So we had a rally in end of February, beginning of March, even though contagion rates and death rates were all galloping higher. So, and we saw how that happened, how that evolved. We had another leg lower. I think that's where we are again. The markets are saying, look, there's going to be a vaccine. There's going to be some kind of a treatment. It's all going to be fine. In 3 to 6 months, we're going to be back to where we were before. I doubt that. I hope I'm wrong, but I doubt that seriously. So I think equities, because it's been for the past few days or a week or two, it's been kind of the logical trade to be short. I haven't been short, but I'm not long either. But it's made sense. And I think positioning has been one way. And now we're seeing shorts getting squeezed. And also you have the FOMO crowd, the fear of missing out, who are trying to get in now. And they're thinking, right, we're going to all-time highs. That's it. This was the low. So I think that's what we're seeing now. And once all these shorts are squeezed out, and everybody who thinks is late but is getting in, once they're all in, I think that's when we have the next leg.
And to be perfectly honest, we have markets that in most of the cases still keep rewarding people that are following that mentality, right? I mean, yeah, there is no question about it. Some of them got wiped out in the plunge lower that started in the 20th of February. But in general, this mentality has been rewarded again and again. Now, it's a big discussion to have, and the first speaker that we're actually going to have at the top of the hour is going to be Mark Yusko, and I've met Mark. We've met Mark.
Yeah.
In
I really
person
like
as well.
Yusko,
yeah. He's excellent. So we've met Mark. I think he's definitely going to speak about that. I have no questions in my mind that Peter Schiff is going to speak about that as well. So it's one discussion. Like, for how long can that go? I mean, for how long will moral hazard, in essence, be able to propel asset prices and help them stay decoupled from economic reality? But on the other thing, we mostly here we're traders, so it's one thing having in mind what's the fundamental backdrop of everything, and a second thing to see how you can profit from the markets. And fighting for fundamental reasons the markets is usually not a smart game, right?
Yes, that's
well,
correct.
the art of this game, Steve, is not if, it's when.
When, yes.
It's always the when. The timing is
it's
everything.
the timing, because many people had absolutely the right ideas very frequently, and they ended up losing money before their prognosis of what's happening in the markets became a realization, right? So that's always a very, very tricky part.
Guys, I just want to ask you guys something. With the Fed meeting today in the presser with Powell, is there anything that Powell could say to surprise the market? I found out yesterday the huge rally we had in corporates and junk bonds.
Mm-hmm.
You know how many the Fed has already bought to drive up the prices like it did?
A lot of them.
Zero. Zero in. Okay, zero in.
A lot of promises have been made, and the Fed has already built.
Look at the impact from not even buying one junk bond or one corporate bond. They just said they're going to.
Yeah, but don't forget they made something else as well. They made them eligible for to be used as collateral, and in many cases, I mean, so that's that's in essence as potent as saying I'm going to be buying them, right?
Yeah, that's a good point, actually. I'm personally just worried with everybody effectively expecting a V-shaped recovery. And there's only a few voices who say the opposite. Like today, we had the German, there's an economic institute, DIW. They said there's a looming recession that will be deeper than the one in 2008. I think that's probably an exaggeration, but it's a possibility. So whenever we discount this scenario, it's being discounted, in terms of probability, it's being treated as being close to zero, which I really, really disagree with. Okay, we have 30 seconds.
Okay, go ahead.
We have 30 seconds for GDP data. I just brought DataFlash. DataFlash is part of the Forex Analytics service. It's an excellent tool. Believe it or not, it's as fast as Bloomberg, or it might lag on occasion, like, a couple of milliseconds, but, bottom line, it's that fast. So, let's see what we get. I doubt that the market is going to I think that the market might cheer a better than expected reading. I doubt that it's going to sell off because of a bad reading, because they will immediately mention it as priced in. But let's see what we get.
It's late.
Still waiting for the data. It's a
Yeah.
little
Where do
bit
you get a
delayed.
haircut during a pandemic?
My wife, as simple as that. But my haircuts are always quite
I'm
easy
talking
to
about
make.
me.
Still, the data haven't come out, actually. I also have live squawk in my ears, so trust me, it's not out yet.
Stocks are rallying hard, so maybe it must be a good number.
Yeah, but as I said, I do expect that we might have a rally with good data, and I think that the market is going to dismiss bad data. You know how it is. When the market is bullish, it's easy for it to dismiss bad news and to lean on good news. Still no data out now.
I just saw actually a headline that Gilead, however you pronounce that name, they are halted with the pending news. So this
have been halted. I say it as well.
Might be the reason
have been
why
halted in pre-market trading.
Yeah.
Okay.
Yeah. So and news from this company can only probably be good news, right? Because they're actively trying to find a vaccine.
Yes.
Who is it? Gilead?
Gilead. Yeah. Is that how you say it? Yeah.
Yeah.
Okay. Gilead, yeah. Anyway, okay, we still wait for the numbers.
Still stuck waiting for the numbers. The numbers are not out yet. I keep hearing the squawk in my ears saying that we're still in standby for the data. No idea why it's already delayed by 1.5 minutes.
Yeah. Okay. Well, we can get that whenever it's out. No.
People buy headlines today, sell newspapers tomorrow anyway.
Well, that's a good point, Dale. You must have a plan. Oh, there we go. Is that positive?
Yeah.
I see positive 4.8.
Up 4.8.
It can't be. There must be something wrong with that. Typo.
This makes no sense. This is the best reading we've had in years, which totally makes no sense.
Maybe there's a negative sign missing. I don't know. And also the revision also 4.8. Well, I mean, anyway, okay.
Something is wrong here.
Yeah. Let's not be hasty with this. Okay. Adam Button is saying Gilead drug is successful.
No, Stelio, I just...
Okay.
No, that's from Data Flash as well, so I don't have a second confirmation.
Fine.
Okay. Yeah, the data is running late via Bloomberg as well.
Yeah, so that might not... I mean, something is really wrong with data today. What's up?
Yeah.
Oh, I hear from the squad conflicting data for GDP. Some erroneous data coming through, I hear from Squawk. So there is something, they've messed up something with data, as it seems, from government, most likely.
It looks like stocks are rallying on the back of the
erroneous data, perhaps, because that would make
in terms of the vaccine, I think that's
perhaps of an announcement.
Yeah, we took out yesterday's high. Now the market's in a position to
minus 4.8 now.
Negative 4.8.
Minus 4.8. So they fixed it. Yeah. So
yeah. Okay.
So the number was correct, but it was probably it was erroneous data initially announced. And we had that huge delay. I've never actually seen that. I don't remember seeing that before in such a big announcement, whatever. Anyhow, they did that as well. So.
I never saw minus $38 crude either. And who has traded a pandemic before? I'm not that old.
Nobody that's alive to talk about it, Dale. I can tell you that much.
Yeah.
Okay.
Well,
so
that was interesting.
Speaking of indices, we're almost at a key resistance area now. I'm going to speak about the S&P because we do know that the S&P is the barometer for risk assets. Okay, so the S&P is almost at the confluence of the 61.8% fib, and a little bit lower. We tagged both yesterday and today equality of the two legs higher. This first leg higher with the second leg higher. So we're definitely entering an area of resistance. Now, people are still getting squeezed. There's no question about it. For those of you that are daily listenings on, Face, you know that I was long until 28.55. I reversed my position there just a quarter, and I'm looking to build a short position because I do believe that the market is overdone. Keep in mind, we've said that before. We might not be at all-time highs, but with earning estimates being downgraded by the day, probably price to earnings ratios at our all-time highs, which means that we still, yeah, I just got confirmation that it's minus 4.8, by the way. Sorry, that's why I paused. Previous 2.1%, minus 4.8. So that is confirmed for first quarter. So first quarter GDP was weaker than expected. And keep in mind, Stelios mentioned it before, unquestionably the biggest hit in GDP is going to show in second quarter data. So if first quarter was affected that much, keep in mind that second quarter is definitely going to be a lot worse, which officially means that we have a recession. I mean, the definition of a recession is 2 consecutive quarters of negative GDP growth. I think with the first one being quite negative, there is absolutely no question that the second one is going to be negative, and it's going to be a lot more negative. So we officially have a recession after so many years. Of course, now the question is for how long will this play out? I think perhaps longer than most expect. Central banks can't, they're not omnipotent. They can't really do everything. They definitely can help, but up to an extent. So risk assets reaching a resistance area, I would start being very, very careful here, because even if we assume that we've already found the lows and we assume that that was the low, I still think that a decent pullback with areas like 2650, 2680, 2730 being interesting areas of support. So, I think that during the first pullback that we're going to see, we're going to get a better idea of, where we stand, if we've already seen or not the low. Until that happens, as I said, for the, in the short term, we're really overdone. So, at least looking lower temporarily is probably the place to be. I know that we don't have a lot of questions today because the audience is mostly for the event. I already see Mark has logged in. He is up in 20 minutes. So I'm going to cover, a couple of the majors, or if we have any questions. And then I'm assuming that we should get Gregor with us. Also, we're going to have Joe with us. So speaking of the majors, I still see, a period of consolidation here in the Euro USD. So not much to see here in the same, actually the opposite applies to the DXY. I mean, still a period of consolidation, opposite direction. Obviously, you can see it here, probably a rectangle. So I wouldn't be expecting that much from the dollar yet. In the short to medium term, I would still be looking to the upper side for a bullish breakout, especially if we see risk sour. I do think that we're going to see another leg higher for the US dollar, but I would be very bearish following that period. Now, having to do with some of the assets, and then I think we have Gregor with us, so I'm gonna
Yes,
pass the
he's
screen
here.
to him. Okay,
He's here,
perfect. Gold is still holding very nicely. I mean, testing multi-year highs. Keep in mind that gold might be at the 78.6% fib against the dollar, but that hasn't stopped gold from being at all-time highs against the vast majority of the currencies, in essence, being in a bull market unquestionably. So, once we see the dollar move lower, I think that it's a matter of time to see gold at all-time highs against the dollar as well. Having to do with crude, we've pinpointed several times the several divergences between similar assets. I mean, crude oil stocks are posting higher lows, while this is a continuous, by the way, while crude is still moving lower. Natural gas is also posting higher lows. I think that it's a matter of time for crude to actually find the bottom. And keep in mind, when that happens, you might see crude really explode to the upside. So I would be very, very careful trying to chase this to the downside. I know that it's hard being long crude, through futures because of the super contango that we currently have. But there are other ways that you can express your bullishness in crude. Gregor.
Yes.
There you go. My favorite Eliotician on the whole planet.
How are you?
I'm good, mate. How have you been?
Very good. Excited for today's event for sure.
Indeed, indeed. I'm excited for every single guest that we have. I'm excited that the first guest is going to be Mark, which I consider kind of a friend. He's an excellent guy, and looking forward to having him on. But not before you give us your outlook for what comes ahead. For those that don't know, Elliott Waves is an excellent methodology, technical analysis methodology that actually gives you quite a nice outlook into the future. So Grega, go ahead.
Especially, Steve, if the practitioner is the wizard of waves.
That's very true.
Which is what Grega is in my book.
Grega, grab the screen and show us what you see and tell us what you think is happening.
Okay, so for today, I prepared some of the most interesting charts and structures that we currently see in the markets. So what I see is very interesting is definitely Aussie dollar. I mean, we have seen a very strong decline during March, but as you can see here, across with Aussie across different or compared to different currencies, it bounced very, very nicely. And actually looking here at the daily chart, okay, you can clearly count 5 waves from the lows, right? So I assume that even if this would be just a temporary low, there will be more upside after a pullback. So I would expect that we will see a pullback when the stock market will also turn to the downside from the near-term resistance levels, and I will show you those charts in the second as well. And the resistance for Aussie that I would keep an eye on in the short term is here at this March 09 highs. It's the same date when also stocks fell significantly, and there you will see in this date there was a gap on stock market that is now trying to be filled. So after that move up, I think that we will experience a corrective retracement, and those corrections can be opportunity to join the uptrend. The first support that I would pay attention on is definitely here at this former wave 4, and then you have this wave 1 swing high as well. Sometimes when this wave 4 swing support is broken decisively, not by 3 waves, but rather with 5 waves, then watch out for the next support at this wave 2 level, okay? Also, I think that it's very important when you're looking at Aussie, look at dollar Chinese yuan. And what I see here is that on the 4-hour chart, okay, we have a very clear shorter term structure. It's pointing that we may see more upside. And if this dollar against Chinese yuan will rise, then in my opinion, we could easily see this corrective setback here on Aussie dollar. So we'll see how this will unfold. But at the moment, it looks like that this dollar Chinese yuan could really push to the upside. At the same time, Aussie dollar will definitely find some resistance. At the same time, as I said, watch out the stock market. Okay,
Grega, when you zoomed out, I saw that you want to take it like one day at a time, 1 week at a time. I totally understand that.
Yeah.
So you're still projecting that this pullback in the Aussie, and I'm assuming that's your viewpoint for the rest of the risk assets as well, that might be corrective, but your intuition tells you that that's going to be a correction in a bigger correction unfolding higher, or perhaps a complete trend change. So in essence, do you think we've seen the lows in the Aussie, or that's a temporary low?
Well, I definitely have to respect the fib levels where the market actually stopped down there, okay? I have been looking for a move towards into this fib zone for a while, and not only that we have seen a retracement for the fib zone, but also away from this Elliott wave channel where you connect end of a wave 2, end of a wave 4, and then you put this parallel trend line at the end of wave 1. And you can see that this was actually a perfect match down there. So I really think that we should respect what the market could be doing here on a longer term chart as well. But as you know me, I always try to go step by step. I will not say that we go impulsively higher back to these 2011 highs. I will be a little bit more careful, and I would just for now track at least 3 wave recovery. But if we get a major break above this channel with major 5 wave rally, then clearly I will stay on the bullish track.
So if the next move higher after a correction unfolds in an impulsive way, then you're going to be looking perhaps for that being a wave 3 in a much bigger recovery, right?
Yes, exactly. Exactly. The key is when you see a 5-wave movement, if you see a 5-wave movement all the way back to this wave 4, then you know that there will be much more upside available. But if you see only a 3-wave move up into wave 4, then you know that this wave 4 can represent
That's
very important.
quite an aggressive target, right? What is that? 88, 82 cents in the Aussie? What is it?
Yes, 82 around.
Yeah, that would be quite an aggressive move. I bet, a lot of people would be caught on the, in the wrong side of the market, if that happens.
Yeah. So as I mentioned, let's go to see the S&P 500.
Mm-hmm.
I mean, it's perfect date today because of this event and also because of the structure that I see at the moment on the S&P 500. Firstly, let's go to this monthly chart. Okay. As you know, stocks, especially the US stocks, really love to make flat correction. And flat corrections are those that are frustrating for a lot of traders and investors because you experience the failure breakouts. And
whipsawing.
yes,
what we call whipsawing. Yeah.
So the one that was a very nice and failure breakout break at the highs was here back in 2007 and then obviously at 2009 lows. And this was a very nice example how stock market is really falling sharply whenever we have moved to the downsides. It's a very aggressive decline and obviously there is too much fear involved to stay in the bigger picture, to stay in the trend. So that's why our people become nervous and they will sell their stocks. And that's exactly the timing when the opposite will happen. Okay. So what I see at the moment on these lower time frame charts from this potential wave C low is that we have 5 waves up. Okay. Here's the 4-hour chart. And there you have waves 1, 2, 3. You have here a triangle in wave 4, and then you have a wave 5. And this wave 5 will ideally fill this gap, as I mentioned earlier, with Aussie at March 09 level. Okay, because gaps can, when they are filled, of course, new orders are executed, flows will change, and that's when you may experience a potential new reversal. Ideally, we will see after that a 3-wave retracement. So I'm thinking that this 3-wave retracement, whenever it will unfold, it can be very, very interesting for potential opportunity on the upside. Even if I'm wrong, this on the ABC flat correction, and let's say that we have here wave B rise and we'll see another drop for a wave C. This wave B is also corrective flag. And for those who are not familiar with the Elliott waves, corrections always unfolds in minimum 3 waves, right? So even if I'm tracking this potential wave B rise, there will still be more upside coming after this pullback here on a daily chart. Okay, so I think that this can be a very nice opportunity, and at the same time, Aussie dollar obviously could make a very similar moves. Also, let me just a second. Let me look at this chart. Okay, it's actually put call ratio. It's now at the upper side of this range. Okay, and I have here, this is actually, I have here an inverted put call ratio. Okay, and what you can see is that we are moving it into some extreme levels. Okay, meaning that
in a very quick time. I mean, from extremely, oversold.
Yes, exactly, to extremely overbought. And this is much better visible if you will add moving average to your put call ratio. But keep in mind that this is inverted just to
to match it. Yeah,
the correlation, obviously.
Yeah.
Yes. The next market I want to take a look at is the 10-year US note. Okay, so we said that the S&P 500 could potentially move into a correction. And when this may happen? Well, I would say that this may happen when the 10-year US notes makes a final push to a new high. I think this is not far away. What I see here is very nice looking triangle. We know that market is now very slow here on the 10-year US notes because of the latest policy decisions. But still, I think that there can be a final break to the upside. Ideally, this will be a 5th wave. And whenever this happens, Okay, that's when this fifth wave will get underway. That's when yields will come lower. At the same time, the S&P 500 could face resistance, including Aussie dollar as well. Okay.
Yeah, and it seems about ready to break. I mean, we're running out of space here. I mean, it has contracted,
yes, exactly.
it has cooled
and
enough.
Yeah. And at the same time, we are not far away from that resistance on the S&P 500, right? So in my opinion, this is now perfect timing. And I really love the markets when I see that everything
aligns
coming together. But after we have this completion of these 5 waves here, okay, that's when actually stock market could again look for potential support, and ideally after those ABC setback. And this can be a very interesting opportunity, I think, for more upside.
Grega, I have a lot of requests for gold, and it's not a surprise, I know. I don't know if it's part of what you've prepared, but I'm pretty sure a lot of people want to hear your opinion on crude oil and gold.
Okay. So you said gold, right?
Yeah, and crude.
Gold and crude. Okay. So I have been looking for this resistance that we are currently trading already 3 months back. We are still at this resistance. So I definitely will not change my bias at this stage. I still think it's worth to be aware of potential pullback. Even if you want to be on the long side, you either wait on this pullback on gold to happen, or you just look at silver because it's at much better price and the fundamentals are obviously very strong for metals in general. And I would not be surprised if in upcoming months, because sentiment is very bullish on gold, and I would not be surprised if the opposite will happen. Even if just short term, I think that we may see pullback back towards 1500 or so. If this will happen in 3 waves and we will see a bounce from those supports, then obviously the uptrend will resume. But if drop would be in 5 waves, then you know that something much bigger is coming to the downside. So fundamentals, as I said, yes, they are strong, but resistance here also can be very strong because we are at some very key levels. Okay, but if you want to play on the long side metals, as I said, rather look at silver because it's much better. Maybe at the end, silver will outperform gold very quickly.
And the gold-silver ratio is, has exploded to unprecedented levels during the past, few months.
Yes, exactly.
And at some point it should pull back as well. So, that should definitely help silver against gold.
Okay, you mentioned crude.
Yeah, everybody is focusing now on crude. I mean, with what happened with the previous contract that went to minus 37 or whatever.
So I'm not sure if this contract will also move into negative zone. I think that as soon as this coronavirus lockdown is done globally, I think that crude oil may recover, but it may take some time, to really see crude stabilizing. I'm looking at 2 different wave counts on a longer time charts. The first one is that we have here potential diagonal formation. We are now at the lower side of this pattern with a throw over formation. So if we can rally and see a weekly close above 27, then I think that we can go all the way towards 40, maybe even $50 per barrel. Okay.
Yeah, but imagine from a percentage standpoint what kind of a move that is, right?
Yes.
I mean, going from like teens to like 40 or 50.
Yeah, so you have to be very careful if you want to trade. Crude oil investments are now much better, but the question is how to invest. I think that maybe look at some energy stocks, the major ones, and maybe rather try to look for opportunities there. Now, I also have another wave count, which I think it's maybe even more interesting, okay? It's potential ABC drop, and you have here 5 subwaves already in wave C, triggering some very interesting levels touching from 1998. And this is different wave count, but same idea.
Same direction. Yeah.
Yes, I think that crude oil will be trading much higher by the end of the year. Of course, we should be looking also what will happen with dollar in general till then, but actually now it looks like that crude oil is somehow its own story. So we may not look at those markets like a tick by tick.
Yeah, because I mean, we know it has happened in the past. There's nobody saying that at the same time crude and dollar can't be moving higher. I mean, obviously, if dollar is moving lower, crude can move more to the upside priced in
Yeah, I
dollars.
mean,
There's no question about it. But
yes, it was the same story with gold, right?
yes, we saw a long period of time that gold and the dollar were moving in the same direction, which was upwards. Yeah.
Yeah. Okay, so also we can maybe touch Bitcoin. Okay.
Go ahead, be my guest. And you know something, that's a nice segue. I guess we'll have Joe with us tomorrow because Bitcoin is going to be a nice segue. I know that Mark, despite being a traditional money manager, with a successful career for many decades, he's definitely a fan of cryptocurrencies. He believes that, they're part of what's coming in the future. So I think
Like you do.
you know that he's joking. He knows I'm a lot more skeptical.
Yeah.
But I've seen a lot of things in life, so I mean, might
Oh,
happen.
you're a young guy.
Yeah.
You haven't seen nothing yet.
Yeah. Okay.
Greg.
Yeah. In comparison to you, I mean, you were running
Well,
the floor in the
that's what I mean.
70s.
Oh,
Yeah.
hold on. Let me get my left leg out of the tar pit. So, Wizard, what do you want to wrap it with, buddy?
Yeah, so we have Bitcoin here. I mean, we have seen a very strong drop here in March. It was the same time of this drop when stocks also moved to the downside because no one did not want to hold Bitcoins if you want to sell your stocks, okay, during fear and what was going on back in March. Obviously, you also wanted to sell your Bitcoin because in Bitcoin itself, it's already much more speculative than stocks, obviously. But still, we have a very nice move to the upside here, right? We have potential 5 waves up. Waves 1, 2, you have here also 5 subwaves within wave 3. You have wave 4 pullback, and now you have 5th wave. The first projections for this 5th wave is right here at this swing high around 8,000. Then you have the second also very important level from 9,000 up to 10,000. Okay, so I'm thinking that Bitcoin is going to see more upside, but opportunities will come after a major retracement.
Pullback
here.
following that. Yeah.
Also, watch out what is happening in technology sector. I have here AMD, okay? And as you can see, these are moving perfectly together, right? They're both moving to the upside. And here we have a very nice 5 waves in the making. So if stocks which have 5 waves up with the NASDAQ as well, then I think that Bitcoin will also see more upside after pullback.
And you know something, Greg?
What an interesting correlation.
I think
only you could find that.
I think you've set the table for a very interesting question for Mark, and that's one of the things I would want to ask him anyhow, which is the following. A lot of the cryptocurrency funds have been in essence touting that cryptocurrencies are uncorrelated to other assets. But as we expected when we got the big sell-off down in stocks, cryptocurrencies sold off with it, and now you're showing an excellent correlation between the NASDAQ, in essence, and Bitcoin. So, I mean, without making it part of doubting what's going to happen with cryptocurrencies, I think that's evidence enough to at least doubt the theory that cryptocurrencies are so much uncorrelated as an asset class, right?
Yeah, yes. I mean, a lot of investors, traders expected actually that Bitcoin will be trading much higher in March when this Corona shock occurred, but obviously that was not the
During
case.
a liquidity crisis, my friends, people will sell even the kitchen sink to raise cash.
And something tells me that they will first sell their Bitcoins before they sell their kitchen sink, coach.
I don't know. It's a tie.
Okay. It's nice to say that, first of all, thank you very much, Grega. Grega is part of Forex Analytics. Grega's
Thank you,
analysis is at your hands, along with, we are a team of 9 traders, right? So all of our analysis is at your hands if you are a member of Forex Analytics. And Coach, I think we should welcome Mark.
Okay, well, to start off the summit, we have a real trailblazer, and you know you have to be a trailblazer to get to the top of any mountain, any summit. So Mark Yusko is going to start us off today, and he's the CEO of Morgan Creek Capital Management. And the topic that Mark is going to be covering is King Dollar could be dethroned. How close are we to a Bretton Woods moment? Welcome to the summit, Mark. Thank you so much for taking time out of your day to be with us.
Thanks, Dale. Thanks for having me. Hey, Steve. How's everybody
Hey,
doing?
Mark. I'm good. How have you been? Nice to see you here.
Great to have you.
Good.
So Mark, you know, we've been talking for a while, and you know, your take on what's been happening in the financial markets was basically a move away from the dollar. I know you've been very constructive on Asia. You're a China bull, so what a great topic. In fact, what was the year, Mark, of Bretton Woods? What year was that?
44, right? 1944?
1944, and when we came off it during Nixon.
August, if I remember right, August of 71.
1971, yeah.
Yeah, I think it was
Okay.
August.
Okay, so you know what? I was a freshman in college. That's how long ago it was. And, you know, I had no idea that we had come off, you know, any kind of metal standard. And I do remember, though, there were these buttons called WIN, Whip Inflation Now. You're younger than me. Do you remember that era at all, Mark?
Absolutely. I'm not that much
Okay,
younger.
so
I'm younger, but not that.
yeah, I know. So, you know, who isn't? And so this is going to be a great topic because, you know, there's been a lot of talk about, and I'm sure the world's looking at what we're doing in this rescue package of, because we are the reserve currency, having the advantage of being able to print trillions and come up with trillions for this and that. It's almost real money now. And I'm sure there are many people saying, well, you know, do we want to hold this kind of paper? So without further ado, Mark, why don't you tell us what you're thinking in here about the possibility of another Bretton Woods moment?
All right, sounds good. Do you guys want me to use video or just audio?
Well,
Absolutely,
yeah,
Mark. It's our
yeah.
pleasure if you want to share your camera. Absolutely.
Yeah.
It's just, I think you guys have to...
Yeah. My mistake. That's my mistake.
It.
There you go.
I'm perfectly happy for no one to see
There you go.
this-
Sorry, my mistake.
this
Okay.
face. But all right.
All right,
now
there's
we got it.
There
Mark.
you go. Nice
All
to
right,
see you.
Good morning, everybody.
Good morning.
All right. So what I'm going to try to do, and I'm not sure if this is going to work, but let's see. I'm going to try to share screen.
Beautiful.
Oh, look
You
at
got
that.
it.
Did work.
Beautiful.
So what I'm going to do is I'm going to go through some slides that kind of lay the groundwork for the conversation, and then we can take questions as you guys have them. But I like these quotes on just doing this generally, right? Making predictions is hard, especially about the future. Financial markets are generally unpredictable, and so to actually predict makes less sense than going through scenarios. And I thought you guys were doing a good job of that before we started here, talking about different scenarios and looking at the way the market might react. One thing that I really try to focus on generally is this idea that markets are in a constant state of uncertainty and flux, and you make your money by discounting the obvious and betting on the unexpected, so betting on surprises. And then Lao Tzu, I think, is my favorite. Those who have knowledge don't predict. Those who predict don't have knowledge. So we'll see which ones you guys think I am as we get going here. So when we think about this idea of global reserve currencies, for many, many years, right, for hundreds of years, that global reserve currency was created or given to the country with the best navy, the fastest ships. And you go all the way back to Portugal. I mean, who would think that Portugal had the world reserve currency? But they had the tallest trees, therefore they had the fastest ships. And then they got taken over by Spain. So they had the tallest trees, fastest ships. Then the Netherlands took over, then France, then the UK got the steamship, and they became the most powerful until America got nuclear power and the nuclear subs and aircraft carriers and all that good stuff. So here we are today. And what I love about this chart is it says in 2030, which is actually only a decade away, the U.S. loses world reserve currency status, and we end up with this global, and I think it's interesting that it goes global, and we'll get to why I think part of that will be about Bitcoin, and we'll get to that here in a little bit. So if you think about money, when we think about trading money, one of the things that's interesting is if you put all the money into perspective, all the money in the world, 86 trillion, again with a T, then you got physical money, about 31 trillion. And then gold at 8 trillion. Now, this is interesting. Gold actually is the biggest currency. Now, not all of that 8 trillion is monetary. It's probably about 2 trillion. And, the U.S. dollar is only about 1.5 trillion. So even though people think of the dollar as being king, it's really gold when it comes to currencies. Now, king dollar does have the highest exchange traded volume in terms of the amount of money that's held in reserves around the world. But what's interesting on the right-hand side is the renminbi now is part of the IMF SDR. And that's really important when people think about, global supremacy and who's going to win in terms of this global currency regime that we're in. So I talk about these surprises, and one of my surprises was that, despite the fact that the Fed kept calling it not QE, now they are calling it QE again, and they've bought more in the past 4 weeks than they did in all of QE1. The problem is that interest rates that everybody thinks have to go back up keep going down. Now, why do they keep going down? It's the chart on the left that talks about this chart of truth or line of truth, that every time interest rates in the U.S. get to this line of truth that's been declining for 30 years, we have a breakdown. And that happened back in 2018. Coming into this year, we had this big wedge on the left-hand side that basically told us that long bonds were looking more attractive than stocks. Now, long bonds have outperformed stocks this year pretty dramatically, up quite nicely versus down. So 30+% increase. Now, what I think is really interesting is how, actually, I'm sorry, the last chart was since 2018 when this all started. Really this year, look at the 30-year treasury on the left-hand side, sub 1%. Now, then you see that big rising line, that spike up. What that was literally is the treasury market broke. Sunday night, sitting at home on Twitter as I usually am at night, and a friend calls up and said, "Hey, you're still up?" I'm like, "Yeah." She says, "Can you talk?" I'm like, "Sure." She says, "I just heard from a friend of mine at Treasury that the Treasury market has broken. Literally, they're not settling trades." And so we went from sub 1%, almost back to 2%, almost overnight.
Never saw that happen before, Mark. This kind of volatility. Yeah.
And look at the trend since, right? And I'll talk about this a lot, is my friend Larry Tentarelli says all the time, nothing good happens below the 200-day moving average. And the surprise in a trend goes in the direction of where you are relative to that 200-day. So the surprises in the treasury market continue to be negative. So we think the interest rate trends continue to be down. We think the bond bears that keep coming out of the woodwork are going to be wrong, and that you should really focus on this long-term trend and move in the, I'm going to move this over to the other side for a second, and that, even the long bond here, the 30-year as well as the 10-year, we think is going to continue to be a good place to invest. All right. So surprise number 2 was that we would have a recession. And as of this morning, we are definitely in recession in the U.S. And it has to do with these 4 horsemen. And it really goes down to what I call the killer Ds. So demographics, every day 10,000 people turn 65, both in the US and in Europe. And what that means is this global tidal wave of an aged population. And, it's like the old line, gentlemen prefer bonds. Older people, 65 to 85-year-old people, prefer bonds. And the demand is going to push interest rates globally to NIRP, negative interest rates, all around the world. And it's really because of this problem with debt. So the second killer D is debt. So you got bad demographics and you have too much debt. And we've printed 16 trillion with a T. And again, nobody talks about the trillion word the right way. A trillion is $1 every second for 31,710 years. And so you've got this problem where we've created this illusion of growth, and it's fake growth. I call it fakeonomics. So we've got fake growth created by debt, and that's causing the stress. And everyone talks about the rise of inflation. We're going to have hyperinflation. Well, we have no inflation anywhere except in emerging markets. In places like Venezuela, Zimbabwe, we got hyperinflation. Why? Because they don't have high productivity levels. And when you print money without latent productivity, you get hyperinflation. In the developed world, we have lots of productivity, lots of latent productivity. We got low productivity levels because we got rising bad demographics. And yet we've got deflation everywhere. Japan leads, then Europe, then the United States. And that's going to stay for a while. So copper, we have to watch copper. Dr. Copper is out of ICU, but still on oxygen. On the right-hand side, we have a little rebound in copper. We think it's going to continue to be negative, and particularly when second quarter GDP growth comes out, which can be really bad, could be down 40%.
He was sued last year, Mark, Dr. Copper.
Yeah.
For malpractice for impersonating a bull market.
Oh, that's awesome. I love it. And the second of the four horsemen, so the four horsemen are Dr. Copper, 10-year rates, oil prices, and the Kospi. And 2-year or 10-year rates, we had no idea that it would get this bad this fast, right? That we hit 0.5% on the 10-year. Treasury market broke, as we talked about, but it's still ugly, right? We're pressing down at 0.6% this morning. We're pressing down at those all-time lows, and we think that's going to continue. Oil prices, look, we thought that oil prices would fall as economic weakness went up, but we had no idea, no idea that we'd get negative $37 like we saw at the futures roll the other day. So what's really interesting is the market is not buying, I call him the tweeter-in-chief. The tweeter-in-chief's nonsense about he brokered a deal with Saudi and Russia, clearly just not the case. And even if he did, they don't have the firepower to fix the problem. But it's actually worse than that. Oop, I went too far. Kospi actually does believe in QE. So you can see tech stocks have been rallying quite nicely, and Kospi regained the 50-day on the right-hand side. So that is an interesting development and something that people should at least pay attention to a little bit. Although I think, the sales, Apple has basically said they're not going to ship phones at the end of second quarter, which I think is amazing because there's just no demand. So the other one was we believe that pigs get slaughtered, in the sense that people were sticking around the Fang Man too much. And we warned back in January that it was starting to look just like 2000. You can see March 10th, 2000. We called this, tech bubble 2.0. We thought that things were going to get ugly. Again, we didn't realize how ugly they were going to get in March. What's really wild, on the left-hand side, you can see the red lines going down, which is retail investors actually fled stocks faster than any time in history. And just let that sink in for a second. Worse than 2008, worse than 2000, worse than 74, the biggest sale. And human beings do two things really well. We buy what we wish we would have bought, right? So we're plowing into stocks in January and February. And then we sell what we're about to need. So we sell at the bottom. So we bought at the top, sold at the bottom. Now someone is buying futures. On the right-hand side, we see that spike up in the blue line. That is a crazy, crazy increase in buying of futures. Now, who's doing it? Well, I think we have the answer now, is the Fed used to not be able to buy corporate bonds. They used to not be able to buy high yield bonds. They used to not be able to buy stocks. It was against the law. Well, how did they get around it? Well, they've set up these special purpose vehicles with Treasury. The Treasury issues bonds, and they buy the bonds, and then Treasury does the dirty work. So I think we're seeing this futures volume driving the big cap stocks, which is why we're getting so much concentration in FANG, and you're not getting any follow through in the rest of the market, which is kind of scary. So everything's fine, right?
So Mark, do you believe you are a believer in a plunge protection team, and this is how they're executing?
Absolutely. The plunge protection team is fact, right? It's not conspiracy theory. It's fact. It was created first quarter of 1988. It's called the Council on Economic Stability. It's made up of the Secretary of the Treasury, the head of the Fed, the president of the four biggest banks. At the time, it was Salomon Brothers, JP Morgan, Citi, Solly turned into Citi, Morgan Stanley, and Goldman Sachs.
Okay. So but other than that, the Fed is independent, right?
Oh, of course it's independent. Of course it's independent. And you can see that in the jawboning reaction. Although it's never been independent. It's interesting. Everyone says, oh, Trump's the first one to pick on his Federal Reserve chairman and make him do what he wanted. No, Nixon did it, and Johnson did it, and everybody did it.
Yeah.
So you just have to be old enough, again, like us, Dale, to have seen the history. So what I think is really interesting and scary at the same time is these 5 stocks, right? Facebook, Amazon, Apple, Microsoft, and Google are now the majority of the market. In fact, it really should be renamed the Fab 5 or the S&P 5. And we have a concentration risk on the right-hand side that we've never seen, right? The Fab 4, Microsoft, Cisco, Intel, GE, actually Fab 5 back then, they included Walmart. That Fab 5 got up to 18%. We're at 22%, a level, again, that we've just never seen. And when you look at that chart on the right, you'd say to yourself, I've seen that chart somewhere before. Well, it looks exactly like the famous bubble chart. And that's the new paradigm. And then we have the fall, which we did. And then we get a return to normal, the bull trap. And then you get, the fear and capitulation on the other side, and you get the crash. Because it doesn't, you notice you don't go to these levels and then plateau. You peak, and then you spike, and then you fall. And here's something that I just find so frustrating, right? Is people are saying, oh, well, we're back in a bull market. Well, bull markets start from valuations of 40% lower. So you can see the rising green line, that is fair value. The blue line always goes back and touches fair value before a new bull market starts, except this time. So we went down 34%, but now we're only down about 13%. And we've got a long way to go to get to fair value. Expected returns in that green box, basically saying that, at the bottom, we actually had a chance to make some positive returns in stocks over the next 4 years or over the next 10 years. Now we're back to zero. We have expected return for the next 10 years of zero. So look, don't fight the Fed. It's hard to argue with this chart. You guys are much better on charts than I am, but the only negative I would see on here is the 50-day, looking towards a death cross, but people say death crosses don't matter. I would say that maybe you could say there's a little bit of an attempt at a shooting star on the far right, but we'll see, or a double top or whatever you want to call them. Although I don't think double tops is even a thing, right? It's double bottoms. Make volatility great again. This is one of my favorites. We thought volatility was the cheapest asset class on the planet coming into this year. Nobody wanted to own it. Everyone was selling vol. And this is a really important chart. Now, people think I'm crazy when I start talking about this stuff, but this is a guy, W.D. Gann. He was a forecaster and trader back at the turn of the century. And he had found this book by Samuel Benner that Benner wrote in 1860s about commodity trading. And Benner laid out the chart on the bottom, basically predicting every market peak and market trough for the next 150 years. Now, this was done, remember, in the 1800s, published in 1901. This guy was pretty freaking good, right? He got the top in 29. He got the top in 37. He got the top in 73. He got the top in 91. He got the top in 2000. And he was saying that 2018 was the next top, and that now this year, 2020, would be a panic year. One might argue that we had some panic. And what's really interesting is he says you also have to watch for these lunar days around March 21st, June 22nd, September 22nd, December 22nd. The big change off the bottom was literally on March 23rd, right near March 21st. So really interesting how patterns repeat, and it's because human beings are driven by these cycles.
We have
So
one coming up, Mark, I believe early May, a
Yes.
supermoon.
Yep, exactly.
First week of May.
Well, here's a crazy stat. You guys will love this. So over the last 100 years, if you bought and held, you made about 23 times your money. But if you bought the new moon and sold the full moon, so you're only invested half the time, you're invested for 2 weeks out of every month, you actually made 14 times more, not 14% more, but 14x more. Pretty interesting. So volatility was really, really compressed coming into this year. In fact, it reached levels of contraction that we had never seen in history. Anytime you're using words like never and ever, it's usually pretty bad. And there was no volatility anywhere. And we said, look, when there's no volatility anywhere, when it arises, it will get ugly. And what was really concerning, and you guys, again, follow this more than I do, but if you look on the right-hand side, the futures market in VIX, in volatility, really was worried about this election. So you can see that volatility was really low on the front month, but out 10, 11 months, it was all the way at 20 back in January. So the fact that we went to 80 something, all right, and we had a record volatility smash, right? 23 days, plus or minus 3% over the past 7 weeks. Now it's so funny. Everybody's looking at the green lines. You can see the green lines. Everybody's saying, oh, well, this is a bottom because the last 2 times we had this kind of volatility in October 32 and November 08, we had big equity rallies. Well, why are they ignoring the 2 red lines on the far left? That seems odd to me because that was in 29 and 30. And I'll argue we're right in the middle of 1930 and it's about to get really ugly. So
Mark, can I just interject for a second? Before the coronavirus, we were already in a manufacturing recession. And people seem to forget that, right?
Yep.
And so now because you can blame everything on the lockdown, but we're already having problems with manufacturing. The consumer was holding up this economy, 70% to 90%, some people say, of the economy. How can the consumer recover from this?
Well, I mean, they can't.
That's what I thought.
They can't, right? Now, what's interesting is some of them can, right? Those of us on a salary, okay, we can. Now, even we on a salary aren't spending as much as we were because, we can't go out to eat as much or ever at all.
Or want to go.
The want is going to be, but even the want is going to be a problem. So a friend of mine's in the restaurant biz, and he was just informed by the governor that when he's allowed to reopen, I think in 3 weeks, 2 weeks maybe, he's only allowed to have 25% of capacity.
Yeah. And
then it phases to 50 and then 75, but he's not going to get back to full capacity for a very long time. Now, the problem is at 25% of capacity, he's done, right? He'll be out of business. And that's going to be true of many, many restaurants. Right. And so we're killing off businesses, particularly retail businesses, for what looks like dubious reasons. And we don't need to go into the whole conspiracy theory, but actually I don't even think it's conspiracy.
And then you have things like the LA Lakers getting loans that were meant for different types of organizations. I don't think NBA teams needed this emergency loan.
Look, the graft and corruption in the doling out of trillions of dollars is really crazy. Look, there's no reason you would fire the inspector general that was to oversee the handing out of the money unless you were planning on doing bad stuff, right? You don't fire the guy who's looking it over. So Bad stuff's going to happen. It's already happening, and we're seeing that. Dale, to your point, here's an interesting chart that goes exactly to your point is not only have we been kind of in this recession that people don't like to talk about, but the market's been dead money for 2 years, right? We had Volmageddon back in January, February of 2018. Then we had the Khashoggi crash, and now we've got the Corona crash. And, I think as people think about, where we are, they're going to start to get a little more nervous. And there is a way to protect yourself, right? You can buy these things, VXX and TVIX, whether you want to be unlevered or levered. And, back in first quarter 18, you made a lot of money when the market was down. Fourth quarter 2018, you made a lot of money when the market went down. But this time, it was unbelievable, right? VXX up 360%, with the S&P down 30, and TVIX up 1,450%. Now, I wouldn't buy them here, which I wanted to talk about. It's not quite time to reload VXX and TVIX, but the risk reward is rising every day. And that little doji yesterday is kind of got me maybe starting to be interested. I'd love to see a nice hammer here, but at least there's some chance that the risk reward is getting better to buy VIX. So let's get back to currencies. Look, wars have no winners. Currency wars are a bad idea. Now, the dollar, back to Steve's point, since 1971 has been in secular decline. We went off the gold standard, went on the oil standard, de facto oil standard. We cut a deal with Saudi and said, we'll protect you as long as you price all global oil transactions in dollars. So we went off the gold standard, onto the oil standard, because you have to be backed by something in order to be global world reserve currency. Now, the problem is that everyone wants to believe that the dollar is going to be strong. Now, it's only strong because the other big currencies are getting destroyed. So, Lagarde has picked up right where, Draghi, whatever it takes, has done. And so she's now destroyed the euro even more. Kuroda-san, right, he just laughs about it, right? He only has one job, which is to weaken the yen. So he presses control print every single day. So back to this issue of where are the currencies. Again, look at the renminbi quietly sneaking up on the Eurozone and eventually going to overtake the dollar, I think, for one of global reserve currencies. So we're in a currency war. That's a bad thing. Probably is going to make the financial crisis worse because countries are at war. This is another important thing that people don't talk about is if we called sanctions, right, starving kids, it would sound a lot less good. And we've weaponized the U.S. dollar in order to, propagate certain geopolitical ideals, and that's interesting. So how do you win a currency war? You swap paper for sound money. Now, what's sound money? Well, gold has been sound money for 5,000 years, and that's been the most sound money. But I'll argue Bitcoin as digital gold is going to be for the next 5,000 years. But you can see Russia and China have been accumulating gold and giving us back our paper, and that's how you win the war. So WEF said that digital currencies could end the global currency wars. And I hate to quote Ricky Bobby, but if you ain't first, you're last. So whoever is first in creating a digital currency is going to win this war, and it's going to be China. So fundamentals are good for this secular dollar downtrend. Elliott Wave says that dollar's going lower. But look, there are a lot of people on the other side. So Fidelity is on the side of the dollar being weaker, and I didn't draw the triangle on the right-hand side, but that's not a great pattern. Although you could say if it broke out over 103, that would be a good upside. But there are people that think this is the biggest cup and handle in a long time. So I could be convinced that if the dollar DXY could break above 103, that could be interesting. Oil, all shale that ends shale. Look, Saudi Arabia declared war on U.S. oil on March 7th. And how did they do that? They basically said, we're going to force you to stop this madness. So the U.S. shale business had been pouring money into the ground and taking out oil. Now, they were losing their ass. They lost over $650 billion wasted, gone, negative free cash flow. And now the government wants to buy oil companies. That's even stupider. So here's what Saudi did. Saudi said, look, we're going to increase production by 2 million barrels a day because Russia's not complying with the cuts. And
After they got their IPO off, Mark.
Of course, because they're trying to defend it.
Yeah, they first wanted to get Aramco off the door, and then
You find some back holders and then start the war.
No, they are very crafty, because here's what's really scary. They have sent. So not only did they, basically hand off a bomb to anybody who bought the IPO of Aramco, and a lot of them did it on leverage, which is even crazier. So now they're way underwater. But what they've done is they basically sent an oil bomb to the United States. There's 50 million barrels in floating storage coming to U.S. to fill up storage in the U.S., which is why we got the negative prices in last month or this month. So here's the problem. Under $30, basically shale is done. U.S. shale companies go out of business. Demand is not going to fix it because 40% of demand goes into cars and trucks. Cars and trucks aren't driving now. Gasoline demand in the U.S. is down 85%. So we've had the worst oil performance ever, which is kind of crazy. Ever, again, is a bad word. And energy credit spreads have blown out. Now, look, I look at this, WTI chart. Nothing good happens below the 200-day. Now, you could argue that, we just had a hammer thrown down with a nice long wick down to 10-10. Maybe. It is a double bottom, arguably, on lower volume. So maybe that's a good thing. I do think oil is going to go back up. I just think it's going to take time. Energy stocks, on the other hand, look, we didn't think it could get any uglier. It did. It got really, really ugly, but it looks to have made a really nice bottom here and just took the 50-day. So we're actually a little bit bullish on some of the oil stocks. There's still a whole bunch of oil stocks that are going to zero.
Just bought in the morning TOT, so tell me that's one of them.
Yes, exactly. Well, Saudis, buy the ones that the Saudis buy, because they're usually pretty smart. So I'm not going to talk too much about Japan. Japan is good at one thing. They're good at printing money. And it hasn't helped their stock market. The stock market's basically been flat, but man, they are really, really good at printing money. But the problem is the yen, Kuroda-san needs the yen to go down. He needs 115, 120, 125. The problem is the rest of the world still views the yen as a safe haven. I don't get that part, right? Government at 200% debt to GDP. I don't really understand, but I guess there's a lot of people that finance macro trades with yen, and
Mark, I think part of it has to do with the fact that Japan, a lot of its debt is internal. So the rest of the world thinks that their external debt, which isn't that much, they won't have any problems servicing that. Worst case scenario, they think that they might internally restructure, their liabilities.
No, Steve, you're exactly right. And look, they are going to do a debt jubilee, right? The Bank of Japan today owns 54% of Japanese government bonds, 74% of ETFs. At some point, they're going to get to a level of ownership of JGBs where they can just do a debt jubilee and cancel them all. So I think you're right on that. But theoretically, that should trash the yen, but it's not. So I am long-term bearish on the yen, but I would not trade against this trend right here. Draghi was a maniac, right? Do whatever it takes. And as long as he got out, the stock market dead flat, despite all his bond buying, negative interest rates, destroying the banks in Europe, and demographics really bad, turning Japanese. And Lagarde is doing the same thing, right? So I'm just not very bullish on the euro. I think it's headed down, and it's just a race to the bottom, right? All countries have got to devalue their currency to get out of debt.
Mark, do you think that Lagarde was selected because of her experience at the IMF and restructuring of debt to come into the ECB because they saw the possibility of this debt crisis and she has this type of experience?
I think that's a really good insight, Dale, and I think that's probably right. It also is, you needed somebody who literally would do whatever it takes. And we've all seen the great picture of all the world leaders at WEF, and it's all these guys huddled around this one woman. And I mean, she is the queen, right? She is tougher than all of them. And, she is icy when it comes to making those decisions. So I agree that she will do what it takes to get them out of problem. So in China, look, China we think is playing a different game than everybody else. They're playing Go while the U.S. argues about how to set checkerboard. It's because they have a good leader, right? Their leader way better than our leader. He thinks in 30-year increments, and I love that back in the 1990s they had this goal. They wanted to have a harmonious rise, and it sounded so non-threatening. And today, over the next 15 years, they want to have a modern socialism economy. But by 2050, right, they want to be, a global superpower, and they're going to get there. So, when Chinese equities again get to this bottom line on the right-hand side, usually good things happen. They got there. Good things have happened. Emerging markets, we think are actually going to outperform for a while here. Yet the rest of the world doesn't think so. More people sell in emerging markets than U.S. But here's the thing. Since the corona crisis started, Chinese equities are basically back to flat. And that trend on the right-hand side, again, looks really strong. And if we take the 200-day, I could get very, very excited about A shares in China. So remember the golden rule, real assets were very cheap. Money printing is really good for gold. That's not telling anybody on this conference call that doesn't know. But here's an interesting point is the Dow in gold terms was back to the same level as the Great Depression. So we're going to talk about the Great Depression a lot over the next few months. And I think that's kind of where we're headed. Gold line has outperformed equities a lot. And when gold and bonds outperform equities, usually forward equity returns are low. So all this talk about forward equity returns being high, I don't know what they're looking at. So mining stocks are even better. We love the mining stocks, GDX and GDXJ. And again, those.
Yeah, we were talking about this breakout, Mark, and I was always taught that the share should lead the underlying commodity, and they're doing this for the first time in a while.
Yep. And you guys were
breakouts.
talking before I came on about why Bitcoin went down in March and whether it was correlated, and why did gold stocks go down in March? Look, in a liquidation, not a normal bear market, but a true liquidation where margin calls are happening and people are being forced to sell. You don't get to sell what you want to sell. You sell what you have to sell. And that's why everything correlated short term to the downside. So now let's get to Bitcoin. So we're in what I call the fiat fiasco. So it started in 1971 when Nixon took us off the gold standard. The currency has been collapsing ever since. That's why things cost more today in nominal terms, and why people get fooled by nominal increases. So we don't think that Bitcoin itself is so awesome. We think that the fiat is being destroyed against it. So look, we're in a parabolic growth phase for Bitcoin. Why? Because of adoption, right? There are now 3 million people who have more than 0.1 Bitcoin. So that's up every year, every quarter, every month. It just goes up. So adoption is following the S curve on the right-hand side. A parabolic nonlinear regression model predicted, and this was from 2014, predicted that we'd hit $10,000 in 2017 and $100,000 in 2021. We did hit $10,000 in 2017, and we will hit $100,000 in 2021. Why? This is really important. This is called stock to flow. Scarce assets outperform everything else. Gold is the scarcest asset until Bitcoin. As of 2 weeks from now, Bitcoin will become the scarcest asset in the world, meaning
The halving.
its flow, because of the halving, its flow will be lower than the incremental flow of gold onto the stock of existing gold. So Bitcoin becomes a better version of gold. It becomes digital gold. And so it tells us it's on a path. Now, if you overlay the stock to flow model on this parabolic regression, look what you get. You get $100,000 in mid-2021. Pretty interesting. So from a statistical, and unfortunately I didn't update this morning, I should have, but we were at 7,300 a couple days ago. we needed to get past the 200-day at 8,000. We zoomed right through that this morning. We're at, I think, 8150 or 8200. So the fact that we have broken the 200-day from the bottom with authority, I think we are back in a bull market. And look, I think prices could get really, really positive really, really quickly. So Steve, to your question about diversification, why it matters. Look, if you look at the correlation of Bitcoin to stocks and bonds, it's 0.15. It's the lowest correlation asset. And that's not over a week or a day, but over long periods of time, over the past 5-6 years. And if you added 1%, okay, so if you took a 60-40 portfolio and added 1%, your return goes up by about 30%. Your volatility stays the same, so your Sharpe ratio goes up. If you add 5% over the last 5 years, 5% Bitcoin, just take 2.5 points from stocks, 2.5 points from bonds, you actually doubled your return. That's pretty incredible. And it's because of this non-correlation. So there's no question that on Black Thursday back in March, everybody was forced to liquidate their Bitcoin, just like their gold, just like their gold miners. But going forward, we think that low correlation will come back and continue. So that's all I got. And
we have a few questions.
Yeah,
Mark,
first of all, since you finished up with Bitcoin, I don't want to give you some of the counter arguments. I have to tell you, though, that I'm so desperate with the fiat system that we currently have that, I can't exclude any possibility. I mean, cryptocurrencies might actually work. I've asked you in person, so I can now ask you on the webinar. We would love to have you on a live debate with Peter Schiff because
love it.
You have more or less the same ideas about the economy and you see the same type of problems. The main difference being how the two of you see the future unfolding having to do with the monetary system. I mean, he believes we're going to go back to the gold standard. You believe that we're going to evolve to, some type of a cryptocurrency system. So
Bitcoin standard.
Backed by gold, maybe.
Absolutely.
Maybe backed by gold.
And here's the crazy thing. I would love to do it and happy to do it anytime. I think Peter's a good guy. I don't have any ill will or animosity towards him. I think he's wrong about Bitcoin. I think he's been wrong for a long time. And yet, to your point, we're really not that different on most of our other beliefs. So I would love to have that conversation and happy to do it anytime. I know he's going to be on later in the webinar, but if you want to, pull us both together back at some point, I'm happy to do it.
Okay. I'd like to ask this one question from someone who's been following you for a long time, Mark. He goes, "Hi, Mark. I'm an astute follower of your writings and webinars for years, and I had one question that I wanted to ask. You and others have referred to the next recession possibly being severe enough to take us into a Hooverville-type depression, but there were some specific factors that propagated the depression, namely poor fiscal monetary choices by the government at that time. We are not seeing that today. The Fed and Congress have been incredibly stimulative past few months. Doesn't this limit the probability of a longer lasting slowdown like we had in the 30s? If the dollar weakens enough, that should stabilize growth. No?
Look, it's a really important point, and it is true that there have been some things that the government has done that I would argue are antithetical to the 1930s. Unfortunately, I think they've actually done some things that are very, very similar to the 1930s and could exacerbate the problem and make what is a garden variety recession into, as Nouriel likes to call it, the Greater Depression. So I won't argue that the monetary response has been large, but the monetary response was actually reasonably large in the 1930s. They cut interest rates to zero. They started QE. QE was actually invented in the 1930s. It didn't start 10 years ago. So QE, they tried it. Then in 1937, at the depths of the Depression, or towards the end of the Depression, they tried to go off. No, at the depths of the Depression, they tried to go off QE and tried to raise interest rates from 0 to 25
like we
basis
did when
points.
we were doing QT for a while?
Exactly. And they crashed the economy even more. So the other thing that we're doing is this stance on immigration, same as in the 1930s. And then finally the tariffs, right? The Hawley-Smoot tariff bill was what really plunged us into the depths of darkness. Now, on the fiscal side, yeah, they pulled out the bazooka and they put some money that theoretically should be, stimulative. But the problem is, at least at first blush, a lot of that money isn't going to good places. It's going to the wealthy, and the wealthy don't put the money back into the economy. They don't spend it. They save it. They invest it. So that doesn't help. You look at velocity of money. If you look at Lacey Hunt's work from Hoisington.com, velocity of money keeps contracting. And the real problem, and this is the biggest problem, government spending has a negative multiplier effect. So every time the government spends instead of the private marketplace, we get a negative implication on GDP growth. So I actually am not sure that the response by the government, both monetary and fiscal, is going to turn out to be as good as people think. Now, it's possible that I'm wrong and the questioner is right. It's absolutely possible. I just think it's not probable because of all the other bad leadership decisions like tariffs. And let's just look at global trade. Global trade is collapsing, absolutely collapsing. And this response to coronavirus, now we didn't even get into the whole thing of, look, the cure for coronavirus is way worse than the disease. The disease is really not that bad, right? It's a normal viral threat. We've faced viral threats for thousands of years and we're still around. We're going to be around after this one. People tried to call it the plague. Those people should have their tongue cut out, right? The plague killed 42% of the population of the world, 42%. Okay, then they say, well, it's like the Spanish flu. No, Spanish flu killed 3%. COVID is somewhere between 0.002% and 0.003%. It's just not a big threat. And yet we've shut down the global economy for no reason that I can think of. In fact, the challenge is we've actually reduced our ability to create herd immunity, and places like California, which probably had the virus in November, actually built up a lot of herd immunity, and they've got 1/10 the number of cases and fatalities that the East Coast has. So there's no clear evidence that what we did was right. And there's a lot of evidence that says maybe what we did is going to have long-lasting implications and drive us toward that Hooverville outcome.
Well, what we did that was right was having you kick off the summit, Mark. Thank you so
thanks,
much.
Guys. Look, I love being with you. I love your show and the process, and I applaud you and commend you for getting thousands of people to get together on a Wednesday morning and talk markets. So thanks for having me.
And you could find Mark at Morgan Creek Capital Management, at Mark Yusko on Twitter. Thank you so much, Mark. I appreciate you being here and edifying the community during the summit. Take care,
thanks,
my
guys.
friend.
Be well.
Bye-bye,
Enjoy the rest of the day. All right. See ya.
Mark, what a pleasure to have you here today, buddy. Really appreciate you coming here and being part of our summit, and looking forward to your topic, the dollar supercycle and the end of economic primacy. So take it away, brother.
Great. Well, thanks a lot, Dale. Thanks a lot for this opportunity. I got a chance a little bit to work with your team, Joe and Steve, and I'm very impressed. We've got a really first-rate team, and so I look forward to this, and thanks a lot for all the help in setting this up. Maybe the first place to begin, though, before I share my screen, is to really just talk about methodology. Because I spent most of my career on the institutional side. I began my career really on the retail side. That's when we met, I think, Dale, on the floor of the exchange. Yeah. But I spent most of my career really working with institutional investors, largest asset managers, large companies. And I think there's really a difference between institutional and retail. And I think that what I've tried to do with by being on the social media, especially make my blog accessible, is really trying to democratize or help democratize the markets in a sense of bringing institutional knowledge, institutional ways of thinking about things into the retail space. I have a lot of respect for people who are using their own money, not just what I've done my career, helping other people trade their money, but really the people who, a lot of your viewers, a lot of people on the webinar today, using their own money having their own skin in the game to trade and live on their own wits. So I have a lot of respect for that, and that's why I try to help bring these institutional ideas. I think maybe the first place to begin is a lot of us use linear approaches to things, linear relationship between variables. And as I'll show you shortly, I think that things are much more cyclical. And especially when we've been talking about the big dollar cycle. So even though I'm a macro, I focus on the macroeconomics. I have a lot of respect for the price action because this is, I think that the fundamentals don't change as often as the prices do. And the key to making money in the markets is not so much getting it right as really being prudent risk managers. As a head of strategy for different banks over my career, I often, people come to me with trade ideas. And a person who's relatively new to the game will come to me and say that they have a trade idea, they can make $1 million. Someone who's more experienced, who perhaps has more scar tissue, would come to me and say, listen, I have a trade idea, and if I'm wrong, we lose $200,000. One is focusing on the downside, the risk management, and the other focuses on the upside and the sort of the glory, hitting the home run or something like that. So I find I use technicals to help assess and manage risk, because I think that in trading, what I often see is traders, when you look at their track records, make a little money, make a little money, make a little money, lose a lot of money. And so to avoid that, I find the technicals are helpful, even if one does not really believe in the numerology involved and the Fibonacci retracements and other technical schools.
It's the only thing that we can control, right, Mark?
I think so. I mean, I think that it's sort of like in poker, you know, they say you can't really pick the cards you're dealt. You just have to play with what you have. And so, so maybe I should show you this first chart. I think it gets to some of the issues that previous Mark was talking about. There is, I think this is the only picture of the dollar that really matters from a policy-making point of view. And what I will show you shortly, though, is, so this is really, let me just define this for you. This is the real trade-weighted measure of the dollar index. This is not the dollar index that we trade. That dollar index that we trade is not really a dollar index. It's mostly the dollar against a bunch of European currencies. I helped launch that and market for that, dollar index when it's first launched. It's a nice trading vehicle, but it has nothing to do with the real world. For example, our biggest trading partners like Mexico and China are not even in that dollar index. This is what the Federal Reserve uses. This is real, meaning it's adjusted for inflation. It's broad, meaning it includes a lot of U.S. trading partners. And what I brought this chart back to sort of the beginning of the modern era, which is when we got off the Bretton Woods system. So that's in 1971. And you can see on this chart that there's been 3 big dollar rallies we've had since the end of Bretton Woods. The idea that the dollar is in a big downward trend since Bretton Woods is just not true. This chart illustrates the fact that we've had 3 dollar rallies since the end of Bretton Woods. This first big dollar rally here, this is the Reagan dollar rally. This is Reagan and Volcker. This is the raising of interest rates by 100 basis points overnight when Carter was still president. And we had the policy mix under Reagan and Volcker of loose fiscal policy. Again, under Reagan, we had tax cuts, military and social spending increases, loose fiscal policy, tight monetary policy, because remember, we had double-digit inflation, and Volcker squeezing that inflation out by raising interest rates despite the rise in unemployment. That policy mix, I look for that policy mix. That's another important point about methodology. I look for that policy mix. Tight monetary, loose fiscal policy, and that policy mix often coincides with a currency rally. That's not a Reagan-Volcker, but we'll come back to that with the more recent dollar rally. That's what Germany had when the Berlin Wall fell. The government had loose fiscal policy, right? There was a leveraged buyout of East Germany. The Bundesbank didn't like it, stepped on the monetary brake. The Deutschmark at the time shot up. What's interesting here about this dollar rally is that it ended in the sort of the official end, not just a peak of it. What happened was the official peak is in February, but what officials did, it was still too high. In September 1985, this is the Plaza Agreement that basically triggers the intervention coordinated intervention among the G5 countries. Canada and Italy weren't invited. And that set us up for a bear market for the dollar, a 10-year bear market for the dollar. And then we had the next dollar rally. I call it the Clinton-Rubin dollar rally, because this dollar rally was partly the tech bubble. I mean, remember when Netscape, the first search engine, went public? Imagine the internet without a search engine. It's like a dictionary that's not alphabetized. So we had people wanting to buy U.S. stocks and Americans keeping our money at home. But the key to this was the change of the Treasury Secretary. Besides having this rule of thumb about monetary and fiscal policy mix, I have another rule of thumb. I said if anybody close to Texas gets charge of the dollar, it sells off. John Connally, who was in a car with John F. Kennedy as a Democrat when Kennedy gets shot in Texas, he becomes a Republican, and he is Nixon's Treasury Secretary when we go off to Bretton Woods. We decouple from that, the last severing of it, Connally from Texas, Treasury Secretary. James Baker was Treasury Secretary from Texas during the Plaza Agreement, driving the dollar down. And here, the last part of this dollar sell-off, this cycle, was when Lloyd Bentsen was at the Treasury, and he also used the dollar as a weapon, threatening Japan to let the dollar fall if they did not make some trade concession. What this dollar rally, Clinton-Rubin dollar rally, is based on is when Lloyd Bentsen was replaced by Robert Rubin. Robert Rubin said a strong dollar was in U.S. interest. What does this mean? You know, we have a vice president of the United States that once said that a strong dollar meant it was difficult to counterfeit. That's not at all what Rubin meant. Rubin meant that up until then, the U.S. was willing to use the dollar as a weapon. Bentsen used it, Baker used it, and in here we use it several times as well. In fact, some people think that 87 slide, that the stock market fell by 25% in one day, was partly predicated on comments from Treasury Secretary Baker threatening the Germans with a dollar devaluation, setting us up for that 87 crash. But in any event, what Robert Rubin meant was that the U.S. would not use the dollar as a weapon to either promote exports or to devalue our debt. If the dollar fell by market forces, so be it, but the U.S. would not purposely drive it so. De-weaponizing it, and this is what paved the ground for the Clinton-Rubin dollar rally. Again, this rally, it's not just a downtrend, but this was a big trend, lasted many years. And then in October of 2000, Lawrence Summers had replaced Rubin as Treasury Secretary. And, you know, in this time, as the dollar is rallying, and the reason it's rallying again is because Americans are keeping our money at home, and foreign investors could not wait to buy U.S. equities. This was the explosion. I had one account I'd set up for my son. I called it my Wintel account. I only bought Microsoft and Intel in it. This is as we were replacing typewriters with computers. This is the carving out of this space. And so we had this big dollar rally, but in the middle of it, so towards the end of it, the euro was born. And when the euro was born at about 119, it proceeds to fall to about 82.5 cents. Europe thinks we're picking on it. They did not want a weaker dollar, they didn't want a weaker currency. This is despite this idea that that central banks or countries always want a weaker currency. It's just not true. Here, at the top of the Reagan Volcker dollar rally, Europe and Japan wanted to stop the dollar from rallying. They wanted to stop their currencies from falling. Same thing here, the Clinton-Rubin dollar rally. Europe did not want the euro to fall any further. They helped organize G7 intervention. The U.S. participated in it, and participating in the intervention. Excuse me?
Was that the Plaza Accord right there?
No, Plaza Accord is okay. 85. This is another one. We don't talk that much about it, but in October 2000, the major central banks intervened again at Europe's request to support the euro. That is, they bought the euro, sold dollars. And that set us up for another long downtrend in the dollar. Now, my book came out in 09. My first book came out in 09, in August of 09. So I'm sorry, August of 09, in here someplace. Here we go. I had thought that the dollar was going to be in the middle of another big dollar rally, because a lot of people were telling me that the dollar could not rally, that there was structural problems. And that's another methodological point. When I hear people confusing cyclical forces and thinking that they're structural forces, like right now, people think the dollar only can go up. And they've got all these reasons why. I read one reason recently that they said the Fed's balance sheet is going to cause the dollar to fall. The Fed's balance sheet is about 30% of GDP. The ECB's balance sheet is about 40% of GDP. The Bank of Japan's balance sheet is over 100% of GDP. But somehow the dollar is going to be dragged down by the Fed's balance sheet. So the point here, I think, is that for me is that I had anticipated this big dollar rally, and now I'm thinking that the third big dollar rally since the end of Bretton Woods is over, or nearly so. The crisis has put like a little spanner in the works, perhaps. But, you know, at the end of last year, 3 or 4 months at the end of 2019, this broad-weighted measure, the dollar fell. Bloomberg hadn't updated since the end of the year. We know that it's really fallen in the first 3 months of this year, and it's also fallen at the end of last year. So I thought that a good case can be made for it rolling over. And why would the dollar roll over? Well, I thought of 3 reasons that I saw. One is the policy mix was no longer as favorable. Remember, this is should just back up a little bit and talk a little about this Obama-Trump dollar rally. And at first it was divergence. The U.S. first in, first out of the great recession, the great financial crisis. And then latter part of it was, again, as we saw with the Reagan, the policy mix. Federal Reserve was tightening monetary policy, and the government was spending money. So fiscal stimulus, monetary tightening, will give us this Obama-Trump dollar rally, which I think is rolling over here. And so the reason I think it's rolling over, policy mix has changed. It's no longer supportive for the dollar. Secondly, what I find interesting is that, again, this gets to the methodological point about cycles. You would think that interest rate differentials have moved in the U.S.'s favor, but they really haven't. The U.S. interest rates, and I'm looking at the 2-year interest rate differentials, have really fallen since the end of 2018. So the dollar is losing its interest rate support. And, you know, most recently, of course, interest rates are converging close to zero. That is, ECB, Swiss National Bank, Bank of Japan have negative interest rates, but they have not cut them any further during this crisis. Instead, they've used other tools, but it's the other countries like the US, the UK, Canada, Australia, New Zealand have been cutting interest rates. So you have a convergence of interest rates, and that also undermines the dollar. And thirdly, I think this is one area where I think Trump is right about the dollar, and almost no matter what metric you want to look at, is very overvalued. I'll give you an example. The euro, so how do we measure overvaluation in currencies? I think one way economists have come up with is purchasing power parity. And I know everybody's familiar with the Big Mac or cappuccinos at Starbucks and looking at them over different countries. The OECD has a model. I use that just because it's handy. And that model suggests that OECD currencies don't really get 20%, beyond 20% or 25% beyond fair value. The euro is stretching that now. And other currencies are as well, but that's sort of the big example for you. But I wanted to show you, before I leave this completely, is to show you another screen if I can. Let me see. I might need some help.
You got it. It's right there.
Yep. So I'm looking for this other screen here for you.
Hey, Mark, if you click on the share screen button again, which should now be at the top of your screen, because now that you're sharing your screen, the Zoom panel is going to be at the top of your screen, and once you mouse over it, it's going to expand. So once you click again on the share screen, it's going to give you the option to change the screen you're sharing.
Yes. Okay. So here you go. See that?
Yes.
Yeah.
See the new screen?
Yep.
So you see that this yellow line over this I've put this is the euro. And I took the inverse of the euro. So I took the euro and did the opposite. So rather than having how many dollars did the euro buy, I look at how many euros a dollar buys. And you can see over this how well how well the broad trade-weighted dollar and the euro track each other. So for me, focusing on that broad trade-weighted dollar is the real anchor. And then the euro, which of course is what we can trade. We can't trade that real broad traded weighted dollar, but that is that's where I get the major thrust from my dollar views.
Okay.
I thought maybe maybe I should show you a couple of things that I'm looking at like right now for like some actionable things. And so again, I'm going to try to share another screen with you. And this is the Australian dollar. And you know, you can see that, yeah?
Yes.
Yep. So you can see what an incredible recovery we've had there on the Australian dollar. And my work, again, combining technicals and fundamentals, suggests to me a couple things. One is that we're already beyond those Fibonacci retracements. That came in at these old highs near 64.50. Well beyond that now. And I'm looking at a place to sell it. So what I'm looking for then is a reversal, something in the price action to tell me that a high is at hand or that a reversal pattern is actually unfolding. It does not exist yet, but I'm anticipating it by early next week, because early next week, the Reserve Bank of Australia meets. And I don't think they're going to be very happy with the appreciation of the Australian dollar given the weakness of the economy and the terms of trade shock. And again, the terms of trade shock really refers to what they're exporting relative to what they're importing. And I know that trade is falling, but trade is still a very important factor. And I just point out that I think that the Australia, typically a central bank wants a currency to go in the same direction as monetary policy. So when the central bank is tightening, they want a stronger currency. They're easing now. The RBA has eased very aggressively. They are the first country besides Japan to try yield curve control. The yield curve control means they're targeting another rate besides the overnight rate. What they're doing is they're targeting the 3-year yield, the 3-year bond yield at 25 basis points, which is the same as the overnight interest rate. That is steepening the yield curve.
Okay.
And the strengthening of the Australian dollar offsets that easing. And so I think they will see a stronger warning or pushback from the RBA next week. And that's just probably in time for the Aussie be peaking. This yellow line I put in there is the 200 moving average. And so ideally, I'm looking, so sort of like a scientist, like those people who found the DNA, they sort of knew what they were looking for, and that helped them find it. It's a very delicate balance. So I am looking for a reversal pattern here. Now I want to just show you one more chart.
I just want to ask you something on that Aussie, Mark.
Sure.
So this recent rally, since it carried past a lot of fibs, and even though you're looking for Bank of Australia not to be happy and a correction could ensue, maybe back to 62 cents or 60, are you just looking for this pullback to be corrective, and is the possibility there viable that the lows we made on the crash are the lows for quite some time in the Aussie?
Yeah, no, that's my thinking, Dale, is that Aussie, when we were down here, this is just like unreasonably, I mean, this is the market's panicking. This is the market's pricing in that big tail risk, that left-hand tail risk. The world was coming to an end. Locusts were swarming Africa. We were hit with a virus, and I know I heard Mark's comments about the pandemic and how we might have overreacted, and I think that again is not borne out by the facts. I think that the fact of the matter is this: that you look at death rates, and you look at like New York's average deaths or the country's average deaths. This is the big one. This is not just what did he call it? A garden variety recession. This is the big one. This is the biggest pandemic of our lives. It's not just that the U.S. overreacted. Almost every country had the same response. And what's going to happen, and this is really the telling thing, is, the idea that tomorrow or whenever the government says, okay, now you can go out. look what's happened where people have allowed to go out. They do not have, the social trust has not come back. They are reluctant to do public transportation. They're reluctant to go to big restaurants. They're reluctant to have big sporting events. This is, I think, a big deal. And I want to say that the markets are pricing in the end of the world, not just in the Aussie, but you see this in almost every risk asset.
Yeah.
And even
now they're
non-risk
pricing
assets.
in, we could flip a light switch and everything's okay, right?
Yeah, I mean, yeah.
Let
no,
me
I
ask
agree.
you this, Mark. In the Depression, in the 30s, and this is not my thought, it comes from Danielle DiMartino, that it took 3 years for the unemployment rate to get to 20 or 30% in the Depression. And we did it in 3 weeks.
Yeah, I mean,
what do you
everything's
think?
happened. Everything's happened faster in this crisis because of the nature of the crisis. This is not a garden variety downturn. This is the world economy coming to a screeching stop. And so we're going to see this not just in the weekly initial jobless claims, but next Friday, that'd be, what is it? That's May 8th. That we're going to get the April non-farm payrolls from the U.S. And the early estimate is for a loss of 21 million jobs. Yeah, so of course this is different than a typical recession. Now, I was in that camp that thought that the economy was weakening. You know, before we got into this crisis, this is the longest expansion in American history. And it's been longest, and I thought it was becoming increasingly fragile for some of those shocks that we all know about, like the tariffs, like the changing policy mix. And so I was concerned that we were headed for a recession in any event.
Before
but this really pushes
catalyst.
over.
Okay.
And let me just show you one more chart here, if I can this here.
Oh, you're getting the hang of it now, buddy.
I'm trying to here. I'm a little slow.
Great
I'm still a
presentation.
boomer, I'm afraid. So I want to show you this one because this is another actionable one. Immediately actionable, I think, or something to be watching very closely in the next couple of days. So this is the British pound, and where the Aussie crashed, so did the sterling. Sterling did not belong at 115, not March. The sell-off took place. You saw the nice base, had the nice bounce, and now look at this. To me, this is a head and shoulders pattern, potential head and shoulders pattern. So you've got the left shoulder, head, right shoulder. Yesterday, we got right above 125, shoulder.
Very symmetrical.
Very nicely done. And then we've got the neckline around 123. So for me, so again, I have this macro view that there still is a dollar shortage out there, and that the sterling and other currencies had a bounce like the Aussie, and now I'm looking for this bounce to either correct lower, to your point, Dale, or to retest those lows. And so I'm looking for these reversal patterns. In the Aussie, I'm looking for just a day pattern to tell me it's okay to sell it. Here, I'm looking for the breakdown of this head and shoulders pattern.
Nice look.
And so,
okay.
So those are the charts I really have for you. I think that I guess my other point, just broadly speaking, is that and this is what I wrote about in my second book called Political Economy of Tomorrow. I think that our challenges are not so much from capitalism's weakness and the excesses, the weaknesses that it generates, the say danger to the environment or disparity of wealth and income. Those are all problems, but they can all be fixed. To me, the hardest problems really come out of the success of capitalism. It's sort of like maybe some people we know, that their greatest strength is also their greatest weakness. And I think that's true about capitalism. And so in my book, I really talk about the possibility that the way to characterize or way to frame what we're going through modern era is really like a Midas, King Midas story. Remember King Midas from Greek mythology?
Yeah.
Everything he touched turned to gold. At first it was a gift. He touched a tree, turned to gold. A piece of fruit turned to gold. And then he tried to drink some wine and hug his daughter. And I think that's where we are. We're seeing the downside of the incredible success that capitalism brings us, where even poor people among us living longer, having more material things than ever before. And so what concerns me really then is in this Midas moment is not that for me, the Midas moment is that the heart of the problem and why interest rates are low is not simply because the central bank is buying them. In fact, if the Federal Reserve stopped buying treasuries, I think yields would actually fall further, because what would happen if the Federal Reserve stood back and let the economy do what it will do, which might stay in a trough and not recover, interest rates would go down further. I'm worried that the problem we have is really generated from too much of a good thing. And, you know, in Brazil, they found this. When Lula became the president, he thought that his country suffered from the lack of food. He found out it didn't, that more people had nutrition problems, but had overweight problems than were starving. And I think this just illustrates a general problem that I think that is in the world, especially in the major industrialized countries. We have too much. And the reason, it's sort of like, there's a story about a guy who's taking his motorcycle. He's riding his motorcycle in China, and he has a half a pig he's bringing back to his family. And he gets hijacked, and they let him keep the motorcycle. Pork was more valuable. And the idea is that we know when pork prices go up, we know why. Like right now in the U.S., all of a sudden there's some disruption of supply. In China, they had a call from the Asian swine flu. In the U.S., the meat processors have shut down. We know that supply and demand works for commodities. Oil prices, a great example. What about money? And I think that because we live in a capitalist society, many of us think about capital as a special thing. That you can have too much of anything, but you can't have too much money. But collectively, we have so much money. And I think that is why interest rates have fallen. Interest rates stay low for various reasons, but among them that I think is underappreciated is that there's just too much money. And I know people say, well, what about all this debt? Well, one person's debt is another person's asset. And so too much debt and too much capital, they really work hand in hand. So let me stop there, Dan. I know you must be eager to ask.
So what are the repercussions of having too much, Mark? Where are we going? Because the title of your presentation was The End of Economic Primacy. So is it possible that because we've reached this Midas moment, we're going to abandon capitalism and move either real far left or real far right?
Yeah, you know, I find this so interesting that, like, I see this every time we get a downturn, every time the central bank does something, people announce this is the end of laissez-faire, the end of capitalism. Keynes wrote The End of Laissez-Faire in the 1920s. I'm not sure, like, what people think about capitalism and what's ending, but just think about the size of the federal government. In the U.S., the federal government consumes a third of GDP. In Europe, it's closer to 50% of GDP. That is to say, modern economies do not generate sufficient aggregate demand, and the governments step in. I can't think of I don't think that this like Garden of Eden was only up to the markets. I don't think that ever existed. But so my point about the end of economic primacy is I think that the great financial crisis ended the Reagan-Thatcher revolution, if you will. A real push of liberalization, capital markets, even think about the securitization. It was really an explosion of economic liberty. And I think that the end of that financial crisis began a new era. And that new era, I think, is this coronavirus. I think there's a question I think a lot of people have. Will the coronavirus change the trajectory, or will it accelerate forces that are already at work? And I think for me, the end of economic primacy was already in the works before. You think about, it's not just in the United States either, but of course, President Trump illustrates or brings a lot of those factors together. Economic nationalism, national security. This is what's going to happen to, say right now, for example, the U.S. does not make any antibiotics. I think we lost our last penicillin factory about 4 or 5 years ago. So what's going to happen on the other side of this crisis is we're going to be onshoring, reshoring, if you will, medical profession. That is medical research, making antibiotics, making drugs, making medicines, making medical products. Same thing that China is going to face. China is really reliant, like many countries are, on a U.S. duopoly, OIS and Android. And I think that it's not in their interest, not in other countries' interest, to be that dependent. So they have to develop their own. I see this privacy rules in Europe beginning to break down the one web into different components. I think that's increasingly what's going to happen. I think that the environmentalists are going to tell us that just because it's cheap to drill shale oil in the U.S. doesn't mean we should do it. New York State, for example, has shale formation, but people in the state said, no, we don't want shale drilling in New York. And so I think that the economic efficiency, those arguments are going to have to get more balanced. And I think this changes the direction of globalization. I think we still will have trade, but I think that it changes the globalization. But these forces, I think, were already in play before the crisis. Europe, for example, passing rules so that the Chinese state-owned companies don't buy up their companies, especially at this big discount that's recently been given. So I think that this is long-term forces, and I think that we'll have perhaps less trade and less economic efficiency type of arguments. Instead, we'll look at things like national security. We want to be secure in energy. We want to be secure in food. And now we've learned we want to be secure in medicine, medical products.
What a great presentation. Once again, Mark, I have a tendency to be a bit emotional about big changes and shocks that are happening in front of my eyes. And you know what? You're better than a Valium. Okay, because you can put everything into context that it's just the evolution of things, and it really isn't the end of our way of life, because the government stepping in to do this is just another transition that will lead to another transition and another transition. Am I reading you correctly?
Yeah, I think so. I think that the relationship between the state, the economy, investors or citizens, these are the three key relationships, and I think that they do morph. And I'm not a purist. This is a mixed event, just like I try to combine technicals and fundamentals. I think we got to combine politics, economics, and yeah. So, but I do think that maybe as to leave on an up note is we had that first quarter GDP this morning is horrible. The only thing we can really know about it, it's going to be worse in Q2. But my optimistic note here, besides being a Cubs fan and knowing that there's always next year, is that the economies are likely to be bottoming out here at the beginning of sometime in May. So say next month, the economy is going to be bottoming. We're not going to go back to this kind of situation again. That the contraction is the steepest as now, and I think that it's not going to be like the V-shaped recovery or anything like that, but just the math of a GDP, because we're looking at the difference of the difference, the change in the change. And so I think Q3 will be a lot better, and that we're just, like I say, the economies are bottoming in the next few weeks.
Mark, thank you so much for being here. Everyone, you can follow Mark on Twitter at MarkMakingSense. And the name of your blog again, Mark, same thing?
Is Mark to Market. It's
Mark to Market.
Mark to Market. Mark with a C to make my mom happy.
Okay, Mark, thank you so much, my trading warrior brother.
Thank you. Good luck to everybody.
Thank you,
Yeah,
Mark.
good hunting to you too, Mark. Thank you so much for being part of the summit.
Hey, Justin.
There's Justin.
Hey guys, can you hear me okay?
Yeah,
Yes.
perfectly.
All right, how do I get the fancy background like everyone else?
You have to be a hologram.
I did send it to you.
Technical tools, not my strength, but no problem. But thanks for
welcome, Justin. Nice to see your mug. Nice to meet you.
Nice to see yours, and thanks for everyone for attending. Hope everyone is staying safe and healthy.
Thank you for sponsoring this event.
Oh, well, listen, you guys know I've been a big fan of Forex Analytics for years. We've been a sponsor for years, and when Steve mentioned that he was interested in putting on a larger event to a bigger audience, I sort of begged him to let us be involved, and very appreciative for the opportunity, Steve and Dale and Blake and everyone else at Forex Analytics for letting us be a part of it.
Thank
you.
So
why don't you tell us a little bit about, Steve, you have a question? Tell us a little bit about Forest Park FX and your model and what you do for people. You're a broker of brokers. Do you have many FX brokers under your banner that you send people to and look for the correct fit?
Yeah,
and try and fit their needs of a trader?
Absolutely. Listen, I know I've got a limited window here and people are attending not to hear me so much as they are the far more educated and accomplished traders that are part of this panel. But I do have a little bit of a slideshow that, if it's all right, I'll bring up and share. And I think, Dale, that'll address some of your questions and some of those of the viewers. And I can talk a little bit about who we are, our value proposition, and we have an
It's up.
opportunity people. So good. Glad you can see it. So just a quick bit of background. My name is Justin Hertzberg. I'm the founder and CEO of Forest Park FX, and we are a globally regulated introducing brokerage firm. We specialize in the over-the-counter FX market, which is part of what's made us a good partner and fit in working with Forex Analytics over the years. And just a bit of brief background on me, because for some reason, I don't think anyone intends to end up in FX, and I've joked for years I took a wrong turn somewhere and ended up here. But got a philosophy degree from Emory University a long time ago, and I joke that my only options with that degree were to become a barista or to go to law school. And so I went to law school, got my JD MBA at the University of Miami with a concentration in finance, and was counseled at that point in time that if I didn't come out of school and start working as an attorney, I would probably never have the opportunity to do so again. So I actually started my career as a securities and commercial litigator for a large firm in Florida, and quickly realized what I probably knew all along was that I was a bit more entrepreneurial than your average attorney, and started looking for something that I could do that would leverage my educational background, my interest in finance. And in 2009, I left traditional practice of law and went to go and work for an FX prop firm that was led by a former FX fund manager who at his peak had about $750 million under management, and by volume was probably one of the largest FX traders in the world. And at that point in my life, it sounded a lot sexier than being a lawyer. Made a major career change. It was really my first exposure to trading anything other than baseball cards. I got really interested in the markets, really interested in the brokerage and exchange side of trading. And from there, I worked for a couple of other firms in a variety of different capacities. And in 2013, I launched Forest Park FX, which was an NFA registered, CFTC registered introducing brokerage firm. We expanded in 2017, launching a UK office and being regulated by the FCA there. And the reason that I started this business was I wanted to find a place within financial markets where I felt we could make a difference, somewhere where I could combine my advocacy background as a lawyer with my sort of entrepreneurial interest and fascination with the markets. And FX was really the natural fit for that because it's an over-the-counter interbank market. It's not a national market system. It's not like logging into an E-Trade account or a TD Ameritrade account and you're going to see the exact same bids and offers on shares of Facebook because that's what a national market system is. FX is still a little bit Wild West. It's still an aggregation of pricing amongst liquidity providers. And we saw that there were a lot of great educators, commentators, mentors, people that are part of this panel are providing tremendous guidance and information and understanding about the markets. But ultimately, what is a viewer, what is a subscriber, what is a newer trader supposed to do? They've got to apply that knowledge in the right context. And there wasn't a lot of information about how to do that. If you went to a particular broker for that information, they've got a very biased approach because they want to earn your business and they want to force you into using their platform, their offering, their pricing model, because that's how they make money. But I felt that there was really a need for someone to sort of sit in the middle that was broker agnostic, that was objective, that was actually going to try to steer people in the right direction and apply the value that they would be getting from, say, Forex Analytics and all the commentary and market analysis that you provide in the right brokerage context for their particular trading needs. And, I observed through the years of being in financial services and in particular the FX space, and we noticed a lot of things that traders were doing wrong in making their brokerage decisions. And the first, and here's a short list of things that I've talked about so many times over the years, but we would see traders choosing unregulated brokers, which to me is akin to just throwing your money away. Those are nightmares waiting to happen. Very, very important, always work with a regulated broker. We would also see people always believing what they read about a particular broker or trading platform or piece of technology. And you have to kind of go into the world with eyes wide open and realize that it's a competitive landscape and that there are people looking to destroy the reputations of others. You've got very bitter or jaded people that write reviews that are not based in fact, very much the same way that someone might bash a local restaurant that you love and think is terrific, but they just had a bad experience or had a bad day and they decided to take it out on Yelp. And so you have to really take a more critical view into how you approach your brokerage solutions. Because we're talking about an over-the-counter market, traders often don't understand the different pricing and execution models that might be at play and how that could affect their trading strategy. We would see traders using the wrong platform for the wrong reasons effectively, and trying to understand the technology you're using and how that could impact positively or negatively the trading that you're looking to conduct. And really, when you put it all together, we would see that there were plenty of traders out there with good strategies that they were just employing in a bad environment. And what we wanted to do ultimately was to be a steady hand and a steady voice and guide them in the right direction where we felt that they would have and realize the most value. And that really led us to our core thesis, which was to be a value-adding introducing broker, someone that not at the expense of the client, of the trader, could help them navigate these waters and ultimately find the right brokerage and trading solution for their particular needs. And so that really became our mission. We decided to build a company around helping traders make smarter brokerage decisions, doing everything we could to understand their particular trading strategy and needs so that we could connect them with the platforms and the technology that their trading demanded. And that we didn't want to just end it there. We wanted to provide ongoing service and support for all of the questions that come up, whether it be broker questions, platform questions, technology questions, trade execution issues that arise from time to time. We would represent the client, not the broker. And it helped to have a company that supported you and your position when you have an issue or a conflict with a broker. And then the other more tangible value proposition that we offer to all clients is that we actively work to reduce their costs of trading through either a cashback rebate program or negotiating better spreads or commissions with the brokers that we have aligned with. And that rebate model is one of the things that's easy for traders to grasp. It's literally pure value for them and making it cheaper for them to trade with one of our regulated brokers. For all the skeptics in the world, we don't mark up costs of trading. We don't interfere with client costs of trading in any way. We are truly trying to be value add, that not just in helping you find the right broker, but actually making it cheaper for you to trade with that particular broker and saving you money on every trade that you place. And, with regard to Trader Summit, one of the other sponsors of this event is IG, which if you're a trader and you don't know who IG is or what IG is, I'm not sure how that's possible. They're one of the longest standing, most reputable brokers on the planet, massive company, publicly traded, well regarded into virtually every market and every geography. And we're very fortunate to have a great relationship with them. We were IG's first introducing broker here in the US when they launched last year or relaunched last year. And love working with them. I think you'll hear from some of their people tomorrow. And one of the things that we're doing as part of this event for all the people that are listening that are interested in trading, really encourage you to work with IG. It's a terrific broker. And we're going to be doubling our cashback rebate offer from what we normally offer, which is 5% of your spread. We're going to be doubling that and basically rebating back to customers 10% of the spread that you realize on your trading with IG. So it's a very generous offer. It's literally cash in your pocket that comes out of IG's pocket. And they're okay with this. I checked, I cleared, but we'd like to do everything we could to help you be as profitable as possible. And Dale, just to address your question earlier, the brokers that we work with in the U.S., we work with the three major FX brokers, IG, Forex.com, and Oanda. We enjoy a strong relationship with all these brokers. Obviously, we'd love to see IG succeed as a sponsor of this event and grow their business here in the U.S. as they've worked very hard to reestablish themselves in the U.S. market, and we're doing everything we can to support them.
How
as well.
courageous of IG to come back into this market that everyone fled.
It's
How about that?
Undertaking. It's a tremendous capital requirement and commitment. It's a very, very onerous regulatory burden to take on. They've done it well. They've brought in some great people. Their pricing and execution is outstanding. They're an incredibly well-capitalized firm. And we're doing what we can to educate the U.S. market about the benefits of trading with IG. And so we're happy to be their first U.S. IB. But we do also work with Forex.com and Oanda, which are also terrific firms. And we do a lot of work vetting the brokers that we work with because we stand behind our recommendations. If we're going to encourage a trader to work with a particular broker, we want to make sure that that's a broker that is well capitalized, well run, well regulated, and going to provide a fair and equitable trading environment. On the non-U.S. side and through our
you have a little more due diligence to do on the non-U.S. side. Don't you think, Justin?
Well, we certainly do, although, I will say we focus very heavily on your heavily regulated jurisdictions. So our brokers are typically those regulated by the CFTC and the NFA here in the States, the FCA and ESMA in Europe, and ASIC in Australia, which we deem to be really the toughest regulators. And if you can make it there, the likelihood of some untoward action being taken against you by a broker is minimal. We feel very confident about introducing clients to brokers in those jurisdictions. And we continue our due diligence. We continue to keep a very close watch on all the brokers we work with because our number one priority is to protect our customers and make sure that we do provide them with that fair and equitable trading environment that they deserve. And so you'll see a lot of other big names on here. Again, we work with IG in Europe and proud to have that partnership, but some other very large FX brokers as well. And so for any listeners in on Trader Summit that are interested in trading FX, or if you already have an FX account with one of these brokers or would like assistance in choosing a broker, we'd love to help you. We'd love to help you save some money in the process. We'd love to be that free resource for you for any questions that you have along the way. You can feel free to get a hold of us on our website. You've also got my email and our head of sales, Trent Hare, his email and direct dial phone number as well. Those really are our direct phone lines. I joke all the time that all the ways my wife can get a hold of me and yell at me about something, so can our clients. So I really encourage you to reach out, ask any questions that you have, and we would love to help you. And other than that, again, Dale, Steve, Blake, everyone at Forex Analytics, thank you so much for letting us be a part of this event. We're really honored to be involved. It's a tremendous lineup. I cannot believe the quality of the people that you got to participate in this. I hope we get to do this many, many times over. And unless you've got any questions for me, Dale or Steve, I'm happy to let you get back to the more intelligent people that you've got lined up to talk about markets and help people make some smart investing decisions.
First of all, thank you for sponsoring, and we've been working with you, so we know from experience that the service you deliver is of the highest quality, and that's why we recommend you to our clients. Otherwise, we wouldn't at all. We do have a couple of...
We trust you, bro.
That is very true. That is very true. And I think that Trent and you are two of the most knowledgeable people in the industry. So I always strongly recommend people speaking to you first. We have a couple of questions. One comes from South Africa, actually. Hi, I'm from South Africa. I use a broker from here. I haven't had any big problems, but are you guys able to assist me with them? So
Without knowing about the specific broker, it's tough for me to say, but South Africa, I can say, is one of the fastest growing regions right now for regulated FX trading. We're seeing a lot of firms that have previously established in other jurisdictions like Europe and Australia are now moving into South Africa and obtaining licenses there. For that particular individual, the question, just shoot me an email, give me a call. I'm also on WhatsApp, Skype, every messenger service that exists. Happy to talk about the broker, do some due diligence for them, make sure that it's a good venue to trade. Even if we can't work together, I still want to make sure that people are working with quality firms and knowing that their assets are protected and that the trading environment will enable them to trade successfully.
another question, do you offer copy trade or PAM, or does that depend on the broker?
In some instances, it depends on the broker. In some instances, it depends on the licensing and registration that a particular person has. We actually have developed an in-house trade copier program recently that we just started to roll out and license to certain brokers and trading groups. We also have a full-scale programming services team that can basically build anything, any custom indicator or algorithm for virtually any trading platform that's out there. Is part of our service as well. But if people have specific questions about becoming a money manager, I can always put my lawyer hat on and help navigate that regulatory quagmire and give them some guidance and direction in terms of what the right thing is to do to make sure that if they are going to undertake that type of activity, they're doing so in a fully compliant manner.
We also have Braddon that had recently a very bad experience with one of the US brokers. It has to do with the recent incident we had with the oil futures. He says that he was long, but he wasn't able to trade it at all after it went below $1. And his position was in essence liquidated without hitting a margin call at the expiration, and he couldn't do anything about it.
So we have seen, if we're talking about a U.S. person, this would have been a futures account, not an FX
Yes.
account, because no CFD trading here in the States. What we have seen, and we've been following what a lot of different FCMs here in the States, or futures commission merchants have been doing here in the States. We've been following along with what their policies and procedures are with regard to some of these breakdowns in traditional correlations. We saw it, several weeks ago with the gold supply chain breaking down and how that was materially affecting gold spreads and effectively blowing people out of positions. We are now seeing, obviously, oil going negative when you factor in storage and transport costs. Different firms are taking different approaches on how to effectively manage that. There's no blueprint for this because we're really seeing things that are unprecedented. I'm certainly happy to speak to this person. They're welcome to contact me. I can reach out to that particular broker, see if we can get a better understanding or explanation as to what happened.
Yeah, and we just got another one that had the same problem with a different brokerage firm in Europe or elsewhere. I'm assuming they don't say where. So they can contact you about that, and
yep, of course,
you can help them look into it.
Yeah, we're
Okay.
a resource, and I encourage people to take advantage of that.
Perfect. Justin, it was a pleasure having you.
Always a pleasure.
Justin.
Good luck with the rest of the conference, and I will be listening in and learning a lot. Thanks, guys.
Thank you. Have a wonderful day.
You too. Bye.
Peter is a contributing editor on CNBC. I've interviewed Peter many times. Always walk away learning something new. He's with Bleakley Advisory Group, and I'm sure anyone who watches financial television knows that Peter coined the phrase, the Fed is not data dependent, they're S&P dependent. So welcome to our summit, Peter.
Thank you, Dale. Sorry about the graphic. It seems like I got half the background and half my office.
That's okay.
Yeah, I can tell you what the problem is. In the virtual background settings, you have set that you have a green screen. That's the problem. That's why it can't display properly, Peter.
Okay. Well, I'm going to be sharing my screen, right, Peter? So
Yeah.
I'm going to share my screen, unless you didn't bring any kind of presentation or anything, correct?
No.
Okay. So I'm going to be sharing my screen, and I want to show a couple of things here. I want to show Peter's, where is the tweet deck? Here it is. Right there. Huh. Let me move this. Anyway, there we go. Okay. So the book report. I know a lot of people would say that on the way to school, the wind blew away their book report or the dog ate their homework, but this is a different book report. And it's done by Peter, who really has a handle on what's happening with the Fed and what's happening with economic numbers. And Peter, I know you've been very constructive. The precious metals market, since I've been talking to you, you talk about a long runway in silver. You've also been constructive on emerging market debt and have been very cautious about U.S. equities. And last time we talked was before the March crash that we had. And first of all, I'd like your impression of the March sell-off. And I know that you and I had also talked about the economy being fragile, already weakened manufacturing. Was the coronavirus an excuse for what was going to happen anyway, Peter?
I mean, the virus was certainly the pin to, the bubble that we've seen over the past 10 years created by zero rates, negative rates, and QE and so on. So it was going to be something, but of course, no one knew that it would be that. So what economic downturns do is it exposes underlying vulnerabilities. It exposes fragility. It exposes excessive leverage. And we certainly have had all of those combined. So again, whether it was that or something else, it was going to be something. And that certainly ended up being the case. I do want to say at the March lows, I did get more optimistic. If there's one thing that I've been optimistic on is been the effectiveness of shutting things down in order to contain the spread and allow the healthcare system to regroup, to buy us time to effective therapeutics, buy us time to better handle when a reopening would eventually occur, acknowledging 100% the economic damage that does. I think we're now at a point where we need to start rolling this out, the reopening, and I think people are going to have to really get used to wearing a mask as being a very effective tool to keep people safe. Now we're at 2,900 in the S&P. The calculus is quite different, and I think right now the stock market is embracing the direction of improvement on the economy, and at some point it's going to shift to the degree of that improvement. I think the Treasury market with the 10-year yield at 59 basis points is more focused and worried about the degree of that improvement and less the direction. Also, of course, being helped out by Federal Reserve QE.
Okay. All right. So since you brought up the bonds, I wanted to get your opinion on the fact that the Fed did not have to buy one junk bond or one LQD corporate bond, and the rally was so dramatic without any action. Have you ever seen the Fed be that effective? Here's LQD. Here they said they would step into corporate bonds. They'd also buy junk. Here's junk, not as strong. Do you think the Fed's going to be tested since they didn't do anything? Is the market going to test their resolve and see if they actually do come in and buy some of these issues?
I'm I mean, I think they'll certainly buy things. No question. I just think that they're not going to buy nearly as much as people think. I actually cleared my screen of that graphic noise, so I don't know if you want to switch back so people can.
Okay.
No,
Well,
it wasn't working correctly, so you did
Yeah.
well.
Yeah.
Okay.
Okay.
So I think that, we've seen the ECB, we've seen the Bank of Japan get really aggressive in buying private assets outside of their treasury bonds. I think the Fed is going to use more of the threat of buying rather than doing it in such size, particularly on the high yield side, because they've done, first of all, they've done a complete end around the Federal Reserve Act, we know, in setting up
Right.
these special purpose vehicles to get around to buy this stuff. But I think the market may be disappointed in the extent at which they buy, because I don't think the Fed really wants to clog up these entities and their exposure with junk debt, because it's just that even politically, it's a very dangerous road. So I think right now they've been more focused on unclogging the freezing that we saw in the credit markets in March, rather than being a major presence in these markets. And I think that's a very big distinction, not only within U.S. markets, but also distinguishing them from the others. Now, that doesn't make the Fed this great actor. They're getting involved in private markets also, but I just don't think they're going to do it to the same extent, again, as others. And I think the next thing, of course, for the Fed is this mainstream lending program, where they're really going to be taking on and junkifying, I call their balance sheet, because they're going to be taking on a lot of credit that is not pristine, and with debt to EBITDA ratios, according to their mandate, of 4 to 6 times, which seems low, but how do you define EBITDA? There's going to be a lot of craftiness on the part of companies to make their EBITDA look like something that can meet these criteria that would enable companies to get these loans.
Okay. The market was sounding warning signs of debt to GDP before the virus struck, and with the additional fiscal rescue packages that have come out of Congress, I've heard that debt to GDP in the U.S. is anywhere from 100 to 125. What kind of impact is that going to have on our economy going forward for years? Do we reach a point of no return on this, where people just start to shy away from anything dollar denominated? I know if I was a foreigner and I looked at all this printing by the Fed and budget problems with the U.S. government, that I'd be a little bit leery about holding anything denominated in dollars.
Well, I like to say it doesn't matter until it does. In 1986 and 87, people were having debates about the exploding U.S. budget deficit. But we know in a bond bull market, budget deficits don't matter. To the point now of when it does, and we just have to look at Japan and Italy to know that with the help of your central banker, it may not matter just yet. And with the Fed buying as many treasuries as they are, we know certainly the ECB has been able to suppress Italian 10-year bonds, which are yielding less than 2%. It did tick above 2% recently, but still below. That with the help of central banks, you could suppress interest rates. To your other point about what does that eventually do to the U.S. currency, that of course is a big debate. On one side of the currency argument is, oh, there's a shortage of dollars, we're running out of global dollars, therefore there's going to be this persistent and constant bid to the dollar that will eventually continue to propel the dollar higher. On the other hand, the dollar does have a relationship to the U.S. budget deficit as a percent of GDP, and the rising ratio should be an impediment to the dollar. So I look at the dollar right now, it's obviously been a beneficiary of the global shutdown and the freeze up of markets and just give me dollars, I want to be safe in dollars. But now that we are headed to this reopening and an economy that certainly relative to March and April is going to look better, because anything will look better than what we saw in March and April. And just by definition, when you reopen things, some people are going to get their jobs back, and you're going to see a reduction in jobless claims. Now, at some point, of course, people are going to see that, wow, this economy is nowhere close to what I'm used to. But for now, the market will focus on that soon, but just not today. So yeah, I do think that the deteriorating U.S. financial situation is going to be a dollar depressant. And you look at the dollar reaction to specific currencies. Let's take the yen, for example. The yen, it's amazing to me how well the yen trades. When you look at Japan and the debt nest that they have, negative interest rates, yield curve control, and now they have essentially unlimited ability to print money, which up to this point has already gotten them to a point where they own 75% of the ETF market, and they own basically half the JGB market and have a balance sheet that is more than the size of the Japanese GDP, and the yen trades really well.
Yeah, so why are people buying the yen right here, Peter, with risk on, a recovery in the S&Ps, with gold going up, the dollar steady? Why are people still looking at the U.S. dollar yen as a safe haven currency?
Yeah, it is quite amazing. And I think also you do have Japan, which still has current account surplus, and I think that also has helped the yen. And I think that there's been certainly a lot of repatriation of yen back to Japan in the midst of this economic downturn, and the yen therefore not being used as a carry trade currency anymore. So I think it's just a combination of things. But to the point is that you throw enough stuff at the yen, you think that it would be just confetti at this point, and it's not. And even take the euro. The euro since 2015, 2014, has really been trading in this sort of 105, 115 range against the dollar. And you've thrown everything at the euro. You've thrown the ECB, which is now experiencing unlimited QE and getting deep with negative interest rates, and also with buying corporate bonds and the complete mess with a lot of European economies and Italy and off the charts debt to GDP ratios. And the euro still can't break a dollar. And I've heard God knows how many breaking dollar calls in the euro over the years, and you still can't break bears. So that tells me that, okay, there's another issue with the dollar. And take the British pound. Obviously the British pound got hammered after the Brexit vote, but I think the pound here is compelling. And once we get the finalization, hopefully, of a deal, now it may not happen this year because of everything that's gone on with the virus and the shutdown, maybe an early 2021 event, but I do expect when those I's are dotted and T's are crossed, the pound's going to have a nice rally. So it's really, in my opinion, the dollar performance on the upside has really been against parts of emerging market. It's been those countries that have major problems that really have also dollar funding needs, like the Brazilian real, like the South African rand and the Turkish lira, and these countries that have major challenges as well as Japan and Europe does, but being an emerging market and being sort of dollar short makes it even more difficult for them. But to me, the ultimate currency, you mentioned earlier, still remains precious metal, still remains gold. And I think its performance of late is proving to be that. And at some point, and I wish I knew when, silver will follow. And obviously silver gets tainted with this industrial metal brush, just as copper does, for an example. And because industrial usage is about half of the demand for silver, but silver still has 4,000 years of money use and treated as such. And I do expect that its historical relationship to gold will resume at some point. I just wish I knew when.
Yeah, timing, and here's a quick look at the gold-silver ratio. So right now, Peter, people could exchange 1 ounce of gold for 112 pieces of silver.
Yeah, and going back to 1975, So pretty much capturing right after we went up the gold standard.
Oh, wow.
That
Okay.
ratio has averaged 60.
Yeah, I remember mean reversion around 40. So this could end up being a very big trade just on a mean reversion here.
Yeah, it's
And
one of my favorite ideas.
is it? So can you trade? I know Steve Volge says you can structure a trade this way with futures. Are you going to trade this by shorting gold?
Just being long gold and silver and the miners is,
Okay.
I've been doing a pair trade, which some people can do but because I'm just bullish on metals generally, I'm just going long both rather than doing any sort of spread trade.
Okay. And for the first time, and I know you and I have talked about it before, the gold shares had dramatically lagged the performance of bullion, Peter, and you talked about that the XAU and other gold share indexes were back to levels when gold was, like 1,000. And now we're finally getting some type of breakout here in GDX and the juniors. A lot of people, I think, do not know that they have to do due diligence if they buy individual miners. Is that part of your process? Because I've had the experience about being right about the underlying commodity and having selected the wrong company, and it was their management or it was their debt, and they didn't participate in a bull market in the underlying commodity. So what's your process for deciding what miners to go with?
For sure. I mean, at the end of the day, mining is a really crappy business. We have to all understand that.
Mark Twain said it was two liars standing over a hole.
Yeah, that's a good analogy. I like that more. Where you have no clue to where the pricing of your end product is going to be.
Right.
Getting stuff out of the ground is extraordinarily uncertain and costly, and God knows where your mine is geographically. That you have to hope that you have a government that is on your side. So you have to really get multiple things right. Now that said, there are, of course, certain miners that are much more well run than others, that are in safer jurisdictions, that you can at least cross off some of those risks and really just hope that a well-run business, even in a tough environment, in a tough business, can benefit from positive pricing environment. And we know for sure right now we have both a positive pricing environment in terms of the price of the product, but also in terms of the cost structures. I mean, I think a lot of these mining companies have got religion since the top in 2011. They shifted from this empire building to actually running their business for cash flow. So all-in sustainable costs have been cut dramatically. Now you have obviously the drop in oil prices that helps a lot. At the same time, you have a rising price of gold. So take GDX, for example, and I'll get more specific onto your real question.
Okay. This is GDX
the last
right here,
time
monthly.
gold was 1,700, GDX was in the 50s. So you can only imagine that in the economic world we live in, where pretty much every single company across the board, maybe outside of supermarkets and food companies, are seeing declines in revenue, that gold miners are actually seeing an increase in revenue. And I think for my clients, it's just easier to own GDX just to get a diversified basket of miners. But for myself, I'll own the individual names, the biggest names, and a junior one here and there.
There's Newmont. Newmont actually even acting better than GDX. Besides, Homestake's gone, so I think Newmont's the king now, Peter, isn't it? Kind of the blue chip of all miners.
Yeah, it's sort of call it the blue chip, and I think Barrick Gold is right behind as well as Agnico. And what you'll see is when the average money manager, when you say average, we're not meaning more generalist, when the generalist money manager that really never touched a gold stock before, or if they did, it was for a very short period of time, when they see that as a new asset class within equities, they'll just buy the biggest names just because it's easier. It's just easier to buy Newmont and Barrick and Agnico to use those names. Now, as you get deeper into the gold bull market, you'll find you'll start to get some catch-up trades and everything underneath that. But
Right. Even the
generalists,
explorers.
yeah, for the generalists, they'll just look for the biggest cap name, then you head
All
back
right.
to the portfolio.
I tell you what, the big debate in S&Ps, and then we'll get back to some currencies, but I have to see where you're at. So the big debate on S&Ps is we've seen the low. We're going to have a retest of the low, or we're going to make a lower low. And right here, we're trading, God, right there at the 61.8% recovery here, Peter. At the minimum, is it possible that we're getting excited on the reopening? And I don't know about you, but I'm not rushing out to a restaurant in a hurry, even though California might be easing. And is it possible that it's going to take a while for some of the fear and the psyche of consumers, which were really the ones holding up the economy, not just because of a loss of jobs and having to wait for programs to get money to them, but just the fear of being infected, that even though we're opening the economy, we're opening it and no one shows up.
Yeah, that is what is most likely to happen. Until you get a vaccine, the threat of getting infected will always be there. Now, obviously, there are things that can bridge us to that in terms of effective therapeutics, and whether it's the Gilead news today that can help get us there, that people can feel comfortable that if they do get it, it can be treated like anything else they may get. And I think that will go a long way. I think you have one thing that you mentioned where people are going to take their time and go really slow and just going back out again. And whether that's into a crowded restaurant or going to, a sporting event or a concert, which obviously is likely a 2021 event with the vaccine, it also gets deeper than that, because this has been such a traumatic experience that you can also assume that even if life is back to normal in terms of everything being reopened, well, I'm assuming that consumers after this traumatic event will, first of all, the unemployment rate will be higher because companies, that restaurant that had 20 people, well, maybe they only hire back 15 or 16 or 17. Well, that's a large percentage of that 20 that are not going to get their job back. I also think that consumers just generally are going to save more. I like to look back now that the S&P is about 2,900. So we've retraced a little bit more than 50% of the decline. So the last time we were at this level was middle of October. So let's go back to what the macro background was in middle of October compared to today. So middle of October, we just got over the repo earthquake, right. and the Fed was now dramatically increasing the size of their balance sheet, which led to, I call it the fluff in the latter part of 2019 in November, December, that you just got this lift off from about 3,000 to 3,400. And then obviously quickly gave that back as the Fed reduced their repo purchases. And then of course this virus hit us hard. But just go back to before the liftoff, where we were at 2,900 in October. The unemployment rate was 3.6%. The unemployment rate, now I'm not even going to count March and April because we know the unemployment rates are exploding, but that's self-inflicted. You have to really look at what would be a normalized unemployment rate when we get out of this, when everything is reopened, because that's really the true measure. Looking at economic data that's awful because you did it to yourself, it's like punching yourself in the head and having a headache. You're not going to analyze why you got the headache. You know why you got it. You gave it to yourself. So to me, looking at the economic data now is really just worthless. The economic data of relevance will be after we reopen. So look at after we reopen. Is the unemployment rate going back to 3.6% anytime soon? No, I say it can be 5 years before we even get back to that. And maybe by 2022, we can get back to, mid-single digit unemployment rates. Let's look at S&P earnings. Back in October 2019, we were looking at $165, $170 of earnings in 2019. it really settled out at about 165. And for 2020, people were talking 180, 185 plus. Well,
Yeah.
at best, obviously a lot of the self-inflicted, we're talking 100 to maybe 130, and maybe a rebound in 2021 of maybe 150. So now we're about trading 20 times 150. And listen, 150 is a shot in the dark. I mean, who knows where we're going to be next year,
Yeah.
but I argue that we're not going to be at that 165, 170 that people were banking on in 2019. So it's a much different world we're in today versus October 2019. Now, of course, you have the Fed and you have this dramatic expansion of their balance sheet, which is essentially doubling. So people have to ask themselves, am I going to buy stocks on the reopening and the Fed backing the markets, or is the attention going to shift sort of like the way that it did in Japan, that, yeah, the Bank of Japan is doing all these things, but the economic fundamentals are really what's going to matter for the valuation of equities. And, you know, they had 30 years of declining PE ratios, notwithstanding the size of the Bank of Japan balance sheet. So at some point, and it could be September, October, I do think the market's going to shift from the Fed and like I said, the direction of the economy from the lows, because as you reopen, it should get better, just mathematically. And it'll shift to the degree. And we'll look around and say, okay, people are still afraid to go out. And if they are, they're only going out for dinner maybe 1 or 2 nights a week instead of 3. And they're not going to a crowded restaurant. And if anything, that restaurant only has 50 to 75% capacity where it was before. And that's when people start to really quantify things. And
Okay,
sometimes
so
we can
go
have
ahead.
an 18 to 20 PE multiple because treasury yields are low. And my response is, yeah, treasury yields are low, but the cost of capital for corporate America is actually much higher, particularly
Yeah.
if you're a high yield company. So high yield, those yields now are averaging about 7.5% to 8% now, whereas
Yeah.
my example of October 2019, it was around 5. So that's what we should be pricing PE multiples on, is the cost of capital for corporate America, and because the risk-free rate in terms of treasuries are obviously being artificially pinned.
Okay, so someone comes to you, Peter, at Bleakley Advisory Group with $1 million portfolio of stocks, and the S&Ps are trading here at 2,900. What do you advise them?
So what we're doing with clients is, well, first of all, we're after giving them our macro viewpoint. And you know, we have a history of not trying to necessarily market time, but obviously be sensitive to this world we're in right now. So can the market go to 3,000, 3,100? I guess, yes, of course. And that's why we'll put some of that on, like a percentage, like maybe 15, 20% tops, but
Okay.
save a big chunk of that money on the assumption that we will head back down again, and we will likely retest those lows again, not because of the circumstances today, but as I said, what the economic circumstances will likely be in the fall when the economy is reopened again, mostly, and I say mostly because live events and big gatherings will not be, but mostly, and I do think schools will be open in the fall. And people are going to look around and see, wow, this is an economy that's much different, and this is going to be a multi-year reparation, call it, in order to get us back to where we were in 2019 and for about 6 to 8 weeks of 2020. And that will be the next challenge for the market. So yeah, maybe over the next couple months, especially if we go through the summer, and if maybe the sun, heat, and humidity is a suppressant to the spread of the virus, and we could get a respite here, and maybe we get some good antivirals.
Yeah.
So maybe the next couple of months the market will be okay. But come fall, when not only the virus comes back, but we all look around and see what the state of the economy is, you know, that will be the next challenge.
All right, so you are looking for another second wave, because in the Spanish flu era, there was more than one wave. The first wave dissipated after, actually, I think helped end World War I. People were too sick to fight. And then we had Armistice Day, and people thought the worst was behind us. And then we had the second wave, which was even more virulent.
Yeah,
You
the
think that
second
we're
wave,
going
I think we'll be much better prepared for it. So
to, okay,
I'm less worried about the second wave than what we've already experienced.
okay. All right, so I know that over the years that you and I have been talking, and Face is a little over 3 years old now, so we've had quite a few conversations that you always gravitated towards Asia. You felt, this was where the growth was going to come. And when you didn't want to be in U.S. assets, you were talking about being in emerging market debt. So I thought, since you had brought that up so many times, does the currency of the underlying debt of an emerging market economy play into the equation of total return for you? And since the dollar has been strong and some of the emerging economies have had more problems because they have a lot of dollar denominated debt, would it help if the dollar peaked and emerging market currencies began to appreciate again?
Yeah, no question. And I think you made the distinction for me is when people talk about emerging markets, I specifically am really bullish on emerging Asia. Now,
Right.
I
Okay.
consider South Korea emerging, but it gets thrown into that bucket. I don't consider Singapore as thrown into that bucket. You go to Singapore, it's as advanced as any country in the world, but it does get included in emerging markets and not just emerging market bonds, which yes, you do need to get the currency right if it's going to be local currency denominated. But to me, I also find hugely attractive Asian equities as well. I think when you look out over the next 10 years, after the dramatic underperformance over the last 10 years, that I argue that Asian stocks, and I include China, of course,
Right.
and I also include Japan. For decades, we heard Asia ex Japan, right? That was, they created different equity buckets. You had Japan, and then you had Asia ex Japan. Well, I think over the next 10 years, even Japanese stocks are going to be a beneficiary of the outperformance of Asian economies relative to the rest of the world. And for sure, Asian economies are dependent on the rest of the world. They're hugely dependent on Europe and the U.S. But I think what you'll see over time is they'll become less dependent, and that they'll become more dependent on each other. And China itself will become a rising consumer economy and less dependent on trade with the rest of the world. And that will benefit those areas of the world. And you look at some of these currency-adjusted Asian ETFs, and take Singapore, for example, a country that I'm very bullish on long-term, particularly with...
You have a symbol for that ETF?
EWS, Eddie Willie Sam. You look at, and as a beneficiary of money coming out of Hong Kong.
What was it again? TWS?
EWS, Eddie Willie Sam.
Okay, got it.
This ETF has essentially done absolutely nothing over the past 10 years. But you can buy it here with a 5% plus dividend yield, almost 6, and a PE ratio 11, 12 times. And to me, a currency that is very attractive relative to the dollar. So I would argue that over the next, it is heavy in the banks, in the 3 big Singaporean banks. So keep that in mind. But
there's a Singapore dollar right in front of you.
Yeah, so I'm positive on Asia over the next 10 years relative to the U.S., certainly relative to Europe. And I acknowledge all the problems in China right now, the huge debt load, the more authoritarian approach that Xi Jinping has taken. But, there's still family in China wants to live the life that we do here. And they work hard, and they want to travel, and they want to consume, and they want to go to their steakhouses, and they want to live their life. So we cannot underappreciate the global presence that the Chinese economy is going to have for many, many years to come, and the help that's going to give to other countries in that region.
Another great interview, Peter. Anything that you'd like to wrap it with? All of these currencies, there could be some amazing opportunities in some of these currencies, because if trends are changing, it's embryonic. if they are changing here.
Yeah, for sure.
agree?
And I do want to look at, particularly over the next couple months, that if we start to shift the focus to a reopening and less of fears of this economic shutdown and collapse, that it's going to be a good test for the dollar. And that did the dollar rally in March and April for the sole reason that it was just this flight to safety, or did it rally because there was a strong foundation for it? And we're also going to see a good test of this shortage of dollars again that I hear all the time from people, whether that's going to be the propellant to the dollar. I'm more skeptical. I'm cognizant of the shortage of dollars, and for certain borrowers that is very much the case. But to say that there's this blanket shortage of dollars is not necessarily the case, because in certain countries there's enough dollar reserves to deal with dollar-denominated debt, whereas in other countries there is a shortage of dollars relative to that dollar-denominated debt.
Okay. And I'm looking around. Steve Volge, are you with me? Any questions that we could put
Absolutely.
to
I'm here, Coach.
Okay. Any questions you want to put to Peter or the attendees?
First of all, yeah, we do have a couple of questions. One of them, I think, because you mentioned, Mr. Bukvar, you mentioned Singapore. So there is a question if you could say something about the rates in Singapore.
Well, interest rates are,
yeah.
in terms of interest rates, I guess.
The rates, REITs, the
REITs.
residential.
REITs.
Yeah.
REITs.
Oh, yeah, you call it REITs, sorry, yes.
Yeah.
That's Greek for REITs, right?
Indeed.
Singapore REITs, I think they've obviously gotten beaten up, particularly like office REITs, but I find some of them very attractive. I mean, there's some really, particularly industrial REITs in Singapore. There's some healthcare REITs in Singapore, to me, that are attractive with great dividend yields. And I do think Singapore is going to be a great beneficiary of not just money flows, but population flows because of what's going on in Hong Kong. And that will benefit some of these Singapore REITs. Now, some of these Singapore REITs, of course, also own properties outside of the country. They own properties in Australia in particular. But I think Australia is going to be a beneficiary of this growth in Asia over the next decade as well.
I don't find it a coincidence. Mark Yusko, in essence, mentioned the same thing, that he sees a lot of value in some of the emerging markets. You're telling us the same. I pretty much know that Peter Schiff that follows is going to, is going to be talking more or less about the same thing. Does this also have with your viewpoint in what the dollar is going to do going forward? Because we definitely know that a devaluation of the dollar is going to help a lot of the emerging markets. As you well mentioned, of course, Singapore and Hong Kong, are not exactly emerging markets, but do you think that that's going to be one of the catalysts for emerging markets to overperform?
I do. I mean, let's look at Asia right now. And you want to talk about an area of the world where the economy is still essentially open. And yes, Singapore's had a recent setback, but a lot of that really was segmented in the dorms that house a lot of the foreign migrants. But Singapore, for the general population, did an amazing job in containing this virus. South Korea, we know, after falling behind the curve rather quickly, caught up extraordinarily well and never really closed down. Hong Kong, I think Hong Kong has less than 10 deaths in the entire city of 7 million people. And they never really shut down. The restaurants stayed open. Now, growth, of course, obviously got hit hard. But when you want to talk about which area of the world is going to rebound the quickest on this reopening, it's going to be Asia, because they never really closed. And they had their arms around this a lot better than the rest of the world, because they experienced something like this, not to the same extent, but they experienced SARS. For them, wearing a mask is normal protocol. I listened to the Las Vegas Sands conference call last week, which I am a shareholder myself and clients, and the COO, based on Las Vegas, and most of their business happens to be in Macau and Singapore, made the point that we're like shell-shocked here in the U.S. We've never experienced this, of course. So wearing a mask and having to do the distancing and all this stuff this just has overwhelmed us. But in Asia, they've been through this. They are used to this. That's why they've been able to deal with this. Still a very difficult situation, still a very virulent virus, but they've been able to live through it without having to collapse and shut down their entire economies. So they're going to rebound a lot better. That should help their currencies and, to your point, help emerging Asia as an asset class, whether it's equities or credit.
Okay, thank you very much.
So Peter,
Thank you very much, guys.
you could follow Peter at pbookvar on Twitter, and here's his website, everyone, right on the screen, the book report, and you could subscribe to it, and you'll see Peter on CNBC, and I'm sure he's going to become part of your intelligence gathering in the weeks and months and years ahead. He is for me. Thank you, Peter, very much for being with us at the summit. I'd hang out on a mountaintop with you any day, partner. Thank you very much for being with us. Our next guest.
Go ahead, Coach.
Has he arrived?
He seems to be here.
Okay. Our next guest is Peter Schiff.
There he is.
Whose reputation precedes him. Peter is well known for being a hard money advocate for many years. I might even be a bit older, but I've been following Peter's work for a long time. He's the CEO of the Euro-Pacific Capital Inc. group. And Peter, welcome to our summit, and want to thank you for joining us. And you have to be feeling pretty good with what's happening to your favorite asset class, the precious metals, and the miners. And the miners. And this is the second time I've spoken to you. I spoke to you many years ago on FX Street. So welcome to our summit, Peter.
Well, thanks for having the summit and inviting me to be a part of it. But as far as, gold and the mining stocks, what I'm happy about is that they haven't gone up yet, because it still gives me an opportunity to get more people into this trade. A lot of people should be, considered it very fortunate that they have the opportunity, given everything that has already happened, to be able to buy gold at the price that it's at today. And in particular, to be able to invest in mining stocks. This is really a gift horse for those of you who do not already have, any position, let alone an overweight position, which you should have in this sector. And this could be one of your last opportunities to do this.
Okay. Does that include silver miners too, Peter? Or, do you have a little different view on the fact that with the gold-silver ratio trading over 100, that silver is undervalued for a reason, or it's not a justified reason and will eventually revert to the mean of maybe more like it used to be when you and I didn't have as much gray hair, when it was trading about 60 to 1, 50 to 1. You think that's possible again?
Yeah, I think it's more probable than just possible.
Okay.
I think things have a tendency to revert to the mean. So I think that will happen. As far as why silver is so cheap right now relative to gold, look, a lot of things are very cheap right now. Look at the price of oil relative to gold. So gold buys a lot of things right now, other commodities. But I think it has to do with the fact that you don't really have the psychology of a bull market. I think people, investors who are looking at the price of gold still don't get why it's rising and how much higher it's going to rise. So there's still a lot of skepticism of the rally. I think there's a lot of expectation that it's temporary. Now, maybe it's just related to COVID-19. And, when this is in the past, the gold's going to sell off. So I think everybody's kind of been bracing for the gold market to sell off. We've really been climbing a wall of worry ever since gold really bottomed out in December of 2015 at about 1,000, 1,050 when the Fed first started raising rates. Everybody kind of expected the price of gold to fall. And instead, it's been rising steadily against that backdrop. It's climbing this wall of worry. So I think once gold really takes off, once we take out those 2011 highs, around 1900, and the bull market really kicks into another gear, I think silver is going to participate and ultimately overtake gold as far as percentage gain.
So patience, patience. Don't wait to buy silver. Buy silver and wait.
Yeah, I mean, you should buy. I think it's a good buy.
Yeah.
I think it's, as a commodity, as an industrial metal, as a precious metal, a monetary metal, there's a lot of compelling reasons to own silver. And, you look at the alternatives, what else do you have as money? I mean, do you want to just own dollars or euros or yen? I mean, look at the rate that these currencies are being debased, particularly the US dollar right now. There's no interest that you can earn on any of these currencies anyway. So you might as well own real money. The yield on silver is the same as the yield on dollars, except that they're not mining silver as fast as they're printing dollars. So you have a lot more purchasing power that you'll be able to store in silver or gold than in dollars. In fact, if you're in dollars, you're about to have your purchasing power robbed. I mean, we're going to see probably one of the biggest losses in the purchasing power of the dollar in the shortest period of time that we've ever seen in the history of this nation.
Let alone, Peter, do you think that this could be used, COVID could be used as an excuse in the war on cash, because the using cash can transmit the virus? We've already heard that they were burning currency in China. Is Paul going to say, turn in your $100 bills? We're gonna get rid of cash. It'll be all debit card.
Look, COVID is going to be used as an excuse for a lot of things. I mean, it's kind of like a catch-all. Any problem that you're having, blame it on COVID. If you're a company and you were going to have trouble, your earnings were in trouble, or you had too much debt, blame it on COVID. If you're a state government, municipal government, you got underfunded pensions, you got all kinds of obligations, you're broke, just claim it's COVID's fault and ask for a bailout. The government could just... Look, we were going to be in a recession anyway, but now we could just say, oh, it's not because of bad monetary and fiscal policy. It's all because of this virus, and therefore it's nobody's fault, so don't blame anybody. And of course, the government uses COVID and the hysteria around it, whether it's real or just drummed up by the powers that be, but the government is using this emergency the way it typically uses emergencies, to assert more power and to diminish individual liberty.
Do you worry? And I'm going to introduce you to my colleague, Steve Volge. He really admires you, Peter. He's wanted to speak to you for a long time. I think he even has a poster of you in his office.
He's joking. What is a reality, Mr. Schiff, is that I'm a Greek economist, but we are in the same school of thought. I mean, I'm an Austrian economist as well. We are probably a rare breed. We still believe in sound money and fiscal responsibility. One thing I wanted to add to your introduction, people that haven't seen your mortgage banker's speech in 2007, in my opinion, they should definitely do it. It should be taught in universities in economics. It should actually give credits. I think it's one of the best speeches I've ever seen.
Thank you. By the way, I did that in 2006. It was around November.
Yeah. And I remember the crowd and, how they took everything, you said, like, it's, the weird guy that's coming here and is trying to sell us on, a story that's far away, much decoupled from reality. Now, I want to touch on a few things that you've already spoken about. Because I'm also an Austrian economist, so I know the counter arguments as well, and I'm pretty sure the people would want you, making some points on them. We are seeing central banks double down on everything. Interest rate policies back to zero, monetary easing, trillions of dollars. Despite all that, the dollar is still strong. And for the gold thesis, the silver thesis, the minus thesis to play out, we should eventually see the dollar continue its long-term downtrend lower. When do you think that's going to happen?
Well, first of all, I don't think the dollar is strong. The price of gold is rising. In fact, it hit new highs over the past month or couple of weeks. And so if the gold is rising in dollar terms, then the dollar is weakening. The dollar is losing purchasing power. The way you measure the purchasing power of a currency is in terms of gold, particularly the US dollar. Now, the dollar has gained some value relative to other fiat currencies, but those fiat currencies have simply lost more value than the dollar. So the dollar is not strengthening. it's weakening less than other currencies that are weakening more. But I do agree that ultimately the dollar is going to be the weakest of the major fiat currencies. And, you know, if you compare the dollar strength in this crisis to the dollar strength in the '08 financial crisis, and this is another financial crisis, it's just a larger one, but the dollar had a much bigger rally back then than it's had now. And in fact, if you look at gold, right, gold dropped about maybe 30% early on in the '08 crisis. This time around, it only fell about 15% and then quickly made a new high. It made a new high a lot faster this time than it did in '08. And so to me, that really shows you that the dollar is much weaker today than it was back then. And after this temporary rise, just like we had a temporary rise in '08, the dollar is going to roll over and collapse. But I think the big difference between the dollar now and the dollar back then is the dollar eventually stopped falling around 2010, 2011-ish, because the Fed was able to fool the markets into believing that it's 0% interest rates and quantitative easing, that the policy was a success. But not only that it was a success, but it could be ended, that the Fed had an exit strategy and that these emergency measures would be brought to a close, that the Fed was going to normalize interest rates and shrink the balance sheet back down to where it was before the crisis. And so that implied a much tighter monetary policy, the Fed selling off treasuries and mortgage-backed securities, shrinking money supply, raising interest rates back up to 4 or 5%, where they had been prior to the crisis. And so the markets, being forward-looking, the Forex markets began to factor in that return to normal in the dollar. And so the dollar began to rise, and it had a very big rise in 2013, 14-ish, as the market started factoring in what the Fed was claiming it was going to do. Now, back at that time, I was stating that it was impossible, that the Fed could never do what it was claiming, and that the markets were foolish for believing it. I said that the Fed would have to abort its plans to normalize rates, and it could never shrink the balance sheet. If it tried, it would have to give it up. And I said eventually the Fed would go back to QE, and that QE4 would be bigger than QE1, 2, and 3 combined, and that the Fed would be back to zero. Now, that's where we are. Now, people have to, separate the bubble from the pin here. The coronavirus is the pin, right? The problem is the bubble that pin pricked. And of course, the bubble was deflating before it found that pin, because last year, 2019, before we had COVID-19, the Fed already fulfilled my forecast. It abandoned its feigned attempt to normalize rates. It cut rates 3 times in 2019. And the Fed went back to quantitative easing, even though it tried to pretend that it wasn't QE, it was doing quantitative easing. Now, once the coronavirus came and it accelerated the onset of this depression, then it accelerated the Fed's return to zero, and it really ramped up QE4 to the size that I forecast it would be. Now, once the dollar starts to fall, and it will, this time there's going to be no stopping the decline, because nobody is going to believe that the Fed is going to normalize rates or shrink the balance sheet. If the Fed couldn't shrink a $4.5 trillion balance sheet, what hope does it have of shrinking a $10 trillion balance sheet? If the Fed couldn't normalize interest rates when the national debt was 20 trillion, how is it going to do it when it's 40 trillion? And so once people realize that this is a permanent policy of endless money printing and debt monetization, and that the Fed has no ability to ever fight inflation with actions, it can simply talk, then the dollar is going to fall through the floor. That's going to happen. And the price of gold obviously is going to go through the roof.
Absolutely, there is no question about it. And a lot of people would say that Peter Schiff predicted 100% what's going to happen both in the previous crisis and this one. But despite being right on all his assessments of what's going to happen with the economy, the markets didn't actually play out in the way he expected, you expected in this case. So what makes you think that the market can't be fooled again? Yeah, not in believing that the Fed will normalize, because I know that, I mean, I assume that everybody understands now that this isn't happening. But what if they keep believing in the less dirty shirt theory that, okay, the rest are easing as well, US dollar is still the world's reserve currency, and, you know, we're already seeing stock markets having rebounded like 70% from the low.
Yeah, you know, there's a lot of what ifs in there. And, you know, I think what I got wrong initially, you know, back in 2005, 6, when I was forecasting the financial crisis and the bursting of the housing bubble and the Fed's and the government's reaction, I assumed that the markets would be smart enough to figure this out. But I was wrong. I mean, the markets got fooled and the Fed was able to inflate a bigger bubble than the housing bubble. Right? I didn't think that they would get away with it. I thought they would try. I just didn't think they would succeed. Now they did. Now, just because they were able to blow up a bigger bubble than the dot-com bubble doesn't mean they're going to blow up a bigger bubble or even a bigger bubble than the housing bubble. Doesn't mean they're going to be able to blow up a bigger bubble than the one that just popped, which a lot of people had described as an everything bubble. We had a bubble in stocks. We had a bubble in real estate. We had a bubble in bonds. I mean, you name it, it bubbled up based on an unprecedented amount of cheap money. I mean, the mistakes that were made because of the monetary policies of Bernanke and Yellen and now Powell dwarf the mistakes that were made as a result of Greenspan. I mean, Greenspan, was like a Paul Volcker compared to what followed. I mean, he had interest rates at 1% for like a year and a half, and then it took him another year and a half to get back to 5, wherever he got. But what followed was unprecedented monetary excess and recklessness. And so the mistakes, the misallocations, the malinvestments dwarf what was made then. And I think it's impossible to blow up a bigger bubble than that one, which is required, is impossible. The Fed is going to try, will overdose on that stimulus. And, the dollar just has to collapse because it didn't happen last time. You know, we dodged that bullet. Doesn't mean we're going to dodge it again. In fact, I think we dodged a bullet only to step on a landmine. And this is going to be a much bigger collapse in the dollar and in the U.S. economy than the one that should have happened following 2008, right? Because the problems got so much worse as we kicked the can down the road. So we would have been better off had we taken our medicine then when we weren't nearly as sick. And now the medicine is going to be much more a bitter taste.
We'd be coming out of it now, wouldn't we, Peter?
But we would have come out of it a while ago. And, that's why the economy is so ill prepared for this coronavirus. I mean, we were very sick before the virus came around. See, the reason that it's such a big deal is because nobody has any savings. Everybody is levered up. All these corporations have been, using all this cheap money that they got from the Fed, and they've been buying back their overpriced stock, but they're all levered up. U.S. governments have taken advantage of the cheap money, both the federal and the states, to go deeper and deeper into debt. It's enabled all this profligacy to continue. Had the Fed let interest rates go up, governments would have been forced to cut spending and reduce these debts. But they didn't have to make those difficult choices because the Fed gave them an easy way out. And then the same thing with individuals. American households are living paycheck to paycheck thanks to consumer credit. And you have record auto loans, credit card debt, student loans. People have mortgages, second mortgages, home equity loans. So no one has any money. Then all of a sudden we get this coronavirus and that disrupts everybody's incomes. And now nobody can pay their debts. And so we have this huge financial crisis as this whole house of cards implodes. If we had a real economy without cheap money, if we had real savings, then companies could go a few months without revenue. They would have, the balance sheets to do that. To the extent that they needed money, they could tap into the private sector for that money because we'd have ample supply of savings. individuals can afford to be laid off for a few months. They would just use their savings to cover their rent or their mortgage or whatever. But we don't have any of that. Nobody has that. Thanks to the Fed, we've been living in a bubble, and that bubble has popped. And that's why people still don't get it. Everybody expects that, well, we're going to return to what we had before the coronavirus when it's over. That's impossible. We can't reflate that bubble. The best that we can do, right, is recover from a depression to a severe recession. There is no going back to what we had before the coronavirus, because that bubble has been pricked and the air is not going to come back into it no matter how much money the Fed prints.
So, Mr. Schiff, what do you foresee being the end game to this unprecedented situation? As you said, yes, we see the law of diminishing returns. I mean, they have to throw in more money and more money every time to rescue the economy. At some point, it's definitely going to fail. What comes after that? The change of monetary system?
They're not rescuing the economy.
Yeah, that's true.
They're preserving the bubble. The bubble is the problem in the economy. The way you rescue the economy is you let the bubble deflate. You let people lose money. You let asset prices come down. You let interest rates go up. You let the economy restructure so that we can have a viable, healthy economy again. But the road from where we are to where we need to be is a very difficult road. And it's one that no politician or no central banker wants to travel, especially on their watch. So we constantly make the mistake of worsening the problems and interfering with the free market's attempt to actually solve those problems. But, you know, the other big difference now is that the free market and capitalism are going to be so discredited by this election that's coming up in November. And even the Republicans now have abandoned any pretense of believing in fiscal responsibility or capitalism. And every Republican still thinks that everybody should be bailed out, that everybody should get a check from the government, and no one cares where the money is coming from. Everybody is now bought onto the idea that the government has a pile of money and that can just dole it out to whoever needs it, and there's no consequence, that we all believe in a free lunch. Well, I think if the November election comes down to which political party can deliver the most free stuff, the Democrats are going to win that debate every time. And so we're going to make a sharp turn to the left officially. Trump I think will be out at the end of this term, and we're going to have a Democratic president. And I think the Democrats are going to take back the Senate, and so have the House and the Senate. And they're going to have carte blanche to dramatically increase the size of government, which has already increased massively under Trump. And the deficits, which have already exploded under Trump, are going to go through the roof. And all of it is going to be paid for by the Fed, which means none of it is going to be paid for. It's massive inflation. Where all this is going to be funded is through a destruction of purchasing power. See, the government has two ways of paying for its spending. It can legitimately tax us and take our money away from us and spend it, or it can create the money out of thin air, which it's doing now, and then steal our purchasing power and spend that. But one way or another, government must be paid for. And the most expensive way to pay for government is the way we're funding it now, when the Federal Reserve prints the money. Inflation is much more expensive. It's much more an onerous tax than a legitimate taxation, which is why people need to be buying gold and buying these gold stocks and getting out of the dollar. Because what they're really doing is avoiding that inflation tax, because this is going to be a massive bill that Americans are going to be stuck with. And anybody around the world who's been foolish enough to hold on to dollars, they're going to be stuck with this tab. All the bailouts, all the stimulus are going to be paid for through a loss of purchasing power in the U.S. dollar.
And do we have a hyperinflationary stage, Peter? And when does that kick in? And some people have a definition of hyperinflation at about 26% is where they believe we've broken into that territory. Are we going to have wheelbarrows full of dollars and people dump the dollars and seal the wheelbarrow?
Well, I don't know. I think the odds of that type of end game are much higher now than they were in 2008. I mean, I've always thought that was a worst case scenario, but I think it's actually a more probable scenario now because the only way to avoid hyperinflation is the Federal Reserve at some point is going to have to admit that everything it's done in the past was a mistake, right? That all the QE, all the 0% interest rates were wrong. So it's going to have to fess up to its past sins. And then it's going to have to finally do what it should have done but was afraid to do in the past. And that is let interest rates go to a market level, which is now going to be much higher than that market level would have been had they allowed that to happen, in 08 or 01 or, in the past. And because we have so much more debt now because of how low they kept interest rates and for how long, the defaults are going to be much bigger. And it's not just going to be private sector defaults. We're going to see government defaults. And I'm not just talking about states and municipalities that can't pay. I'm talking about the U.S. Treasury that can't pay the interest on the national debt or can't repay the principal. And the U.S. government not being able to make good its unfunded commitments to make Social Security payments, Medicare payments, payments for government retirees. All of these phony promises are going to have to be reneged on. And all of the people who have loaned money to the U.S. government are going to have to deal with reality that the U.S. taxpayer is too broke to make good those IOUs. So if the Fed does the right thing to prevent hyperinflation and lets interest rates go up and then lets everything collapse, and there's no bailouts. See, if the Fed is shrinking the money supply, nobody can bail out anybody. And of course, once it's the U.S. government that is broke, obviously it can't bail anyone out when it's broke itself. So we're going to have to finally swallow this medicine after years and years or decades of avoiding it, and it is going to taste worse than ever. The question is, do we have the political will to actually go through this type of default where politicians, have to slash government spending, default, let prices collapse, asset prices collapse, and go through this horrific economic downturn? But if we don't have the guts to do that, then we will have hyperinflation because there's no way to stop the inflation once it's running amok like that. Once there's a loss of confidence in the dollar, how do you reinstill that confidence? You can't do it, right? So unless you let interest rates go way up or go back to a gold standard, but the minute we go back on a gold standard to reinstill confidence in the monetary system, then the party's over. You can't print gold. Right. And so then the government has to start living within its means again. And that means a massive collapse. And our whole country, our whole economy has been a gigantic bubble. It's not just the government that lives beyond its means. It's America. It's American individuals. Everybody is just borrowing and spending. And the whole world has been making this possible by supplying us with the goods that we don't produce and loan us the money that we don't save. And, the flip side of this is when America has its day of reckoning, the rest of the world is going to experience the opposite, jubilation. It's going to be relief for the rest of the world to no longer have to live with this system where everybody else has to live beneath their means to support the United States and to maintain the U.S. dollar as a reserve currency. That necessitates that the world collectively has to produce a bunch of stuff that it doesn't get to consume, and it just supplies Americans with all this stuff for nothing. And a lot of capital, a lot of savings that could otherwise have been invested productively outside the United States instead is squandered by loaning it to the U.S. government or Americans so that they can buy stuff they can't afford.
Okay, so Peter, I have 100 ounces of gold, and I have 2 silver coin bags that I'm doing curl splits to build up my arms so I could be a great survivalist. And I walk outside my door in San Diego, and we have all this social unrest. What good, besides being able to barter with these metals, is it going to serve me? And where should people think of going to have a haven and watch this on television instead of being in the middle of it?
You're talking about where should they physically move?
Yeah.
Well, I mean, I don't know. I mean, I'm in Puerto Rico.
I know.
I'm here.
Were you there for the hurricane?
Well, I was living here. I wasn't on the island.
Oh, okay.
I left the island.
Yeah.
But I'm here to avoid the hurricane of the IRS. And
Okay.
so, the natural disasters aren't nearly as bad as that man-made disaster. But look, obviously, I think living out in the suburbs might be better than, or in the country, even beyond the suburbs, maybe better than living in a major city. And, I've been telling people even before the coronavirus, but now in particular, to stock up on stuff, while it's still there. So you don't have to barter. If you have a good supply of products that have a long shelf life,
Yeah.
they're only going to get more expensive. Not only may they get scarce where you have to wait in line to buy them if they're available, but they're going to get more expensive. So you're going to get a better return on the stuff you buy in the supermarket than the stuff you get at the stock market. So you can load up on merchandise. But yeah, having silver coins is going to be a positive in case you do run out of stuff. The worst case might be for inflation. And this is something that I think will probably happen. But once the dollar really collapses and prices really start to go up, governments have a tendency to scapegoat, right? The government never wants to accept responsibility for inflation. All inflation is caused by the government, is caused by the Federal Reserve. Human behavior, greedy entrepreneurs, capitalists, labor unions, they don't cause inflation. Inflation is made by the government. But the government always wants to blame other actors. And one of the ways they try to fight inflation is with price control. So they try to say, we're going to limit the ability of stores to raise prices, and that's going to stop inflation.
They're already doing that.
That has failed every time it has been tried in the past. That's the only certain thing.
Yeah, well, they think inflation is rising prices. It's not. Inflation is an expansion of the money supply. Prices just, end up going up as a result of that. But the minute you try to cap prices, all you do is create shortages of the goods that are subject to price controls.
And black markets.
And then instead of rationing goods based on price, we ration it based on queuing up in long lines and reducing how much you could get. But then what happens is if you really want to get something, you have to buy it illegally on the black market, right? That's where all the good stuff is going to be available. And to the extent that you're selling something illegally on the black market, you'll probably want to sell it in exchange for something like silver, where government won't know that you're making the sale because you're breaking the law. And also, if the dollar really starts to lose value quickly, merchants aren't going to want to accept dollars for their goods because then how are they going to buy more goods if the dollar keeps falling? So they want to be paid in a medium of exchange that will preserve its value long enough for that merchant to turn around and buy something else with the money. And so it's going to be a lot safer to accept payment in silver than in just rapidly depreciating pieces of paper.
So, Mr. Schiff, in essence, we're talking about a likely change in the monetary system. So I know you've had a lot of debates about that. Let me say in advance that I'm not pro-crypto. I still don't see the intrinsic value there. But for example, we had 2.5 hours ago, I'm pretty sure you're familiar with Mark Yusko. He's a great guy, an actual asset manager. He's actually the partner of Anthony Pompliano. You've been on his show a couple of times. Yeah. So there are people like Mark, which also believes in sound money, that they think that the way forward in a new monetary system is going to be using the new technology that we've seen in cryptos. And hence, when things show like they might be moving that way, even the existing cryptocurrencies like Bitcoin, Ethereum, etc., might actually gain a lot in value.
Well, I don't think that any of the cryptocurrencies, including Bitcoin, would qualify as sound money. I don't think there's anything sound about any of them. Is it possible that there can be some speculation surrounding those currencies? There has in the past that people may buy them for a while and the price may go up, certainly. But they're not sound money. And what I think is going to happen when this fiat system implodes is we will return to sound money, which is gold, right? So before the dollar was the world's reserve currency, currencies were backed by gold. And I think that they will be backed by gold again. In fact, the reason that America was able to convince the world to moving on to the dollar standard was because the dollar itself was backed by gold and redeemable on demand in gold at a fixed exchange rate. And so what that did is it enabled foreign central banks like, the Bundesbank or, the Bank of Japan or the Bank of England, instead of holding gold to back up the pound or the Deutschmark or the yen, they could hold U.S. treasuries, which earned them interest, but they could convert them at $35 to an ounce of gold whenever they wanted to. So in effect, their currencies were still backed by gold, even though they were using the dollar as an in-between between them and gold. But, we severed the link to gold and defaulted on our promises in 1971. And ever since then, the dollar is just a piece of paper. But it's been the reserve currency, which has been a major problem for the world. And I think once the dollar collapses, the world is going to go back to gold as the primary reserve for fiat currencies, which is going to be great for the world because it's going to impose a much higher degree of fiscal discipline all around the world, especially in the United States, but every place else. But since the United States has been the biggest beneficiary of this monetary system, we have enjoyed the benefits of being able to write checks that nobody cashes, so we can live beyond our means. We can consume without producing, and we can borrow without saving. When we go back to a sound monetary system, in the short run, the most pain will be felt in the United States. We have the biggest phony economy that is completely dependent on the world accepting our paper in exchange for their stuff. And when that comes to an end, we have a massive day of reckoning. The biggest concern that I have is the government, rising and becoming more powerful and us becoming more of a totalitarian state, because we're going to blame this collapse on capitalism and a lack of government regulation, which of course is the opposite. If we could stick with capitalism or re-embrace capitalism, we could overcome this in a matter of years. Capitalism is a very powerful system, and it would work better now than it did in the 19th century. As great as it worked back then, if we can only re-embrace it with 21st century technology, capitalism and sound money can do even more wonders in this century than it did in centuries past. But the problem is, if we don't do that, if we end up with a totalitarian regime, then there's going to be no recovery.
So far, to be honest, that's what we have been seeing. I have to openly admit that there was also an ulterior motive to the previous questions. I asked Mark Yusko here on the show he would be interested in going through a debate with you about that, because in essence, the two of you have a very common understanding of how the economy works. I mean, he was mentioning the exact same things as you are. He was mentioning that countries like China and Russia are moving away from cash and they're buying gold, for example, because they know that commodities and, real money like gold are going to be, next day's thing once again. But you disagree on that part. What is the future of cryptocurrencies in our monetary system in the day ahead?
I just don't think, look, fiat cryptocurrencies with no actual backing have no future because they cannot work as money. They cannot be a store of value. They can't be a unit of deferred payment, or even they don't even work very well as a medium of exchange or a unit of account. They don't satisfy the criteria of money. That's what everybody in the crypto community overlooks. They don't think that money has to have any value. It does. Yes, fiat currencies don't have value. That's one of the reasons they don't work. But legitimate currencies, before currencies became fiat, when they were legitimate currencies, they were backed by real money. The real money was gold. What gave gold its value as money? It was its value as a commodity. It was what you could actually do with gold that made it so valuable, what it could do as a metal. It's the fact that it's the best conductor of electricity in the world, and the fact that it's used for jewelry or dentistry or aerospace or all of the characteristics. Gold possesses characteristics that other metals don't have. It is the most useful metal on the planet, probably in the universe, but it's the most useful metal that we have. But then it has other characteristics that make it such a good money, in that it doesn't decay, it doesn't tarnish, It's malleable, it's divisible. I mean, it has all these properties that Bitcoin copies. And yes, I recognize that Bitcoin has a lot of these properties, but at the end of the day, it doesn't have the single most important quality that made gold money in the first place, and that's its use as a metal, right? I mean, the world has used other things as money. Other commodities have been money because they have useful. Cattle has a use. You could eat it. Oil has a use, but they're not good money for all kinds of reasons. It's not good money. Gold is good money. Now, look, cigarettes have been money, and even in prison, cigarettes, they were money in Europe after the Second World War. The GIs used them as money. In prisons, they use them as money. But why are cigarettes valuable? Because people smoke them. You get the enjoyment of smoking it. But even if you don't smoke yourself, somebody in that prison smokes. It's because you have a bunch of smokers who have no access to cigarettes because they're in jail. That's what gives those cigarettes value. If nobody smoked in the prison, then they would be worthless as money. It's because of the intrinsic value of the cigarette itself. Now, then once, you can break them up, you can exchange with them. There are other characteristics, that make a pack of cigarettes kind of like money. But it's the fact that people want to smoke them. And so Bitcoin has no value. Yes, I can give it to you. You can give it to somebody else. But at the end of the day, you can't do anything with it. There is no real world demand for Bitcoin, which means the price can implode at any minute. How could you have confidence in the future value of Bitcoin when there's nothing that you can do with Bitcoin? And there's never been anything you can do with Bitcoin. You know that there's all sorts of real life uses for gold. So gold is going to maintain value because people are going to use gold. But you don't use Bitcoin. I mean, people use it now to speculate. People buy Bitcoin because they think the price is going to go up. But if you don't think the price is going to go up, then no one's going to buy it. It's just going to go down. And then once it really starts to fall, then everybody wants to sell. And there's no natural buyer because there's nothing you could do with it.
You briefly mentioned crude oil before. We all know what happened with people getting squeezed with minus $37 of barrel price. We've seen that also trigger what was already showing like it would happen, which is the US government in essence jumping in to save the shale industry. Where do you think oil is going from here?
Well, in the short run, obviously, if we're not using as much oil, we're not, factories aren't producing as much stuff. People aren't driving back and forth to work. People aren't taking vacations and flying in planes. The cruise ships aren't running around and using up oil. So obviously in the short run, the price of oil is under pressure. But in the long run, the price is going much higher for two reasons. One, a lot of the capacity is going to come out of the oil industry, oil market. So production going forward is going to come way down, especially the higher producers like the U.S. shale oil producers. A lot of these rigs
are getting bailed out, though. Those are getting bailed out.
Well, they're not going to be producing. I mean, maybe they'll take the bailout money, but they're not going to keep producing oil and losing money. So I do think there's going to be a big contraction in that industry. But eventually, when the coronavirus is in the past, there will be more energy consumption. And so you're going to have more consumption against a backdrop of less supply. But when the U.S. dollar finally falls to the extent that I believe it will, especially against a lot of these emerging market currencies, that is going to really stoke an increase in demand for energy in those countries that are experiencing a gain in their currency relative to the dollar. And so I think in that environment, we could see a boom in the price of oil. And so I think ultimately that's what's going to happen. You're going to see a weak dollar and in a very, very strong oil market. Just when we turn the corner is hard to say, but definitely watch the foreign exchange markets, because once the dollar really cracks, which it hasn't done yet, but once we see it crack technically, then oil prices are going to be moving up.
Would you hold any fiat, Peter, during this phase?
Coach,
is Euro going to benefit the most?
You read my mind. That was the exact question I had. I mean,
any fiat at all for a while?
Look, I think gold is preferable to any fiat currency. I mean, if you look at gold has been increasing. We've been in a bear market in stocks, in U.S. stocks for 20 years, price in gold. So gold's doing well. I mean, I just read, the euro, I think I don't know, was it 20 years, however the euro's been around, but since it was created, it's depreciated 85% relative to gold. So none of these fiat currencies could hold a candle to real money. But over shorter periods of time, right, the shorter your time horizon, the less risk there is in your fiat currency. So yeah, it makes sense to hold some fiat currency just to pay your bills that are coming in fiat currency. I mean, if you've got a rent, you got a lease for a year, and your rental payments they're fixed in dollars or euros, depending on where you live. So it's fine if you hold on to that currency so you can pay your rent because your rent is fixed. But I wouldn't hold on to any fiat currency thinking that I'm going to pay my rent in 5 years with it, because who knows what the rent might be then, because how much inflation it's going to be. But yeah, for your immediate needs, it's good to have some liquidity. And yeah, it's, you can have some cash in a brokerage account.
How about Chinese yuan, Peter? Yeah,
Well,
they have all this gold that they've been accumulating for years.
Yeah,
Could it
look,
be the one?
I'm one of those that happens to think that the next big move in the Chinese yuan and the Hong Kong dollar is up. You've got some people that think that these currencies are going to crack against the dollar. And I'm of the opposite view. I think it's the dollar that's going to crack.
Okay.
A lot of people are just looking for this dollar to go up. They think, well, there's all this dollar denominated debt. That debt's not going to be a problem once the dollar really starts to fall. There's this idea that there's a shortage of dollars. I mean, the one thing that there's not a shortage of is dollars. We are creating them like never before. We're printing them at the fastest pace in U.S. history, and that is only going to accelerate in the months and years ahead. So we are creating dollars faster than ever before. So there's plenty of dollars. There's dollars all over the place. Look at our trade deficit. Even the trade deficit we got yesterday, we had a huge jump in the trade deficit, a big drop in imports, but an even bigger drop in exports. So the trade deficit is a glut of dollars. These are dollars that we're putting into the marketplace every month for which there's no real demand. There's no demand to buy products. And so people are content to use those dollars to buy treasuries or other dollar-denominated debt. But what if they don't want to buy any more dollar-denominated debt? What if they figure they have enough and they don't want any more because they start to have a more realistic outlook on the future exchange rate for the dollar and they don't want any more? Certainly, we're not paying much interest. I mean, how much interest do you get on treasuries? Next to nothing. That doesn't nearly come close to compensating you for the risk that you take in holding on to dollars and those treasuries.
I'd like to get a viewer question in from Julie Smith. Where do you store your precious metals, Peter? Domestic or foreign storage? What do you recommend? I mean, there are a lot of people in the physical business that offer storage overseas, or is a coffee can in the backyard the best way to go?
Well, the good thing about gold is that you can store a lot of value in a small place.
Yeah.
So a coffee can, a shoebox. Yeah. I mean, you can store gold. And I recommend that everybody have some of their gold, stored themselves. We sell gold. Shift Gold is my company. I've got the best prices.
How much over spot are you with what's been happening in the physical market?
Yeah, I'm not there day to day, but I know that the premiums have gone up quite a bit. We're cheaper than anybody else, pretty much. But yeah,
$4 over spot in silver and $100 over gold.
I don't know. You have to call up Shift Gold and check.
Okay.
But check my competitors. I just think that we have the most competitive prices. But yes, if you want to buy physical silver today, the premiums are much higher than they were a few months ago. And it's going to, we used to be able to ship it out the next day. You may have to wait a month or two or more. We can lock in your price, but you're going to have to wait because there's just a shortage of.
Why? Because of the coronavirus?
Well, the mines
they haven't
been able to fabricate.
Could we use that for an excuse too on everything?
Well, that could be part of it if some of the miners aren't on the job.
That's true.
But look, you can store money with a third party. I mean, we have a lot of clients that store money at goldmoney.com. They have storage facilities around the world through Brinks. At my broker dealer, Europe Pacific Capital, we still store a lot of gold and silver at the Perth Mint in Australia. So you can talk to us about, having gold. You can buy it and have it stored over there. It's good to store your gold out of the United States, just in case the U.S. gets kind of cute and, tries to pull a fast one. You've got some gold stored outside the U.S.
Yeah. You're talking about confiscation like the third.
Yeah, or just who knows? I mean,
Yeah.
look, if things really get bad in this country and you just have to leave, it's nice to know that you've got some gold waiting for you. Maybe it'll be illegal to try to, smuggle it out of the country or something like that.
Well, Peter, I tell you what, really, you are a great ambassador for the shiny stuff. Okay, for gold, you're great, but you build the case. You've been right. I've also watched you when the gold market was in a bear phase, and you never lost your conviction. Thank you so much for coming here today and being part of the summit here for Forex Analytics. Really was eye-opening, I believe, for a lot of people.
Yeah, thanks for having me. And by the way, if people want to hear more of my perspective,
Yes.
they should listen to my podcasts, which, I do them 2 or 3 times a week, generally, sometimes more, depending on the market. But you can listen at shiftradio.com or any, iTunes, Stitcher, any of these places that you can do podcasts. A lot more people are listening now on my YouTube channel, the Shift Report, because they want, now I've been doing with the video. So if you like to, see me as I'm discussing, and I'm doing the podcast now live on YouTube. And then once I finish, we upload the edited sound to clean it up a bit and post it to Shift Radio. So they're there for people to download and listen, in their cars or, well, maybe not so much right now. They're not commuting, but they just listen at home. But I'm trying to do what I can. There's so much ignorance that's spreading, right? I've been saying that the one thing that's spreading faster than the coronavirus is economic and financial ignorance. And I'm trying to, be the antidote, the vaccine to that, and to kind of counterbalance the mainstream media on my podcast. So make a point to tune in and listen to my take on the events, the news, the financial events that are taking place, rather than just listening to the mainstream.
All right, I have a suggestion for a theme song for you.
Yes.
Goldfinger. He loves only gold.
Well, I don't love only gold. That's the thing. I mean, gold.
You love your family too, right?
Well, no, I'm talking about for a portfolio. Gold is a small part of our portfolios. We invest in stocks around the world and dividend-paying stocks. I mean, the thing is that, people equate me with gold because I think people should own some gold. I mean, most people in my profession, in asset management, financial services, they recommend no gold at all, which I think is crazy. I mean, I don't recommend all gold, but I think recommending no gold is even crazier than recommending only gold. Look, I recommend a balanced portfolio that includes gold. Although right now, because I think gold is so undervalued, it may need to be a little bit more, and especially the mining stocks. I think the mining stocks represent a great investment value for people who are looking to take the risk of owning a business. I think gold mining is a great business to be in right now. I think the profits are going to go up a lot, and therefore I think the stock prices will go up even more. And, we have accounts. If people are looking for professional management, we manage accounts, gold stock portfolios, individual accounts.
Yeah, Euro Pacific Capital Inc., right?
Yes, exactly.
So you could find Peter all over the internet and contact Euro Pacific Capital if you want to structure a portfolio with the narratives that Peter has just mentioned. So thank you again, Peter, for being with us. Appreciate it. And I hope that you and your loved ones remain untouched from this virus.
Yeah, well, so far we're all healthy.
Good, man.
That's the same.
Go ahead, Steve.
Looking forward to having you again. Thank you very much.
Okay, maybe next time it could be in person.
Okay.
Let's hope so.
All right. Peter Schiff, everybody.
All right. Take care.
Thank you. Jamie Satley. Climb that mountain. Bring your waves to the summit. Here he is.
There you go.
Welcome to our summit, Jamie.
Can you guys hear me?
Yeah, can hear you. Can see your chart. Welcome.
Okay. Welcome. So first of all, thank you so much for having me. And second, I was talking to Steve about this last week. I apologize. I do not have a webcam right now.
Don't worry, Jamie.
Okay,
It's
yeah, it's
probably
fine.
better for it's probably better for everybody because with this whole quarantine thing, I haven't been shaving and I look like a
Like me.
I look
You
like,
look like
no,
me.
I look like a grizzly bear. So so
Are you are you still are you a bear or are you just grizzly, buddy?
no, I mean it's like more like Sasquatch.
Jamie,
What are we
from what I
looking at
see,
here? Oh,
from what I see,
GDX.
you want to pick up the baton from where Peter Schiff left it by showing us the long-term breakout in the GDX, right?
Well, so yeah, so my presentation, I'm going to be running through a tool that I use based on volume. And before I get to that presentation, I wanted to share this because I thought it was a good segue. And you'll see these blue bars here. Okay, this is a weekly chart of GDX.
Yeah.
All right. This is weekly, so each bar here is going to be a week, and you've got 3 volume buy signals, okay, on this chart going back to 2012. One was here in May of 2012. One was back here in November of 2014. And that one, really wouldn't have worked out all that great from a timing perspective, unless I guess you just held on. And one was actually the week of March 20th. So I thought it was a good segue to go into using this this tool, and applying it to what's happening right now. So before we get into this, let's view the slideshow. All right.
Speaking of which, Jamie, they first managed to get everybody that was bullish kicked out of the market in the GDX, I mean, before it reversed higher. So it was like very devious.
Yes, of course, absolutely. And we've kind of seen a similar move with. Hold on, we've seen a similar move with the dollar here on both directions. All right, hold on, let me get the slideshow going. Okay, so this presentation or method actually was born out of an article that I wrote for Stocks, Futures, and Options magazine back in like 2008. So it's, it's a while ago. And the idea is simply to have a process where you're listening to the market rather than trying to predict. And that's really what Jesse Livermore, if those of you who are not familiar with who Jesse Livermore is, just Google him and you can read about him. He was known as kind of one of the greatest traders of all time, did not end up listening to his own rules, and that's kind of what did him in. But what I say Livermore logic, trading logic, is basically volume logic, okay? He followed the market where it was headed, but he watched for clues that the market was changing. His process and his method, he called it his pivotal points method. And we, refer to pivots, like as floor pivots or something. Pivot just means change. So he was looking for the market to tell him clues of when things were changing, right? When it was getting loud, when it was time to go against the crowd. Some quotes here just about him. He was a speculator. He would pick his battles more than jumping in and out. Early in his early days, he was kind of a scalper in the bucket shops, but eventually he was kind of a big swing position trader. Now, this part's important. He thought that picking tops and bottoms was for fools, but he also often found himself buying close to bottoms and selling close to tops, right? This was a result of his process, and that's important. He wasn't trying to trade the top and trade the bottom. That's just what the information that he was taking in, that's, ended up being his result. So here's a good quote from him. He always wanted to trade along the line of least resistance, generally moving along with the crowd, the herd most of the time, but always hunting for clues to change, ready to separate myself from the popular thinking, the group thinking, and go the opposite way. Now keep in mind, this stuff is, this is from the early 1900s. It never changes, okay? These major changes and trends were hard to catch, but I did not want to ride the sled downhill with the crowd unless I'd sold stock short. Now this reminds me of Dixon Watts, who was a cotton trader in the 1800s and somewhat of a philosopher to traders, if you will. And he had a famous quote that he would say, go cautiously with the crowd and boldly against the crowd.
Like that.
Yes. So, definitely appropriate in today's market, right? So he defined pivotal points as days that contained heavy volume. After a big move, big increase in volume was a key signal that the market was the end of its move. So rather than exit right away, he would wait for the market to roll over. And so, these quotes here, this is the logic that I've coded into the volume. And you'll see as we look through some of these charts. Okay, heavy volume often present not just at the end of a move, but also in the middle. If you think of Elliott wave, that's appropriate here because a third wave, right, or a fifth wave, you'll often have big moves in the middle and at the end. Okay, so here is the volume reversal logic. And what we're going to do here is we're going to go through a bunch of charts so you can see how this looks visually. But I have two signals that I follow, and they're on all different time frames, okay? I'm going to show you stuff from monthly, weekly, daily, 4 hour, 8 hour. I mean, you can go as short term as you want. But a 1-bar reversal, so you have to have a high range key reversal. What I call a high range key reversal is, let's say you have a 20-day ATR of 100 pips in euro. The range for that bar has to be at least 100 pips, and you need to make a 50-day low or high, and then you need to close on the opposite side of the prior close. But you also have to have high volume to have what I call a, high range key reversal with high volume. A 2-bar reversal, which I consider to be a stronger signal, is a high volume move into a price extreme, loosely defined as just a 50-day high or low, 50-week high or low. And then the next bar immediately after that is also a high volume bar, but in the opposite direction. These don't happen a whole lot. And when you see these charts, you will understand what I'm talking about. So let's just bring in a chart of just a daily of, say, we'll go to just Euro futures, okay? So everyone can see this?
Yes.
All right. So when I have, little blue, little blue, little blue, little red, this is the volume in the direction of the trend. So I'm defining it as simply 25% above average daily volume, so over a 20-day period, okay? Now, this is what Livermore would call going cautiously with the trend, or what Dixon Watts would call going cautiously with the trend. Now, I'm going to get rid of that so we can see the reversal logic a bit more. All right, so this would be the reversal logic. We're going back here, what's this, 2013. So you can see here, we have a buy warning. Now, let me also say this is not a standalone trading system. This is a tool, right? It's not like this is just set on auto here. So
it's another arrow in the quill.
That's right, absolutely. An arrow in the quiver, right?
Quiver, yeah, quiver, thank you.
So here we have.
I'm quite the archer.
Yes.
I put my arrow.
Dale? Is that what you've taken up during this coronavirus quarantine?
Yeah, but I keep shooting myself in the foot, so I gave it up. I gave it up.
I see what you did.
I have
there.
no hobbies.
All right.
This is my hobby.
Yeah, I hear you. This is my hobby. I sit there, I read about guys from the 1800s that traded cotton and try to come up with try to come up with trading indicators for it. So there you go.
Oh, I bet Jimmy Rogers knows that guy. He always talks about cotton farmers. So
that's right. Well, you got to remember my history, right? Family history is the cotton farming.
Cotton used to be able. It would the last hour of the day I would watch cotton and the stock market trade together.
Really?
Yeah, they used to have a little correlation there.
Well, that's fascinating.
Now with all the swab shortages for the coronavirus, I'm going to have to take a look at cotton again.
Will too. All right. So where were we? We were talking about archery and cotton and.
Yeah. Well, you're on with me.
I love it. All right. So here we have. Now I can tell. It might be tough to tell which is, but the skinnier bar is going to be a 1-bar reversal. and thicker bars are going to be 2-bar reversals. So either way, they're both plotted on here. Now you can see this is a 1-bar reversal.
What makes them a reversal bar? By the way they close like above or below the previous two?
Yeah, so here, so let's just go right here. I'll zoom in a little bit. And okay, so the 1-bar reversal. So first of all, on the bottom here this is volume, but normalized over a 20-day period. So it's just like, it's just you have the percentage that it is, against 20 days. So this bar here was 1.84. That means volume is 84% above the 20-day average of volume that day. Okay. So in order to have a reversal bar, I require 50% above the average. So in order to have the reversal bar, you have to have the price reversal bar. So it means you have to make a new low, has to be at least a 50-day low, and you have to close above, the prior day's close. That's just a key reversal, right, in the classical technical sense. But then we add the volume component, and that's it. It's it's a simple indicator, simple logic here. So you can see going back, I have it on line charts, easier to see where the signals are. But you can see here, short signal, long signal, long signal, long signal. These obviously don't all work. These aren't cherry-picked examples. Moving to where we are now.
They don't happen that frequently, do they?
No, and that's the beauty of it. And something else, if it happens all the time, then by definition, it can't be that important, right?
You can't have reversals inflection points every day.
That's right. So what's rare is, by definition has the potential to be important. All right. So yeah, you can just see the signals, right? Now, funny enough, we actually haven't had any signal during this entire crazy volatile space in FX really since February. We actually didn't have any reversals in euro on the daily. Let's go to Australian dollars, and then I'll show you some other great examples. So like here's Aussie dollar. Again, if I put on, so with the trend, right, down, red, with the trend up in blue, get rid of that. You can see, so you can think like Livermore would be with the trend here in Aussie would be with the trend. And then you'd have this big reversal spike up here, right? And then it would start to roll over, and then he'd go with it.
Boldly with it.
Boldly with it, that's right. Cautiously with the crowd and boldly against the crowd. So let's get into a couple more examples. I've got examples on different charts, like different assets here in different time frames. And really what got me doing this was, so, my background, of course, is in FX, but then got into other markets and trading for some funds and doing other things in equities and futures, and really got, I wouldn't say depended on, but really started using volume a lot in equities and in futures. And, in FX, we really don't have, it's no centralized exchange. So it's OTC, so we don't really have volume. So that's why I follow these futures charts to trade spot. So if I get a signal on futures, I can use it to trade the spot market.
Interesting.
Okay,
and people also use COT that you don't get on.
That's right. It's the same thing, exactly. So you're using COT as a proxy for positioning or sentiment, and you can use that to make informed decisions on whether or not people are bullish or bearish the euro or whatever. Okay, so we're back on the slides. You guys see the slides?
Yes.
Okay. So this is a monthly chart. Okay, and this is one we posted back the end of February. You can see in the whole history of S&P E-minis, right? This is going back to 98. So I've just had this E-mini chart, not cash. We had a sell signal in February. The only other sell signal we had was actually in 07.
Wow.
On a monthly chart. We had a buy signal in 02. Okay. So
Your third signal in 20 years.
Yeah, exactly. Here's the Dow. The Dow actually had sell signal also in February. Again, Dow futures, so YM. And then we had one back in, I guess that was October 2018. Yeah. And we had one
before the worst December since the 30s.
Right. Actually never got triggered on this never triggered a buy. It's just, you know, I'll follow obviously NASDAQ, S&P, and Dow futures, but you can see only got sells on this on a monthly chart. You know, it shouldn't be all that surprising, I guess, given the fact that volume tends to be heavier on down moves, but when you do get a buy, I think it's probably instructive to.
How do you manage risk on these?
Well, so again, so it's a tool, right, that I'm using. Right. But
use the high of the reversal for shorts and the low of a reversal for longs. As far as a stop loss point.
Well, what I'll do is, so here, let me go back to the other chart real quick, because examples will help. All right, so this, by the way, is, this is the Qs. This is Qs weekly. Okay. So you can see some of these bad boys here. But what I'll do is, so let's just say, for argument's sake, so this is a Euro hourly chart, okay? So we have it on hourly now. Let's say that this day over here was a high volume reversal update. Now it wasn't. Let's just say it was. Within that day, you're probably almost certainly going to have a very high volume hour or high volume bar. So in this case, that would be right here. So on my chart, when it's plotted with like a magenta dotted line, that means it's the highest volume over X amount of periods. And that tends to act as a support or resistance level itself. So what I'll do is I'll look to buy, if it's a bullish reversal, I'll look to buy into that high volume level with a tight stop. Or you can also use this as a volume weighted average price indicator from the low. You can see it's actually followed it pretty well over the last couple of days. So essentially you get the signal, you zoom in, you get more granular, you identify the level within that, and then you trade it. You know, it's not like I'm just going long or short on the close or something. Okay, so back to the slides. All right, so Dow monthly. This is Aussie futures weekly. This is 2-bar reversals. You can see not a whole lot. We've had 3 signals over the last.
Still on Euro.
I can still see Euro as well. Yes.
Oh, sorry.
There you go.
There we are.
I forgot to hit the share button. Okay. Yeah, so here you can see Aussie futures weekly chart. So weekly reversals, again, did not get high volume reversals down here on the weekly, which was kind of surprising to me, but whatever. So you can see 3 signals, right? Now, when I get a weekly reversal or a monthly reversal in something like a commodity or currency future, you know, pay attention. Doesn't happen a lot. This is CAD. Again, 2-bar reversals. Kind of where you'd expect. You know, and again, if you're looking, if people are looking at this and trading dollar CAD, remember this is future, so it's going to be a little different. This is CAD dollar, not dollar CAD. Getting down into a little more short term. This is a 4-hour chart of Aussie. So going back, you can see this goes back to, I guess, October of 2018 or so, or 2019, I guess. And you can see some of the good signals we've had here. Sell here, that was December 31st, the last day of the year, last bar of the year. And then again, this is not you're gonna get false signals here, right? Risk management is always is a key. You know, if you're buying this and you're toast, right? Now we did get one on the bottom, on the low here.
Okay, I just have a viewer's question since you're there. Does this process work for equities?
Yes, actually,
was asking.
That's really where it came from.
Okay.
So it, you know, like I said, I wrote that SFO article back in 2008, but back then I was actually using ATR to kind of as a proxy for volume. And it doesn't sound that crazy. If you plot volume in just a 1-bar ATR range, they tend to move together. Like a huge volume day tends to be a bigger range day as well. Not always the case, but yeah, when I was developing some equity scans, I started, kind of fooling around with high volume reversal stuff and back-to-back high volume days. And really with equities, what I do is I'll run it on a weekly basis, but the ones I really pay attention to there are the monthly ones. And before this webinar started, I actually was I wanted to see which monthly charts we were going to get big bullish reversals in. So
yeah, because we are coming to month end here.
Yeah, and there's a lot of potential ones, because the first thing you have to do is identify the high volume breakdowns from the prior month, and there were a lot of them last month.
Yeah.
So yeah, it's going to be a lot. And
yeah, the close of the month is a lot different than the beginning of the month.
Yeah, so it's I scan it's over like 10,000 stocks.
Someone's asking this, Jamie. What volume averages do you use on each time frame to determine reversals? Daily was 20.
Yep.
And hourly was 50. Do you use the same for all time frames?
No, so that's a good question, and the parameters are what I've used for just general, inputs as far as a moving average on different time frames. So like on a monthly, it's 12. It's 12. So just on weekly, it's 13. A quarter. On daily, it's 20. And on anything intraday, it's 50.
Oh. Okay.
And yeah, those aren't like optimized or anything. They just kind of seem to make sense, and I wanted to stick with it. Obviously, you can play around with it and see if you can find something better, but 50 on an hourly chart is going to be roughly 2 days.
All right. Let's see. How can you read the difference between XAU and XAU EUR?
That was a previous question.
Okay.
There is also a question about how do you get the volume since FX isn't centralized. He has already answered that through the futures markets.
Yeah.
Having said that, there are futures for all currencies. So keep that in mind, guys.
That's right. So I was going to say, and at some point, various market makers probably could use volume if you had enough data, right, in order to do this. It's not a centralized exchange, but if you had a large enough sample size, you could probably, get a good enough read. But yeah, so as far as the currencies, like Steve was saying, you have dollar index, right? You've got, Euro futures, yen, pound, Swiss, Aussie, Kiwi, and Mexican peso. So like, you're not going to be able to do it for like cross pairs, but you can kind of put those together if you have signals in opposite directions or something on yen and euro. You trade euro yen, So here's what I was going to do, because we are coming to month end. I want to run and see what the possible bottoming reversals are, or top reversals are, for the list of ETFs. That might be an interesting thing to look at right here.
There's also a question about its usefulness for natural gas and crude oil.
Well, I will say, I don't know if there's any signal that would be reliable on a bullish upside trigger for natural gas. I think it's been going down forever. But okay, hold on here. Let's look and see what we got here. So, oh my goodness. I mean, literally, like, we're going to have the potential to have like every single there's just so many high volume signals last month. So yeah, what I'll do is I'll try to do this real quick. Let me go back to the, here, let's go in here so you can see what I'm doing. All right. So, because the month is not over yet, I need to look and see what we're like. Okay, so someone asked about natural gas. Let's pull up a chart of natural gas and see what that would look like. Also, at least with the TradeStation data that I use, the problem with this is that this is, it's not, you know, this suffers from the roll. It's like looking at the ETF, right?
Yeah.
So you don't really have pure data to look at, so to speak. But here's an answer for you. So you had a natural gas signal to buy it on January 2018. You're not going to get one this month because you can see the average for volume this month is only 1.
Maybe it's going to negative 38, Jamie.
Yeah, you ever thought you would have seen that? Here's
No.
you're gonna get a signal to buy. This is a monthly signal. This is UGA, which is the U.S.
ETF?
gasoline fund. Yeah.
Yeah.
So that's what I was trying to look through to see, just maybe some actionable stuff here to see what was going to pop up. There's going to be a lot of them. UGA, USO. Well, that's obviously not because it's not positive.
Is this a new relationship with Scandinavian capital markets, Jamie?
Yes, actually it is. So
Okay, I thought I'd get that in there.
Yeah, I started working with them a couple of weeks ago, and I'll be helping them with their research portal, Scandex.
Oh, okay.
So
congratulations.
Thanks. So be sure to check out Scandex. We're going to have a bunch of different tools on there to help traders. Rather than just research, we'll have various tools to help traders reach their potential. Is the idea here.
Glad for you, buddy.
Thanks. Let's see. Oh, you're going to get one on XOP, which is the ETF. Good. We have the volume a little low. Okay. So XOP is the ETF, right? For oil and gas.
Okay.
You can see we're going to get a buy signal this month on that.
Big volume on the way down, big volume now on the rebound.
That's right.
Yeah.
And again, this is a monthly chart, so this is longer term. You've had, you've had some. You had one back in the 2016 crisis, March 2016. Had one in February 2015. You had a couple back in 2009. So
some of them never looked back. How about the fact that the magnitude of this is so large that from a tactical standpoint, perhaps you look for some type of fib retracement of wherever this
that's right. Well,
initial run stops.
Yeah. So the question you asked earlier is like, how would I trade this? So, all right, we have this XOP reversal here. So now let's zoom into this a little bit. Okay. And let's see. Okay, so here's XOP. Here is the volume weighted average price from the low right here. Okay, we're actually coming into 2020 volume weighted average price. Like right now, I would actually expect this to provide some resistance right here.
Yeah, gaps, everything, yeah.
Yeah, so what I'd be looking at, is you kind of let it marinate a little bit, see what happens as you get into May, June, whatever, and eventually you probably want to be trying to buy this when you're getting into volume weighted average price from the low to provide support.
Nice.
So yeah,
Jamie,
absolutely.
Great look.
Jamie, I know that you've, through your career, you've used several tools. You've used extensively Elliott waves. You've used pitchforks after that. You're now doing, extensive work on volume and how it affects, in essence, reversals. Do you still keep using all of them by combining, in essence?
Absolutely. Absolutely, Steve.
That's what we do in Forex Analytics as well. I mean, we try to combine, several types of analysis, to get, whenever we get like a common signal in the same direction, we trust it more. That's a concept.
Guys, I've been doing a lot better since I integrated my 8-ball into my trade.
That's right.
Yeah, that's our main indicator. His 8-ball.
The magic 8-ball.
I shake it a few times.
So, all right. So let's, Steve's point here, let's take a look at, so here's using pitchfork or trend line analysis along with this, right? So this is a specific setup right here where you have your original channel, right? And you break out of the top of the channel. That means you're no longer in a correction. Now, the top of the channel often acts as support on the way down, and that's what's happened. Now, you can come back to it at some point in the future, and it should be support again. This actually happened with the British pound just recently. And let me bring in that chart, if you don't mind, if we have time.
That was a great question, Steve, because, a lot of people jump from methodology to methodology instead of building upon.
That's right.
One that they've mastered.
That's right. The whole idea is to build something, build a process, right? Develop a process. All right, so here's that British pound chart, and keep that picture in your head of what I just showed you. And this is the beautiful thing about technical analysis. It does not matter if you are looking at the price of XOP on a monthly chart or an hourly chart, or the British pound spot price here, okay? It's the exact same price behavior. Look what we have the original channel right here, right? Original channel, first two lows off the high. You break out the top, you're no longer in a correction. You come back and you test it, that's support. Break through it, now you watch for it to provide resistance, and guess what? There's resistance, okay?
And I also see that you've marked it as an ABC, and as a likely ABC correction lower.
Yeah, this is what I'm looking for. And again, this is, one of the misnomers, I guess, about Elliott is that people think it's trying to predict what's going to happen. That's not the case. It's trying to find, at least for me, it's trying to find levels to trade, and Elliott gives it context. So it's like, coming into a B wave high here, I'm fine with selling that, because the idea being, if we're right about a C wave, we should turn relatively quickly, right? And we did. But this is a combination. You can see here, you had, as you mentioned, Steve, you've got the wave count. Okay, fine. But you've also got some pitchfork analysis, simple levels analysis, whatever. If I wanted to take it another step further, I could zoom into, a short-term chart here. And when we were trading into that high yesterday morning, we were getting all kinds of heavy volume. And this is a 30-minute chart now, right? We were getting 30-minute sell signals on the way up, right? 30-minute sell signal here, 30-minute buy signals on the way down here, back on the 21st. So that really is, you can see how combining all of this information to make an informed decision. There you go.
Before, if you're done, Jamie, before you go, outside of the methodology completely, what would be your highest conviction trade be at the moment? At this current juncture in time, I mean, what do you feel strongest about based on, your analysis?
That's a hard question because when you ask it, it's like, well, time frame one, right?
You're absolutely right. Okay, let me rephrase it. Let's say for the month that's coming ahead.
Okay. I'll tell you what, I believe, but I want to check something first. So first of all, we just looked at the British pound. So we're coming into the seasonally weak period for the British pound, right? May is historically a really bad month for the pound. I tell you what, though, my favorite setup, long-term set, and it's been, I've probably talked with Dale about this.
The bonds?
Probably a year ago. It was dollar yen.
It's called that TLT rally.
Right. Well, so that's done with, right? That's played out.
Yeah.
But it's probably, and this is a long-term chart, but it's probably this dollar yen trade idea. So
lower yen.
Yeah. So I have this as a big A.
Yeah.
Finishing a huge B.
Yeah.
And eventually we're going like mid 90s on dollar yen.
Okay.
Right now.
Yeah.
That would obviously coincide with the nice picture we have in treasury yields. We see a triangle, a likely breakout from the triangle to the upside, and then a reversal.
Yeah.
I'm into the treasuries because the yields are the exact opposite. So perhaps one spike lower in yields and then a reversal and US yields going higher.
Yeah.
Right.
Well, here also, if we look at
and maybe a pullback in the S&Ps while that happens. From here, we took out 61.8 here.
Yeah, S&Ps we're actually testing a.
I'm trying it.
We're testing a big spot here at S&P. So this is 2020 volume weighted average price right here, that thick line. We're right at it.
Yeah.
Now we're still within this channel. This is actually, so this is a good example too. So this is a 4-hour chart. And you can see, if you can see it, I know there's like a lot of stuff going on here, but we had a sell signal on the 4-hour chart back on February 13th, right here.
Mm-hmm.
We had a buy here. We had a buy here, so we've been a little early. We had a sell. The last time I tried to short was over here. Now that hasn't worked. That's not worked out. So what I'm doing is I'm waiting for it until I get another 4-hour sell signal.
Okay.
Why
don't we wrap it with this, Jamie? How to join this methodology? Are you still teaching this, or do you still have SNB going, trade desk?
Yeah, so I'm still writing stuff at SB Trade Desk, and I'll be writing stuff at Scandex. I would be sure to check out Scandex because we're going to have a bunch of different features and things coming out.
Spandex.
Scandex.
I didn't think. Oh, I thought you were trading wearing spandex, Jamie. All right. Anyway, look, I'm
Dale, how long have you been up?
About 18 hours. Anyway, so Jamie, thank you for coming here. I wish you a lot of good luck with your new broker and appreciate you being part of the summit. And you could also follow Jamie on Twitter at his name. So at Jamie Satley. And really thank you for, being part of our first day here, Jamie. Nice presentation.
No, thank you for having me. This was wonderful. And real quick, because I'm a screen hog, and I think this is important. So on that dollar, Steve was asking about, what I like here. Again, this is a longer term idea, right? I don't know what's going to happen today, or Fed coming out.
A fractal for.
But this here, so this black.
Yeah.
Okay, this is the yield spread. This is U.S. Japanese U.S. 10-year minus Japan 10-year yield spread.
Oh, okay. Wow.
Okay. Now, dollar yen, if it was trading on the yield spread,
would already be there.
Should be at like 75.
Yeah. Wow.
So this has been going on for a while. Now, for whatever reason, the relationship between the yield spread and dollar yen broke after the August low, which was, last year, that kind of panicky low we had last August, right?
Okay.
So I don't know, this adds a little more fuel to the fire as far as the idea of dollar yen going to the mid 90s, in my opinion.
Okay. Nice look. And, the correlations have broken down with the yen on almost everything,
Yeah, I mean, absolutely, it's not the risk on, risk off, so to speak, scenario, and it hasn't been for a long time, I guess. But the one thing that does tend to move together over a longer period of time is gold and yen, right?
Yeah.
So,
and that's divorced.
Yeah.
A bit. So anyway, Jamie, hope that you and your family remain healthy. And thanks a lot for coming on today and edifying people that showed up for the summit. They'll be there on video too. And good hunting, my trading warrior brother. Till next
Great
time.
day.
Absolutely. Thank you guys so much, and have a great rest of the event for the next day and a half or so.
You do, Jamie.
Okay,
All right.
Jamie. Hi, Mark.
Can everybody hear me?
Yeah, welcome to the summit, Mark.
Thank you very much. Thanks for having me, Dale, and Joe Perry, everybody else.
Yeah, so I look forward to it. Normally it's an interview, and I see you want to talk about volatility. I just have one question. And, people wonder how I remember things like this. But I remember one of our interviews, Mark, and if people don't know who Mark is, he's a CNBC contributing editor. He's on there a lot. He's a CMT, and he has a great website and one of the best tacticians I know. And this is why I bring it up, because before the break that we had in February, March in the market, you and I had talked before, and you had a time frame thinking that the market might have some strength into the end of April. And so we got the big break, but here we are at the end of April with a hell of a recovery. And, cycles don't always point towards the top, but it's still an important time frame for you, isn't it, late April? I'm just guessing.
You know what? Not as much anymore. And so, initially I'll say that,
All right, hey, hold on, Mark. I have to cover 1,000 S&P shorts I put on.
Yeah,
no, I'm kidding. Go ahead.
I don't want to say that that I'm negative now because I'm positive. I'm simply being a lot more tactical, and I really need the market to prove itself that it's going to go lower. There's a number of things that I show for right around May the 9th into the 16th, and I think that could be, an initial period where markets peak out. I think we're a little bit stretched today, but really any minor weakness today likely still holds 2,900 and then makes a final push higher. So I'm skeptical to try to
Is
come out.
3,100 realistic?
What's coming? You know what? We can talk about a lot of those after I go through some of what I brought. I have a little bit more of a formal type presentation, and we can obviously go back and forth. But I want to discuss with the viewers what I saw specifically during January, February that made me concerned, and really what I see now. And there's really a lot out there, and I'll try to cover it as quickly as possible.
Take your time.
Certainly one of the more surreal, unusual times that we've seen on record. I mean, I've been in the business since the early 90s, and literally the last 2 months has just been, wildly exciting on both the downside and on the upside. And so, stocks have managed to really shrug off one of the largest periods of economic and earnings uncertainty. And that's really the key message, is that everybody was scratching their heads, first of all, as why the market was going down. And now those same are really scratching their heads as to how can this rally continue given lack of a vaccine, given lack of any certainty with regards to earnings or the economy or anything. And so truly a lot of things to be really frightened about. And many times that sentiment is actually more important than the news or what's around us itself, is to really study how those around you feel about the market. We're set to make literally the largest monthly gains now in about over 25 years. So, we have a near-term pattern where markets are really not that overbought. MACD and other indicators are still positive, but that's also within the framework of a lot of weekly and monthly momentum that it really is negative. And so, you look at a couple of the key themes, and that our own bounce in the U.S. has been far stronger than what we've seen in Europe, Asia, and most of the LATAM space. I think that's interesting. Small caps and mid caps literally in the last week have started to show signs of moving higher and breaking out relatively against the S&P. And so that's really an interesting concept. It's not normally something you see at market tops. Growth has begun to slip a little bit. You've obviously seen that energy and financials outperformance of late. My thinking is short-term cycles show the potential of a peak in mid-May, but really it's going to be mid-July that I'm eyeing as to being important. And so, sentiment right now, we saw last week's AAII bulls down at the lowest percentage of the year. So it was down at 24% bulls. So that's really interesting that after a 30% rip in the markets that we're seeing the lowest percentage bulls. And I still look at that survey as being, something that I would include in my toolbox. It's certainly not a be-all, end-all, but it's very important. So, the monthly chart, many people use log charts. I do myself, but this one actually did have 3 important hits to this longer-term trend line in the last 10 to 11 years since the bull market started in 2009. So I do think it was important. We actually held where we needed to on a month-end basis in March, and now we've snapped back. But the real warning sign to me is the extent that the momentum has really begun to roll over. That's a big thing. We hit our highest overbought levels on record really in January of 2018. For any of you that use the Bradley charts, the long terms actually peaked out in 2018 as well. That was a meaningful peak. And not just for US stocks, obviously we peaked out this February, but largely for when momentum globally peaked out, 2018 was the year. And so now we've had a decent rally off these lows. And so initially, let's just look back, and I'll try to cover these quickly, and then we'll move on to some charts. I know we all are interested in the charts, but everybody wants to know, what were the warning signs? I did turn bearish on the market in January and actually in February. And so my annual report for this year turned negative for the first time in over 5 years. And this business I just started in 2016. So this is the year that I came out in late December thinking this year was going to be a negative. These are some of the reasons why. Now, some of these materialized right away. Some of them started in January, February. The high yields started to diverge pretty meaningfully in mid-January. That was pretty important. And we also started to see the defensive positioning. So all of a sudden, when you start to see utilities rip and outperform technology, you really have to scratch your head. The put to call started to dive. The equal weighted gauges hit new highs in January, but yet we didn't in February. So the market peaked out a minor peak. S&P and NASDAQ ripped back to new highs, but yet the majority of stocks did not follow suit. And that's a real key warning sign of some negative divergence that's really important. Small caps and mid caps actually peaked out in mid-January, so they didn't follow suit. That's also part of that whole equal weighted gauge that did not follow suit and move back to new high territory. And a lot of it was about breadth starting to really slump into February, and we'll look at that. But really, the Treasury yields truly proved to be the catalyst. They have tended to show some decent correlation with equities over time, and when we saw not only the break in October of 2018 was yield-based and coinciding exactly with when Powell spoke, but also that happened in mid-January and also mid-February. When you saw the meaningful breakdown in Treasury yields, that was the real catalyst for when stocks actually started to turn down. But the sentiment turned very bullish last November when the market had gotten through, September, October, thinking that nothing else mattered. Deal with China was underway. We saw very high levels of bullish sentiment. And so that was part of the process. That coinciding with these divergences are something that everybody really should pay attention to, in terms of things that can coincide with meaningful peaks in the market. So right now, there's a number of different positives. I mentioned some of them. We're still in an uptrend. We still have higher highs, higher lows. Momentum is positive. Technology is the big thing to watch. Tech is 25% of the market. We have not turned down in tech. So it's important to really take notice that the market's up 28%. We don't want to be too short-sighted and try to jump in and out of this, but really watch what happens with technology. That's going to be the key. Defensives right now are still underperforming. You look at not only over the last month, but over the last week, we've seen meaningful lagging in utilities and the REITs, and sentiment right now is still subdued. We've had a big rally in the last month, and stocks really, sentiment has not really snapped back. The negatives, though, are pretty overwhelming. We do still have a lot of bearish momentum. That's important. We still are within this negative momentum divergence, which I pointed to in January 2018. That's not going away anytime soon. The market cycles are going to be negative until at least next year and potentially into 2022. So this does suggest for me that it is going to be a rally to sell into. I'm just not willing to step in front of it right now when things like transportation and other laggards are starting to come back to life, and along with the small caps. So the transportation has been under pressure. That's something we'll look at. The lack of participation is an intermediate term concern. And as I just mentioned, some of that has improved on a short-term basis. So here's our S&P chart as of yesterday. So we managed to actually break up above the peaks from April. A lot of people had noticed, correctly so, that breadth and momentum were stalling. But my thinking is the move up over April really changed that. And if anything, still very important for how this moves. So, this move for me should get up to, right now we're at 29.43, I think, in S&P futures heading into the Fed. So it's an interesting spot with regards to time. My thinking is, can it be meaningful in the short run, produce a minor pullback? This was the chart that I referenced a second ago, and this is just, the market had taken on this very choppy, overlapping type period and a corrective style that many thought should eventually give way and be a head and shoulders peak. Well, 80 times out of 100, these oftentimes do not turn out to be head and shoulders. We would have needed to get down under 27.27 in S&P, and now we've actually pushed up to new highs. And as of today, this looks to be, ending potentially a fifth wave from the 21st of April. And so we'll see if that actually is just a third that ends, today, tomorrow, we pull back and then have a final move up into May. My thinking is it's going to be early to mid-May that's going to be an initial peak.
Okay.
This is interesting, and then we're looking at the peaks from 07 and also the peaks in 29. So time is very, very important. We declined actually for 5 months before getting back 60%. So we're actually higher with regards to retracing this time around, and actually as of a couple days ago, our rally has been longer in time than the time it took to come down. So there has been an overbalance now of time. We declined for 33 calendar days. Now we're on day 37 on the upside and have gotten back about 61%. So it's interesting in that time we're seeing an overbalance. Most of these bull market peaks, whether it be 29, 2000, 2007, you look at this comparison where in 29, you barely got back a third initially, started to sell off again. This rally already on top, we're already an overbalance of time, and we've recouped a lot more than we thought we would have. So that's just, you could say the Fed is
imply that as bullish.
Well, it is bullish, I think, on a 2 to 3 month basis. Yes, the fact that that means that even if we peak out in May, I don't think there's going to be an immediate challenge of lows. I think that likely we could grind around till the summer, and it's important to see that negative divergence really come back. Growth versus value has definitely begun to roll over. That's something that's interesting and new. This is just a ratio chart of the SGX versus the SVX. You see that negative momentum divergence on the bottom. So I tend to plot these as a ratio form. Now, as to whether this is a longer term peak, I'll let the charts show us that. For now, I do expect that value can show some outperformance in the short run. But this is the chart going back over the last 20 years, and it's just a historic, huge period of outperformance for growth. And this largely kicked into gear right after the U.S. election in November 2016. Not to get political, but obviously the perception was that we could see a lot of deregulation and good opportunity for business, and at least the perception was that should be good for growth. That's precisely what we've seen with regards to growth. We've had huge outperformance. Now we are getting overbought in this ratio. The prior chart, we showed that this should start to peak out. So we'll see the extent of this peak out, but for now, that's interesting. This is something that just happened this week, and this is very interesting. Small caps all of a sudden have broken out against the S&P as of this week. So it is a breakout. It's something that I am going to respect in the short run and thinking that we can make up further ground. So if anything, a lot of people are saying, hey, look at the Russell that's had a couple up days. Let's look to sell into this. Well, charts like this, holding suggests that we could actually show some additional acceleration in small and mid caps. But the ratio has just gotten really eviscerated. You look at this longer term sell-off. This is the mid cap versus SPX. Russell's the same. We've gotten down to decade lows in this. So you can afford to give a little back on the upside into May, into potentially the summer. That should be the time to sell into small caps. I just don't think it's right now.
Great look.
Treasury yields have lagged of late. I talked about the correlation. We have seen that over time. We saw the breakdown in January and the breakdown in February. It's been very choppy, and have actually yields, this was taken a few days ago. We've managed a minor little bounce in yields. Financials obviously have responded well. My thinking is we got to get down under 56 bips, and that would turn the attention towards a test of March lows. Right now, we still appear to be in a time when financials can work and actually yields can, we're certainly not going to see a giant rip back to the upside in yields, I don't think. But I'll let the chart speak for that. 140 is my level on an intermediate term basis. Until we get up over that, yields should be persistently very weak, and any sort of bounce in yields is going to be a chance to really buy into treasuries.
That's still a big bounce back to 140.
I don't expect that. So if we get over, say 80 basis points, you can make the case for when we're going to start to see the rally. I don't think that we're quite there as of yet. So you really have to lean on, what's happening with regards to yields. Right now we're still at 60. So I don't see this. Yields are certainly not responding. In the past, that has been a warning sign. We obviously see the yen moving up. We'll speak about that in a minute. But for now, this is something I'm paying attention to. The dollar, I don't have a whole lot of conviction in near term. We've gone from a lot of violent whipsaws, both to the downside and the upside in the Dixie and the DXY. I do think this has a potential to, if we start to break down under 99, I would turn more negative, and really over 101, I'd be positive. And that's just my time frame of preference with regards to technically how I look at it. So, I think the dollar has made some very meaningful longer term breakouts against some very important emerging and Latin American currencies that really deserves mention, and that we've seen it against the Brazilian real. This is a 20-year chart. That's a historic long-term cup and handle pattern. Same pattern against the peso, whether it be Colombian or Chilean or Mexican peso. We've seen very meaningful breakouts. And so, that should mean that emerging markets are going to continue to be under pressure. And I think that's been proven. We've seen the EEM only give back about a third of this rally, of the decline thus far, and our own U.S. markets have already recouped over 60. So until that changes, emerging markets are going to be something to sell into. Euro, obviously, this is a similar type longer-term daily time frame. We see this downtrend at work over 109. I would turn a lot more bullish on it, but for now, it's really something that one would probably want to sell into on a short-term basis after this bounce over the last few days. I don't see any signs just yet that it's broken out, so it's not. And that's just my time frame. The pound obviously moved up and held that important level from 19 and 16 and has now rallied up. Usually that'd be a time to consider selling into that initial bounce off the peak. And so maybe that dovetails with what Jamie was talking about, that we need to see a final pullback to, after this 5-wave move up as part of an ABC. And I don't necessarily disagree with that. This is a longer term weekly structure, but just shows you the levels that I think are very important to the bigger picture for pound sterling. EEM, as we talked about, a very weak rally off the lows. You are starting to see some interesting movement just today in what's happening with Brazil and Mexico that are really starting to claw back. And that's been a big picture of mean reversion all along, where the retailers, the airlines, the casino stocks, the cruise line, you know, all of these all of a sudden are making these giant moves off the bottom. And so, you know, the weakest LATAM markets are actually doing that today and actually are pretty bullish to me short term to try to buy into these like EWZ, EWW. I do like that as a short term trade. The longer term picture, though, is still pretty negative when you look at just diverging markets, developed versus emerging, and really a longer term breakout in that. Commodities have been hard hit. This is just the equal weighted CCI going down to the lowest level we've seen in over a decade. So, you know, I would argue that the dollar should be close to starting a meaningful turn back to the downside. But, you know, until I see that, you know, commodities are really something still that I want to avoid, with the exception of really the precious metals. And, you know, near term, I do think crude moves higher into May. I do think precious metals are still moving higher. Copper's had a decent bounce, but I think the majority of the space has really been hit hard of late. Some of the
agricultural commodities.
Grains have been tough, softs, and so I want to see improvement in these longer term charts before I'll really start to pay them more attention. Crude oil, you know, just a historic breakdown across many different times. This is just a monthly generic chart going back 20 years, and so you see the extent of this damage. And I am sort of short-term bullish on crude into mid-May, but I think that really any rally is going to be something to sell into. I'm not certain that we can recoup the prior lows that we've seen, and you know, those levels are not to the low 20s with regards to just generic crude from back in 08 or 09 and also 2016. So my thinking is you're setting up on an ABC type bounce for crude that does get us up into the low 20s. I would look to sell into that. For now, I do think there's some very appealing technical long opportunities in things like XOP, XES, the oil and gas ETF. I think they're making very good moves, which I think for those that are tactical, they are going to present opportunity. For most that are intermediate term, you know, you simply use strength to sell into. I think the longer term cycle is still very much negative for energy and crude throughout the majority of this year. I think what people are saying about demand is going to prove to be 100% correct, that the amount that they can cut is not going to nearly measure up to the amount of demand being stripped away, 35 million barrels a day. I mean, you had to try to press Mexico just to cut 400 and you can barely even get to 10. I mean, we're seeing an unprecedented amount of shortfall. So this likely is going to continue. Gold for me is still bullish near term. This is a week or monthly chart. You know, I think we probably can still push up and test highs. I do have some concerns about just the positioning getting very long in gold. Silver obviously is not kept up. Those are all very good, you know, points to make. But, you know, the charts are still very, very good to me with regards to both gold stocks and also the metal. So I'll believe it when I see it. For now, I'm a gold bull for the time being. I still think gold can work a little bit higher. If we start to see, you know, the yen start to put a lot of pressure to the downside, and then, you know, we'll see. I'll have to really, you know, we'll see how that all shapes up. Sector-wise, I'll go over a couple sector views real quick, just when talking about equity sectors. Healthcare in the last 2 months has seen one of the largest moves we've seen in recent years, and some of that is a defensive play towards pharma. I think that's absolutely the right place to be. I think near term, this sector is getting a bit stretched, but I do think that, you know, you really still want to be long the healthcare space. And, you know, this is a longer term chart of XLV versus the S&P. You note that the sector peaked out in 2015. The last couple months have seen a big, big breakout to the upside. Healthcare is now the #1 performing sector of the year. So I say that, you know, the least worst performer, vesting technology. Financials, of course, broke down substantially, and it started in December. This was a key warning for the market. When you see a group that's ranked 13%, all of a sudden gets turned on its head, and some of that, most of it was yield related. Yields peaked out late last year, turned down, financials followed suit. We are seeing a little bit of bounce. We'll see if that lasts. For now, it's a concern that we've seen such damage in the space. Yields being persistently low, financials on a rally is something I want to sell into the next few weeks. This is also important, discretionary versus staples. A big breakdown in equal weighted terms. I always look at equal weighted. I think that's really important. People look at the XLY with all its Amazon, Home Depot, and Nike. look, this is not the way to look at these ETFs or even relative relationships. Discretionary actually peaked out versus the market in 2018, right when the longer-term Bradley peaked out, right when momentum peaked out. So this has been really under pressure for a while, but it really was February when we started to see a lot of these builders, everything started to fall apart with regards to the retail space in discretionary, and that proved to be very important. So yes, we are seeing a bounce off the lows. Yes, this will be something to sell into eventually. I don't think it's just yet. Utilities on a longer term basis, and this is pretty compelling, arguably is at levels where we're nearing a very big breakout in utilities versus the S&P. This goes back since 09. So we haven't done it yet. Utilities have been a very big laggard in the last month and a very big laggard this past week. And so we're sort of churning, and this whole churning has lasted over the last year. So this is very much a weekly chart going back since 10 years. Important to know your perspective. My perspective is I am waiting for a time over the next few months when markets start to turn down. At that point, I will trust it, and I will buy utilities with both hands and think that this group can show some meaningful outperformance at a time when yields should remain low and markets likely underperform this fall. Summation index gave us some major clues. I do utilize this. Some use, the simple McClellan oscillator and advanced decline and say, well, that was at new highs back this past January, and that's correct. But the summation actually showed a very material breakdown into February, and that's something that's worth watching. And we got down to where we only had single digits, a percentage of stocks above their 200-day moving average. Now we're up to 12. That's certainly not a great sign when markets have recovered 60%. So yes, this is a big warning sign. The majority of the rally off the lows has been large cap technology. It has been the growth stocks. Now we're seeing small cap come back a little bit. We'll see if this can start to climb. For now, it's a concern that the market has gotten back a lot of what it lost, and yet we still have 90% of all issues are under their 200-day. That means we've seen meaningful weakness. So I am not in the camp that markets rally back to new all-time highs. If that happens, that would similarly be a chance to sell into this move for me. I mean, breadth and momentum are certainly still very, very subpar on an intermediate term basis. The VIX is something which is down about 60% from its peaks, coinciding also with the S&P being up 60% from those March 23rd lows. Vol is going to be tough to use as a way to fight this market. It was obviously a great tool back in January, February when 50 cent as part of the London firm was buying those VIX calls at 50 cents, and it's just a different trade now. At vol at 33, you're going to need to find different ways of betting against the market than apply volatility. Vol has remained pretty firm for a lot of the right reasons that we snap back with little to no reason, earnings-wise or fundamentally, and so that leaves a lot of unanswered questions.
Back then, Steve Volge said, Mark, that if there was someone I didn't like, I would tell them to sell volatility. That's my partner. Anyway, so, okay.
I've always been, I'm too much of a premium hog. I like owning everything and trading against it. Yeah, not volatility necessarily at these levels. And look, I think if the VIX gets into the mid-20s in the next month, then it's certainly appealing to try to own, calls.
What instrument has the less decay to own if you want to own it?
Yeah, I think that this will be something that's going to be a great trade between, June, July of this year and October. And I think when the market finally does turn down again, that this can have another run. For now, it's just not something that's an attractive vehicle.
And plus they erode. Most of those ETFs erode.
So here's a final chart. I'll just show real quick on just the AII. This is, this is last week. So you see this percentage bulls, we got down to 24%. That's remarkable given the extent of the stock market rally we've had. Really is pretty interesting. And so this is one of the few things that I do use as part of my toolbox. I think it's really, really important to look at sentiment. And, investors' intelligence is also important. So is DSI. It's just that, we've had a big market move and people de-risked on the way down and they failed to catch it. And now they're looking at the fundamentals as to why they should get back in. And everybody's scratching their heads. They're saying these companies are, they don't have any guidance and we don't know how to value them. So how can you be bullish on the market? And that's precisely a time when you should actually be trusting trends and sentiment is saying, you know what? It might still be a little early to think that the peak is in on the stock market rally because there's still a lot of people on the sidelines hoping to get their pullback, and it hasn't materialized.
Let us know when they finally capitulate and go long with both hands so we could short it,
Yeah.
Mark.
Well, when you start to hear signs of those that are expecting the stock market pull back to the lows, all of a sudden talking about new highs, that's when you want to watch out, you know,
Yeah.
and I think
Starting to
we're not
happen.
there yet. I think
Yeah.
we're not there. I think that, you know, people that were slow to turn bearish are now slow to turn bullish, both from a fundamental perspective and some colleagues that look at just long-term technicals, and they have a lot of merit as to why they look at long-term. I just tend to find that myself that when volatility strikes like it has, I want to be tactical. I want to be shorter term. To some, you know, it's to each their own in terms of their own methodology and what makes them successful. But for me, I've always found a lot of success at trying to timing on like a 4 to 6 week time frame, or even shorter, you know, over the next week, versus trying to look out a year and say, well, the market's going to be at 3,700 and these are my earnings estimate. I mean, you know, to me, I just think that a lot of that stuff isn't applicable. I mean, I'm happy to use fundamentals along with my technical toolkit when it lines up, but I almost always want to lean on trend. I want to lean on sentiment. I want to lean on seasonality and look at momentum and breadth. And for now, I do think that a bear market did start. Stocks can be 50 to 70% lower. That puts me probably out of consensus and saying shocking things like that. But I think that over the next year, people are going to come to grips. And even if the market snaps back and tests its highs this year into the end of the year, I think that'll be a chance to sell next year. I think we're not out of the woods. The cycles I'm looking at are longer term. They mean that we're going to be in a bear market for a while. So this is
What a great presentation, Mark.
Look, happy to take questions or go over anything.
Yeah, any questions for Mark? I'm looking through them right now.
Yeah, we do have one, for example, that I see here. We have a couple of them that have to do with Brazil. So one of them is, what is your comment on BRL USD? So that was one. And the other one, let me find it. There is a question also
about Dixie, but he already gave the answer.
Yes, he did answer that. And what's your comment on the Brazil economy and its interest rates? So we also have that question.
Yeah, he doesn't even
Look,
cover
I don't pretend to have any big insight as to Bolsonaro or his quest to extinguish the Amazon. And I think those are all very important points. They're just out of my toolbox. They're not how I look at things. I'm not a fundamental guy. I'm not an economist. I think that when you see a meaningful breakout like we've seen in you know, a breakdown in the real, a breakout in the dollar versus the real, that they are important. And yes, we've given some of that back in the last, specifically today. I think the real has rallied to about 539. So that's a good sign, I think, near term. But overall, you know, I look at the chart of what's happening on just a weekly basis of the EWZ, and here's a chart. If we can put this into perspective and show exactly what's happening, I mean, this is really a pretty meaningful, you know, short-term breakout of what's happening. So I put this out as a long idea. I think that we probably can get to 28, 29. I mean, that's over a 10%.
Mark, we can still see your contact information.
Oh, you didn't see
which
that.
is important. Yeah, he didn't.
Which is important. Yeah, but I mean, if you think we're seeing a chart, we're not.
Yeah.
You know,
and Mark, I have a question while you're doing that. Someone said, I wanted to know if you wrote that you thought, where is that now? That 70% of the 2009 to 2020 advance will be retraced.
You know, that's just a figure I'm putting out there because I think the cycle is going to be negative next year. And I think that we've given back 30%. And I think that we honestly, can you see the Bloomberg screen now? And how I'm looking
yes, Mark, we can.
So
we can.
This is something where, you know, just a move from 09 would put us down to
1,500.
You know, 15. You know, right near 1570, 1600 were the two prior peaks from.
Yeah, is that a natural? That double top there? Yeah, that double top there's kind of a natural, isn't it?
So we, you know, this my thinking is 60% of that would get us down to 1700. So I'm thinking that's the area I'm looking at into late next year. And I honestly, I think the pattern is retracing in a way that it's making it's going to make a larger head and shoulders type formation. And I'm notoriously critical of those that label head and shoulders before they're broken. But I do think the extent of the damage on the way down is going to prove to be meaningful. When this does stop and pull back, this could turn out to be like we did from 29 to 31 in the U.S. markets, where we grind it around sideways. You might have a small pullback and then you grind it around into July. When you finally start to turn down this fall, I believe that's going to be the time when you really got to pay attention to these lows that we put in. That they're going to be. So let's.
Okay. Thank you, Mark. You want to put your contact information up there again?
Sure.
Coach, we have a
Yes.
couple more questions for Mark. First of all, thank you. Good presentation, and so I wanted to transfer that. Somebody's asking for your view on the EU, UK, and US economies after the pandemic. So in essence, how do you expect they're going to rebound following, the end of this pandemic?
Is there going to be an end to this pandemic, and when?
That's another great question. I wish I could be that smart to say it's going to end here. I think that, I know much about the pandemic as all of you. I think that they tend to come around every 18 to 20 years that coincides with a pretty key cycle that gave us back in the early 90s, SARS back in 92, and prior to that, the AIDS, HIV back in the early 80s. So I think that that's part of a longer term 100-year cycle that was also very important to give us the epidemic back in 1918. In 1818, we had, smallpox and there's been a lot of things over history. I think the next couple of years we'll find a way out of this. Obviously, the sooner we get a vaccine, the better. The stock market is going to tell us all we need to know in terms of the recovery. And so that's going to be very, very important. I tend to look at the movement in, Europe as just being...
Mark, by saying that you assume that the stock market is going to tell us all we need to know about the recovery, in essence, you're assuming that the stock market is going to recouple with the real economy. Because to be honest, so far, what we have is unprecedented conditions, meaning economies being in complete lockdown and GDP plummeting, and the stock market that seems to already be dismissing that.
See, this is the Stocks Europe 600. This actually has gone nowhere in the last 20 years. So this is a fascinating chart that shows you the extent of which the cycle that started in 2000, that typically allows for a 20-year cycle that's going to hit the latter part of this year, normally suggests a period of underperformance. And Europe certainly has. The U.S. obviously peaked out momentarily and has had, two huge bear markets. Count this as being the third, I guess, from February, and really two tremendous rallies back from 03 to 07 and also 2009 to, late 19. So
also amazing long-term divergence on the RSI on the monthly I see there.
Yeah, and it looks like it was just a little bit of a short squeeze to new highs, and that's it.
This is the Euro stocks peaked out in 07, has never been higher, and its peak also came in 2000. And so look at the degree in which this has lagged over time. This doesn't necessarily make me think, the European economy plays catch up. If anything, I would argue that the economies and the job that we're doing here, the ammo that the Federal Reserve and the Treasury have thrown at this market, I'm hopeful that the U.S. continues to outperform. I think that if the dollar really starts to roll over and join this 8-year cycle, that, potentially we could start to really weaken. And, maybe that's the time to really get more involved in emerging markets. And for right now, I don't think that's the case. So until that happens, it's tough for me to make that call. I think domestic markets are the way to be. Emerging markets have lagged. Most of my calls on Brazil and everything else are very short term. They're really 2 or 3 weeks based on specifically what's happened in the last 48 hours. So I'm not a long-term buyer of any of those long-term laggards. I tend to think that those are still going to face substantial amount of pressure, and that really rallies over the next month or two are going to be something you still want to probably sell into.
Thank you, Mark.
Thank you, Mark.
So Mark, the best way for people to follow you, Mark Newton CMT on Twitter, and your website. You want to show it?
Yeah, that'd be great. So in general, I started my own business 4 years ago now, and providing technical analysis for both individuals and also institutions. I work with a lot of RIAs and wealth management firms, and this is something where
There it is.
I provide technicals on largely a tactical basis. I keep on top of the S&P trends. I am largely equity focused, though I do have probably much more of a tendency to look at FX and just treasury yields in general. I think a lot of them are very much interrelated. So I offer, a trial to those that would like. Simply, if you go to newtonadvisor.com, then a form will pop up within a few seconds. You can fill it out, and I'm happy to add you to a trial, and we can go from there. If you want to ask me a personal question, personal meaning direct individual, then just go to info@newtonadvisor.com. It's a general mailbox, and happy to field your questions when I get time. And until then, I publish a lot in StockTwits. If long and short ideas are what you like, I have my own room I run in StockTwits that has been largely very successful, and it's only long and short ideas. But I provide those also to people that are clients. So you can join at a very reasonable rate as an individual. If you're an institution, I'm happy to work with you as well. Obviously, the more customized work I give you, the higher the fees are there. So, but happy to work with whatever it is that you can do. So yeah, I just want to wish all of you, the utmost in safety and happiness and good health in the days, weeks, and months to come, and stick together, because we can all beat this. I have some Q&A questions, and let's see if I can. People are asking.
We did cover them, I think.
We covered them.
Yeah, I think I covered the majority of them. I don't use a lot of VWAP in my day-to-day work, but it is something
that was for Jamie. That was a question asked for Jamie.
Wonderful. Yeah.
So Mark, I want to thank you for what you contributed to the summit today. Thanks for walking to the flat part of the mountain and hanging out with us today, Mark. And what a great presentation. You know what? They're better if I don't talk too much. So
well, I figured I would just lead. I knew you would get a word in somewhere, but
it was great. It was great listening, Mark.
I'm happy to send this out to whoever would like. I have a copy of my presentation, so feel free to email me and I'll pass that along. And
we will also make available the recording, Mark. In a couple of days, recordings are going to be ready, and they're going to be uploaded and mailed to people, so they will be able to rewatch it again there.
Thank you very much. Well, thank you for all your time today, and I appreciate everything, and happy trading and investing, and have a great time going forward. Best of luck to all of us.
Same to you, and
thank you,
people
Mark.
Don't forget, tomorrow there is the second and last day of the event. So today was great. Tomorrow another great day. Coach, why don't you?
Thank you again, Mark, my trading warrior brother. Good hunting. For those of you, you're very welcome. Our sponsor being IG. You can open an account with IG no matter where you are on the planet.
I put the information in the chat, by the way, for people that want to.
Right, the info is there. So even in the U.S., it's nice to have another choice as an FX trader. I believe they trade other instruments as well, but FX being their specialty here. So consider IG, go to their website, check out their rates. As Justin said, really courageous of IG to give U.S. citizens another choice. They had to go through a lot of hoops and costs, so it's worth giving them a look. And there's never a log as having more than one account. So you could have one account where you are right now, and you don't know if you have a good racehorse until you run it against another. Consider IG and the links that we have. Also, get ready for another great day tomorrow, Warriors. We have a great lineup tomorrow. Looking forward to continuing this summit. And in the meantime,
same time, of course.
Same time. Good luck with the Fed today. I don't know, has the Fed Paul spoken yet? Steve, or
No,
I still have time to scalp my brains out?
you
And
do.
that means a haircut? No, just kidding. So thank you everyone for hanging out with us.
And by the way, tomorrow, Dale, we have Boris Schlossberg, we have Adam
Yeah.
Button, we have the
Oh,
CMT
yeah.
Association, we have this guy Blake Morrow. I'm not sure who he is.
Oh, yeah, I've never heard of him. Peter Goodburn.
We have Stephen Marcantonio, and we also
Oh, the
have Peter
Pivot King.
Goodburn and Lydia Finkley.
Yes, and Cable Queen. So
Yeah.
tune in tomorrow. And it's our mission to build up and edify traders every day. Hope we did that today. Thank you, Steve. And above all, don't just count your pips, count your blessings. Adios, everyone. See you tomorrow.
Bye-bye, everyone.
You're
See you
welcome,
tomorrow.
everyone.